comes to the markets with the tariff component. What should we actually be paying attention to?
Yeah, it certainly feels like Christmas morning that we're getting these earnings results, especially given the lack of data and the political developments we've seen over the last couple of sessions. We're hoping for a nice rerun of the last couple of quarters where analysts pencil in high single-digit estimates and companies beat with low double-digit results. I think the plot twist, though, this time would be, can companies start to quantify the impact of tariffs on their results? In the second quarter, CEOs talked about the potential for the punch from tariffs to impact their businesses. Now that that punch has been delivered, can companies quantify that? We've seen negative earnings revisions in areas like consumer staples and materials. We may start to see the margins of those businesses impacted by tariffs this quarter.
In terms of the banks,
yeah,
we're obviously getting those numbers. Of all of the companies that you want to see this quarter to try to better understand what's really happening, you want to see what?
So financials is so critical, Andrew. When you think about the fact that the stock market has been the biggest driver of the U.S. economy, financials are in the front seat of that. So we're looking at particular like areas like wealth management and capital markets as investing in financial outcomes or financial assets has really produced superior outcomes. We're watching for potentially more guidance on M&A from mid-sized banks that are expected to see 30+% earnings results this quarter. The yield curve is steeper than it was a year ago, another potential tailwind. So the fact that the market is up as much as it is over the past year, we think is going to be a significant tailwind for the financial sector. Tech is another one, of course, the other area with the biggest positive earnings revisions, 5% up to about 20% earnings expected in the third quarter. We'll be watching that. There's almost a symbiotic relationship between tech and financials here, is because tech has driven the market higher, that's helping these wealth management businesses as well.
Of the banks, is there one or two that you like more than another?
We don't do individual stocks, so we're watching the sector here more broadly. I do think regional banks have the most sensitivity to this. So looking down in market cap, mid-cap banks have been an area that we have favored, given some of the potential M&A that we see coming down the pipeline and some more exposure there to the U.S. economy.
And finally, how do you think about some of the smaller companies on the Russell, for example? Do you think that they're out of favor, going to be in favor?
So we have been underweight small caps. Almost 40% of the Russell 2000 index is comprised of unprofitable companies. We are focused right now on companies that make money. We're drafting off the equity market in our views right now with an overweight to higher quality companies. We're fully invested, but we're not chasing junk here. We do think if there's some more volatility here, you could feel it in the smaller parts of the market. Mid caps, again, have been the sweet spot to manage the valuation risk, the concentration risk that's inherent in U.S. large cap stocks, but really staying away from some of the more speculative corners of the market here as we head into the last couple of months here of the year.
Okay, Emily, we're going to leave it there. I want to thank you for joining us this morning.
Thank you.
You bet.
When we come back, a music industry milestone for Taylor Swift. We'll tell you whose record she broke for first week album sales. Got the answer for you right after this quick break. welcome back, everybody. We are just getting results from Johnson & Johnson. Turns out that earnings and revenue both beat the street's expectations. Looks like the company is also raising its full-year sales outlook. Adjusted earnings of $2.80 a share beat the street's expectations of $2.76. Revenue came in at $23.99 billion. That was better than the $23.8 billion consensus. And J&J is now saying that it sees full year 2025 revenue of $93.7 billion at the midpoint. The street's at $93.4 billion. They're also saying that they're backing their full year guidance of adjusted earnings per share of $10.80 to $10.90. The street's at $10.86. Another big headline that's coming from J&J this morning as well. It says it's going to be separating its orthopedics business. That standalone business will operate as DePuy Synthes. J&J expects to complete that transaction within the next 18 to 24 months. That's a big part of the company. I think it's around 9 to 10% of its sales overall for the company, something like $9.2 billion. The overall company had $93 billion. It is a smaller portion of the profit, but we'll get the chance to talk about all of this with Johnson & Johnson CEO Joaquin Duato is going to be joining us right here on set at 6:30 Eastern time. So we'll talk through all of this. The shares of that company right now are up by about 1.25%.
And Taylor Swift, shattering records. She sold just more than 4 million copies of her 12th studio album, The Life of a Showgirl. In the first week, in 1 week, at least in a week, the number includes actual album sales, also, as you would imagine, streaming activity, and the title had been held by, we tease this, Adele for a decade.
Coming up, we got a lot of earnings news to bring you. The big banks, they're all coming up. We're expecting JP Morgan near the top of this hour. We're going to bring you those results as soon as they hit. And as we head to a break, a look at yesterday's S&P 500 winners and losers.
we have some breaking news from GM. Our man Phil LeBeau is going to try and fix it for us on the Squawk Newsline for details. What do you got, Phil?
Hey, Joe, we have General Motors taking charges totaling $1.6 billion for the third quarter related to reduction in what they expect to be EV capacity, as well as unwinding some EV product-related contracts. So as a result, they're going to take $1.2 billion in one charge as an adjustment to EV capacity, another $400 million in contract cancellation. So as you take a look at these charges, that's 1.2 plus 400 million, 1.6 billion. These charges and other non-cash impairment and other charges, that's adjusted for the third quarter as the company dials back what it expects to do when it comes to EVs. And they also say in this announcement that they will expect future charges in future quarters as they continue to adjust to the fact that the EV market is just not what it once was expected to be, and as a result, they're going to be dialing back their capacity.
So, remember we just had Farley on, was that last week, Jim? And we actually asked him about this because the word was already out about GM that they had quietly pulled back, and I don't remember exactly, you probably do. By 2030, they were going to be at some crazy number, they said, and then they totally abandoned that number and came up.
They've abandoned that for some time. They've abandoned that for some time. And Mary Barr, when you talk with her, will tell you that she will be cautious now to put out a specific percentage of vehicles that they expect to be electric by 2030. Where at one time, Joe, and I don't know the specific
it was like
percentage,
50 or something.
it was expected to be something like half of their vehicle sales.
It's like 50.
And then growing to 100% by 2038, 2040, sometime, and that was the original plan. But yeah, she would, if you were to pin her down right now and say, what do you expect by 2030? She'll clearly say that the market is not going to be what they once thought it was going to be, but I also think that she will not give a percentage. At least, to my knowledge, she hasn't done one recently.
Because Farley said, when we asked him, he said, yeah, I would have never done that. Basically, he said, I'd never try to give a...
I think that's the whole industry, Joe. I think you have a lot of automakers who they got out there saying back in 2020, 2021, we're making these investments. We want to be all electric by 2035. We expect that our portfolio can be 100% electric by 2040. You don't see that anymore. There's nobody.
It wasn't in a vacuum, though, Phil. There's a Biden administration, and there are a lot of ESG groups and all kinds of stuff. Pressure.
You are correct. They felt the pressure to make those investments. They felt that this was the pivot that was going to take place long term, which is why they made the investments that they've made. But now they've got to unwind those. And unwinding them is going to be costly. That's what you see with these charges from General Motors. And listen, Joe, we're going to see this from other automakers
That's
as well.
what I was going to ask. Is this not, this is
you
just
will
beginning?
see this from other automakers as well, that they are figuring out, okay, what's going to be the right mix here? How much of this that we earmarked at a particular plant for EV production can we adjust and go to hybrid production?
Yeah, hybrid.
Complete internal combustion engine vehicle production.
Right. They definitely are hybrids are along the way to where people want to get, obviously, but they're also, we're going to ramp up F-150s with V8s and we're going to have a six backseat SUV for, they're not pulling back on ICE or gas guzzlers that much. I guess they're trying.
Not pulling back on ICE and gas guzzlers. What they are doing, Joe, is they are saying those models that we have right now, how can we expand production, and where can we expand production? And increasingly, to this news from General Motors, they're looking at the plants where they said, well, we were going to make X number of electric vehicles here. Let's retool it and go back to ICE engine vehicles.
But speaking of administrations having an impact and an influence, are they talking about doing that in the United States now to comply with the Trump administration for more things made in America?
You mean, Becky,
From where you ramp up stuff. Yeah.
Oh, absolutely. 100%. And look, the CAFE standards have gone away. And the automakers wanted the CAFE standards to go away. And who wouldn't? That's a cost. That's a cost that they've borne for a number of years. Now that they have gone away, the automakers are saying, okay, we don't have to worry about what our fleet mix is going to be. Where is the market right now? Where is the consumer? Is the consumer saying, I want just an internal combustion engine vehicle? Is the consumer saying,
The
I want
problem
an
becomes if you are constantly investing billions of dollars in initiatives that one administration is pushing, and then the next administration pushes you the opposite direction. I mean, that's a problematic thing for automakers and for other companies too. How
which
big
is
of a
what,
cost
Becky,
is this to bear?
which is why the multiple is what the multiple is.
Right.
The constant invest, de-invest. Swing one way, swing the other way. What are the CAFE standards? They've been reversed. There has been no consistency for the automakers, at least for 25 years. Minimum. And as a result, if you were an investor, you were investing only for the dividend. There's nobody, aside from those who were investing in Tesla, there's nobody who was saying, I'm going to invest in General Motors because I expect that stock to double in 5 years. There's no guarantee of that because of the constant investment that they're making, multi-billion-dollar investments, and now we see they've got to unwind these that were made back in 2020 and 2021.
It's administrations change, but what doesn't change is the marketplace as quickly, and they have miscalculated on that I think more than anything. So, right? I mean, except maybe where you build them, administrations can matter, but administration cannot make people
Right. Well,
move to
except for the
the
Biden
EVs.
administration put all of those
Joe,
EV credits on.
an administration cannot do that, Joe, but an administration that
To do
does
credits. Yeah.
offer $7,500 tax
Yep.
incentives for consumers, I mean, that's
Yep.
why the automakers made the investments they made. They
Nobody
felt
wants
that at a minimum
Right.
it was going to be
Yeah.
there through the first Biden administration.
But
which
this is what happened. Even with all that, this is what happens. You know, those are pretty big charges. I guess they're non-cash, but they still ugly.
And there will
All right.
be more. I think the news here, Joe, they have said explicitly in this release, there will be more charges in future quarters.
There will be blood. Okay.
Wow.
All right. Thank you, Phil.
Okay. Meantime, third quarter results are just out from Wells Fargo. Leslie Picker is with us this morning, going through those numbers for us. Leslie.
Hey, good morning, Andrew. Yeah, shares up about 3.3% in pre-market trading. The company did raise its medium-term target for return on tangible common equity to 17 to 18%. I believe that's why the shares are reacting so favorably. If you recall, the company has really transformed itself, diversifying its revenue mix, growing its fee-based income, and reducing expenses. So that brought ROTCE over the last 5 years from about 8% in Q4 2020 to 15% currently, and then they're raising that to 17 to 18% in the medium term. As for the quarter itself, a beat on the top line here, coming in at $21.4 billion for revenue. That's up about 5%. We're not comparing the bottom line at this point in time. And net interest income, that's the profitability metric for loan making, that was a slight miss relative to expectations, but it was up 2%. Their guidance for net interest income did not change. That stays at about $47.7 billion for the full year. Their expense guidance, however, was taken up a little bit for non-interest expenses to $54.6 billion for the year, up from $54.2 billion, and they say that's due to severance as well as higher comp in certain businesses. Charlie Scharf, who is the CEO, named chairman as well. That was widely expected. And in the statement, he said, quote, while some economic uncertainty remains, the U.S. economy has been resilient and the financial health of our clients and customers remain strong. And you can see that in terms of net charge-offs, which came in better than expectations, provision for credit losses coming in better for expectations. So you can see their Wells Fargo shares of about 2.9% on these results, which included an increase in their ROTCE target for the medium term, guys.
Leslie, thank you. Appreciate it. I know we'll be talking a lot more to you because we've got some more results coming very, very soon. Thanks.
And Leslie's got all the in the weeds as far as estimates, because we're just for JP Morgan. We'll give you the bottom line of 507. We can tell you that is above estimates of 484. Revenue is also above 46.43, above 45.388. But the stock is down a little bit, and it's early and thin trading, so we don't know how it's going to play out. But there's so many metrics and there's so much assets under management up 18%. Book value is amazing because look at where the stock is, and the book value is like $120 or something like that. So it is, you can tell just, the premium that Jamie Dimon is awarded just from, I guess, year after year after year of being a great risk manager gives you a pretty good premium to a lot of his peers. Some banks trade at 1 times earnings. This is not quite 3, but almost 2.5 times. Not earnings, but times book.
All the financials have done well this year. This one's up by 38.5%.
Yeah, which is
the last 1 year, not year to date.
As far as we're going to have we're going to have Stephanie on in a couple of minutes to talk about more of these details and credit charge-offs, net charge-offs, 810 million net reserve build. Credit costs include 2.6 billion of net charge-offs. I don't know whether that's worse than expected or not. That's what I'm saying. You need to go deep into the weeds for expectations on this. But stock right now, 305 bid, 309 ask, and it's trading somewhere coming back a little bit.
And it is a very heavy earnings day. Johnson & Johnson, as we mentioned, reporting third quarter results this morning as well. It beat expectations on both the top and the bottom line. The company also announcing that it's going to be spinning off its orthopedics business, with the transaction expected to be completed within the next 2 years. In fact, I think it's a separation. We're not sure exactly how it's going to be separated from the company, but joining us right now to talk about this and much more is Joaquin Duato. He is Johnson & Johnson's chairman and CEO. And Joaquin, thank you for joining us this morning.
Thank you, Becky.
A lot of news to run through. Why don't we start with the earnings? They were quite a bit better than had been expected, and there was a lot riding on this with the expiration of exclusivity for Stelara. This was a big year, and people were watching to see what you did. So what happened here?
Thank you, Becky. It was a very strong quarter, and it's more than a strong quarter. It's a sign that Johnson & Johnson is entering in an era of accelerated growth. The quarter was very strong. Our growth was 5.4%. We beat analyst expectations both in top and bottom line. We are increasing our full year guidance for revenue and maintaining our elevated EPS guidance. And we answer unequivocally one of the questions that investors were asking from us, which is, can you grow through the Stelara loss of exclusivity and the biosimilar entry? When you look at our growth in our pharmaceutical business, if I exclude Stelara, our growth was 16%. So very strong growth. How we did it? In the pharmaceutical business, we had 11 brands growing double digit. Perhaps the standout is Tremfya, which is the product that operates in the same area as Stelara, that grew 40%. So we think that Tremfya, it's going to be bigger and better
Is that
than
an
Stelara.
autoimmune disease?
Exactly. It's approved now both for plaque psoriasis, and also recently we are in the middle of the launch in ulcerative colitis and Crohn's disease. We also had great results in our medtech business with sequential growth, 5.7% in our medtech business. And we had a standout in our cardiovascular business with 12% growth, with Shockwave, our recent acquisition in calcified arterial disease, growing north of 20% and treating its 1 millionth patient. So as I said, we are in an era of accelerated growth for Johnson & Johnson that we see lasting for the rest of the decade.
Joaquin, Carvykti, your multiple myeloma drug, just was kind of pointed out by the FDA earlier this week that you have to have a warning label on this now for fatal impact on stomach or intestine issues. What's the impact of that? Multiple myeloma is a terrible disease, but they did see a couple of instances of patients who were taking that who had intestinal trouble that in some cases could be fatal.
Carvykti is a transformational medicine. The growth in the quarter was 80%. When I talk to clinicians, they tell me that the risk-benefit of Carvykti is excellent. Keep in mind that Carvykti is treating patients with late-stage multiple myeloma. Now we have the approval to 1 to 3rd lines prior therapy, and we have overall survival. This is the closest to a cure that you can get. In the patients that were treated in the initial trials, we have about a third of the patients that are living more than 5 years disease-free with a single administration. So the risk-benefit of Carvykti remains strong. We have already 8,500 patients treated. We are unconstrained in supply, and we continue to see CARVYKTI as the most successful CAR-T launch ever. This is only a sign of our strength in multiple myeloma. Our other standout there is DARZALEX, that grew 20% in the quarter. It's our largest medicine today. Today, out of 5 patients, 4 are treated with Johnson & Johnson medicines when they have multiple myeloma. We are not going to stop until we find a cure for multiple myeloma.
It is a terrible disease. I'm glad to see you making progress on that. Let's talk about the separation of the orthopedics business. Why this business? Why now?
Thank you. We have to be good stewards of our capital, and we have to prioritize Johnson & Johnson to focus in areas where we can identify breakthrough innovation to make progress for patients. And at the same time, we have to be able to recognize where a standalone company may be more able to compete and to win. So orthopedics is such an area. We think a standalone company, a focused orthopedics company, it's going to have the operating model and the ability to be able to drive the commanding market shares that we have today in a market which is more than $50 billion, that is fueled by the aging of the population. I think that a focused company will be able to drive better margins and better growth. When it comes to Johnson & Johnson, it also helps our medtech business to move into high growth, high margin areas. Right off the bat, if I take 25 as an example, our medtech business would be able to increase its revenue growth by 100 basis points and its margin by 100 basis points without our orthopedics business.
Why? Oh, your business without that.
Absolutely, absolutely.
But this is about 10% of the revenue of the company. It's $9.2 billion for DePuy, $93 billion that you make annually. So that's a big chunk to slice off.
Yeah, as I said, we have to be good stewards of our capital. We have to be active portfolio managers, recognize and prioritize the areas in which we can be in breakthrough innovation, and at the same time, areas that are going to operate better as a standalone company. This is what we have been doing for a long time. This is how you manage a large company like Johnson & Johnson, and ultimately it's going to create better innovation for patients and better value for shareholders.
Your stock has been on a tear this year. I don't know if we can look at a 1 year or a year to date. For the 1 year, it's up 18%. It's up even more than that over the year to date period. Why do you think that is? Year to date up 32%. What are investors seeing at this point? What are you seeing?
Investors are recognizing that we are in a new era of accelerated growth, which is based on the strength of our portfolio, both in pharmaceuticals and in medtech, and also our pipeline. We have a tremendous pipeline. We just got the approval of a new therapy for localized bladder cancer called INLEXZO that combines our capabilities both in medtech and in pharmaceuticals. It's a targeted release system that delivers a cancer treatment into the bladder. There's about 1 million patients with localized bladder cancer every year. It's going to be, this platform, our next more than $5 billion blockbuster. Also, staying in pharmaceuticals, we just filed for icotrokinra, an oral peptide that blocks IL-23. So far, for treating these autoimmune-mediated diseases, you were using biologics that are injectables. For the first time, you're going to have a medicine that is oral for treating these conditions with a similar efficacy and tolerability than biologic. We think it's going to be our next blockbuster. In medtech, we continue to progress with our surgical robotic system called OTTAVA, and we plan to file with the FDA beginning of next year. So we have a number of important catalysts in our portfolio that are going to drive this new era of accelerated growth.
Again, year to date, you're up 32%. It's certainly been some momentum after 5 years of that stock really kind of languishing because of the talc lawsuits that were out there. Can you give us an update on where things stand with the talc lawsuits? I think there was recently a judgment of almost $1 billion made against the company.
Absolutely. And let me use the example of that judgment that you mentioned. We are fully confident that this verdict is unconstitutional and that we are going to be able to overturn in appeal. But let me tell you, the earlier days before, we had another verdict with the same law firm with a very similar case in which we prevailed. That shows
your strategy has been to take on every one of these cases. You're not willing to settle. You're going to fight them case by case.
Absolutely. That shows what I was saying you, because we have a strong case. We think that what the plaintiff lawyers have presented is fake evidence. We are now looking to our Dauber hearing, in which a federal judge is going to re-examine the fake evidence, the junk science that the plaintiff lawyers are using to base their claims, and we think we're going to come out stronger out of that re-examination of the junk science. We are now back in the tort system. We're going to fight every single case. We have not paid a dime, and we do not intend to pay a dime because we're going to win either in first instance or in appeal. So we are very confident in our position there.
What happened to the settlement that you all had orchestrated at one point?
We have reversed that amount of money that we reserved, and now we are focused on going back to the tort system and fighting every single case.
Joaquin, let's talk a little bit more about the spinoff of the orthopedics unit, or spinoff separation. You're open to doing a spinoff, but you could pursue other options. Is the business up for sale potentially too?
Absolutely. Our orthopedics business, as I said, it operates in a large $50 billion market. It's a company that it's profitable. We're going to call it the Pew Synthes. That's going to be the name. We're going to appoint an industry veteran as the person who is going to take it to the next phase. And our view is that we are open to different alternatives there. Our preparations is as if it were a spin-off, because that's the longest process. It's going to take 18 to 24 months, but we are open to anything that is going to create shareholder value and is going to take the company to the next level.
Have you had any bids of interest or any calls?
No, I mean, we just announced today.
Yeah.
This is breaking news. It's only for today, but we expect to have multiple alternatives, and we're going to select what makes more sense for us and creates more value for shareholders.
Protagonist, another company, that stock is up 30% after the Wall Street Journal reported that you were in talks to buy that company. Are you?
We don't comment on these rumors. We have to tell you that we already own the majority of the value of the main asset of Protagonist, which is Icotrokinra, the oral IL-23 that I described. We have a great working relationship with Protagonist, and we are very happy with that arrangement. I think this is a sign of how good we are in business development. We signed a global licensing agreement with Protagonist in 2017. It didn't even make the headlines, and now we have a medicine that we have the global rights that is going to be another blockbuster. So it's another indication of how we are able to identify opportunities early on, invest in them, and make big impact on patients and big impact for our investors too.
Joaquin, what would you ask for the Pew?
We are open to different alternatives.
Just give me a range.
I cannot give you a range now. We're open for different
Is it worth
alternatives.
$10 billion?
I cannot give you a range. So we are.
Is it worth more than $3.5 billion? Is it bigger than Bread?
Look, I cannot give you a range.
1998, I think you J&J paid, and then we were talking. We remember because we're.
Investors will value it, and we'll see.
And I think it was $3 billion was what.
The sales
They've got
of
9.2
our-
billion in sales now.
9.2 in sales. So I wonder, what is it? What does an orthopedic company trade at as
Just for the
price
industry
to
sales.
sales?
For the industry, I
Price
mean,
to sales.
the market will value it. We are working as if we are going
Well,
to
you made
a
money on
spin-off.
it at least. Okay.
Yeah, we
Then
make money on it. It's a
27
profitable company.
27 years.
We have been in the orthopedic business for a long time. We
Yeah.
have great positions in all the segments of orthopedics, in trauma, in joint reconstruction, in sports, in spine. So it's a very attractive. It's going to be the largest orthopedics company in the world, and it's going to be poised for success.
Who are your big competitors?
The competitors there are Stryker,
Stryker.
Smith & Nephew,
Smith &
Zimmer
Nephew.
Biomed. That's the area where we compete. And we are convinced that this is going to be poised for success, and there's going to be a lot of investor interest. And at the same time, as I said, it shows that we manage the company for the long term. It shows that we are an active portfolio manager. That's what our investors are asking us. We place Johnson & Johnson in a better place to deliver breakthrough innovation, and we create a standalone company which is going to succeed.
You got a bone saw?
I want, we have all type of instruments.
You
there.
got a bone
You're
saw?
thinking
We
from
have
when
a
Steve
robot.
McMillan used to bring
Yeah,
stuff
he used to
like
bring
that.
bone saws in,
Yeah,
and
we
he
have
was
a
going to
robot.
work them. He was going to use them all.
We have a robot for knee replacement. We are launching a robot for spine. And we have different navigation techniques and software to help in hip replacement and other areas.
Little amazing, whatever you make, like a hip.
We make
Placement
hips,
out of-
knees,
yeah.
shoulders, wrists, everything you can imagine, and we have leading positions in all markets there.
Happy Halloween. Joaquin, very quickly, the Trump administration obviously has been very focused on the pharmaceutical industries. We've seen the deal that Pfizer cut to offer cheaper drugs directly to American consumers. Are you in talks to do something along those lines too?
We have been talking to the Trump administration since day one, or I would say even before day one, and we share with them similar goals about making sure that innovation is affordable for American patients, that foreign entities do not free ride in our innovation, that we bring manufacturing jobs into this country, and we announce our $55 billion plan, which is going to essentially make us be able to manufacture all the medicines that are used in the US. And I cannot announce anything today, I cannot share anything with you today, but rest assured that we are in direct communication with this administration, and I think we have common ground.
So there's something in the works.
We have common ground.
Look, we hope you'll come back when you have something to talk about with that too. We appreciate your being here today.
Thank you. Thank you, and I'm glad to be here in a day that I can tell you confidently that we are in a new cycle of accelerated growth for Johnson & Johnson, and I think investors are recognizing that based on the strength of our innovation and our pipeline.
Joaquin Duato, thank you. We appreciate it.
Thank you.
Squawk Box will be right back.
There's crypto prices really following the equities right now, risk off. Check out the shares of crypto related companies. They're weak as well this morning with some pretty big moves. In fact, 5% losses. I think what's the Dow now? Dow's now indicated down almost 400 points in the NASDAQ as well. The 10-year's right at, where's the 10-year? It's right at that level where we might see a 3-handle, which we haven't seen in a while. Oil, I saw earlier, I don't know if we've looked at it, there's the 10-year, 4.005, and there's crude, 57. 57 crude, while silver and gold continue. over and over.
Coming up, we got more big bank earnings, and in today's 8 a.m. hour, we're going to talk about a potential AI bubble with former White House economic advisor, Chairman Jared Bernstein. Squawk Box, be right back. It is just about 7 a.m. right here on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin, along with Joe Kernan and Becky Quick. A lot of big stories. It's also Pub Day, 1929. It's Book Day, but not nearly as important as some of the bank earnings we're going to get.
Taco Tuesday.
Pub Day. Pub Day. They call it Pub Day. In the book business.
Really?
Yeah.
Because it means
some people have
totally,
streamers come down. They get all
different thing over in the UK.
Oh, Pub Day. Well, yeah, but on Pub Day, you could publish your book and you could drink at a pub.
There you go.
Is there something called celebrate? Is it pub crawl got anything to do with publishing, or probably not? Pub crawl is from pub to pub.
That's from pub to pub.
Yeah.
We're going to go from pub to pub here, a different kind of pub to pub. Our top story, China sanctioning 5 U.S. subsidiaries of a prominent South Korean shipbuilder. A spokesperson at China's Commerce Ministry saying the 5 entities have supported the U.S. government's investigation into the Chinese maritime and shipbuilding sectors. And take a look at shares of GM. We were just talking to Philip O about this in the past hour. Shares of GM right now, you can look, they're off about 3%. The automaker taking and this is big news, $1.6 billion in charges for EV capacity realignment. That's what they're calling it. The company also expects EV adoption to slow. This, of course, after recent government policy changes coming largely from this Trump administration. And Philadelphia Fed President Anna Paulson saying that rising job market risks enhance the case for more interest rate cuts. Paulson made that comment to the National Association for Business Economics. She sees a likely path of policy easing along the lines of what the Fed projected last month.
I was lost without you, Leslie. You were busy. For J.P. Morgan,
You
all I
had it
gave
under
was
control. You're
No,
great.
no, but you're in the weeds. I had top and bottom lines. There's much more important. You got Wells Fargo and J.P. Morgan, but now you can tell us if there's anything in the granular details. I think it's all probably pretty good. I mean, with the market down 380 points to be off, what's it off? I don't know. In fact, it's not. Now it's not even off anything basically. J.P. Morgan is down just a couple of pennies at this point.
Yeah, I'll give you those granular details, but first of all, I just wanted to say something high level, which is that the statements from Jamie Dimon of J.P. Morgan and Charlie Scharf from Wells Fargo are almost identical. They both say some semblance of, while there have been some signs of softening, there's some uncertainty out there, the economy remains resilient. You can kind of see that in the numbers they provided, where Wall Street businesses were very much higher during the quarter, whether that's trading, whether that's investment banking. Both firms saw significant strength there. JP Morgan's business is huge in that front. Its investment banking fees were up significantly year over year. But then you also look at its kind of loan-making businesses as well. And with JP Morgan in particular, they provided guidance, and they said that their net interest income, that's the profitability metric for loan making, was actually going to be higher than the prior guidance, at least implied based on what they're seeing in 4Q. They said NII would be $95.8 billion compared to prior guidance of $95.5 billion. And they said their NII ex markets for next year, for 2026, would be about $95 billion. As it pertains to the health of the consumer, well, when they gave their guidance for net charge-offs for the full year for their card services, those are basically the proportion of loans that are bad and they don't expect to recover them. They actually lowered that to 3.3% from 3.6%. So again, all of that signals that there's some significant tailwinds, at least for the loan-making business for Wells Fargo. And you saw a pretty similar thing with, or for JP Morgan, you saw a pretty similar thing with Wells Fargo as well, where they did miss on net interest income. It was still higher for the year, and then they didn't change their net interest income guide, and they brought up their targets for return on tangible common equity. So bringing these two together, the Wall Street businesses are strong, the loan-making businesses are very resilient, and we'll get more from Goldman Sachs and Citi later this morning for 2 additional data points to look at, guys.
Okay, and stick around, Leslie, please.
I won't go anywhere.
You will. Okay, and hopefully they'll cooperate, not come at the same time.
Yeah.
So
They really should coordinate better.
I know. Don't they watch? Joining us now, Stephanie Link, Hightower Chief Investment Officer and a CNBC contributor. And anything you tell us today, Steph, we just point out, the Dow's down. Actually, it's improved a little. It was down almost 400, down almost 300 now. So any of the moves in the banks may or may not reflect company specifics with earnings. So just tell us what you thought of J.P. Morgan and Wells at this point.
Yeah, and Leslie did a great job in terms of summarizing. I think that for Wells Fargo, it was about the net interest income. That's the reason initially the stock fell, because it did come in a little disappointing, a little bit light, but they actually raised the fourth quarter net interest income, and the full year was unchanged at $47.7 billion. But the expenses were a little bit higher too, so it was kind of a mixed quarter. But the ROTCE guide, the profitability metric, getting from going from 15% to 17-18% is a really big jump, and it has everything to do with the asset cap lift. This is why lifting the asset cap was so incredibly important for the company. The asset cap was in place in 2017, and they lost huge market share in deposits, 20% actually, and now they're investing so that they can gain that market share back, and we're starting to see the results with the guide. On JP, I mean, my goodness, it was a great quarter. It's just that the stock is up 28%, and it's not cheap at 2.5 times book. But I mean, you had investment banking fees up 17%, trading up 24%, equities up 33%, FIC business up 21%, and their deal-making fees were up 16%. So, I mean, it was really good across the board. It's just had a nice run. So I think if these stocks are weak today for any reason, you know, macro-wise, I think you buy them.
Now, can you glean anything from like price to book? I mean, you wouldn't know what to do with these banks, would you, if you based it on that? I mean, you'd short JP Morgan and go long some, I don't know, Citigroup or something?
Yeah, I mean, Citigroup's trading at 1.1 times book. It's for a reason, though. They haven't executed in years. They're just starting to get their momentum back, but it's been a long time. JP Morgan has been just so incredibly consistent and just really great results. So there's a reason why it's expensive. But the numbers are huge. I mean, ROTCE of 20% at JP Morgan, that's crazy. So anyhow, the numbers are good. I think there is more upside in Wells Fargo. I happen to own Wells Fargo because I think, again, as they invest more in their business, as they can grow their deposits across many different lines of business, they will see more profitability and market share. And so that's why I think that one is quite interesting.
Is there anything in these results indicating any type of 1929 type situation with the credit? Anything? Can we make a segue to Pub Day from this step? I think we're not in a position where that's going to happen again, Andrew. Are we?
I'm hoping it doesn't. I think we are potentially more, I mean, this goes to what Paul Tudor Jones was saying a couple weeks ago. I think potentially we're more in a sort of 1999-ish,
you said that.
maybe 97-ish
I took issue with something
kind of scenario.
This happens to a lot of guests because we start talking to each other. Yeah, but I took issue with your, I don't know, your belly aching about that crappy Elizabeth Warren thing that we got rid of. Thank God. You acted like that meant that suddenly, yeah, you're like now the 1929 is more like, because we don't have Elizabeth Warren's thing going. It's like good riddance.
Well, no, but a whole bunch of guardrails are coming out.
Right. Well, that
is true.
That guardrail was, you know, we
might not have liked that guardrail. Look, we have the SEC.
Right,
we have a lot of lessons from 1929. Hopefully we'll repeat them.
We don't need the Fed worrying about climate change either, right? I mean, we can go too far with some of this stuff, don't you think?
I think actually that deregulation is going to open up a whole nother growth vehicle for these companies.
Could be safer.
Well, they have since 2008 they have had huge capital levels and requirements, and they're for the most part they weren't really necessary. I mean, they were really aggressive. So Basel III Endgame will happen sometime this year, I think, or early next year, and then the companies will not have to have as much excess capital. They still have to have a lot, but they're not going to have as much. And they can therefore use that capital to buy back stock, to increase dividends, and oh, by the way, lend. That's what we really want them to do. That's what Jamie Dimon has been complaining about since 2008. He wants to lend to the small and medium-sized businesses, but they've had to hold so much capital as a result.
Will that save us this time, Sorka? I mean, the capital requirements are much greater now. Are they not?
I think so. I mean, I like to think that they're stronger.
They are.
I do. And I think that there's some real lessons that were taken away from 1929 that actually Ben Bernanke put into effect in 2008. But the truth is...
Have you heard from him?
I have, but the truth is that you need to have a politically independent Fed, because when you do have a crisis, hold on.
Are you steering this to Trump, too?
No, I'm just saying about, well, we're having a conversation what's going on now.
I'm not having a conversation about the bad orange man.
I'm not. What I'm suggesting to you is when there is a crisis, typically you have to do things that are severely politically unpopular.
I.e. Paul
Volcker. What happened in 2008 may make it tougher for the Fed to act as strongly before. There's still a huge part of the Congress that is furious about that.
Yes.
There's still a huge part of the American population.
Yes, but that was the right answer, and that was the lesson of 1929.
It was the right answer at the time. And I just wonder if the ripple effects are still kind of...
Oh, I think it'll be very hard. But I think one of the things you go and realize is back in 1929, to the extent we're talking about it, one of the reasons they sat on their hands as much as they did was because they were scared. Because they were a new institution. They were born in 1913, and they were not just scared about it getting hauled up in front of Congress. The thing was so new that they were scared, frankly, that the entire institution would be dissolved.
Yeah.
Just like the Consumer Protection Bureau.
I mean, there are people at home right now like headed to Barnes & Noble. Serious. Even though it's not open.
It opens at 10, folks.
But it's like it's like an iPhone. It's like going to be like when Tim Cook. You should show up at the big one. It's like when Tim Cook. Stephanie, thank you. Sorry.
Thanks, Joe.
Oh, no, you're not. All right. Sorry. It was a long. We had a long talk.
You got a word in edgewise.
Yeah, you got a word.
Stephanie, thank you. Let's take a look at the futures this morning. We are in the red. Dow futures off by more than 250 points. NASDAQ futures now down by about 325 points. S&P futures down by 65. So you are seeing some continued volatility for sure. Friday, we saw the biggest declines we've seen since back to April for most of the major averages. Yesterday, the S&P 500 and the NASDAQ had their best days since May. But now you're seeing the other side of that this morning. Let's get down to Dom Chu. He's got a look at this morning's pre-market movers. Dom, what are the big pressure points when it comes to the major averages?
Sure. Becky, Joe, Andrew, first of all, I want to say I hope because of my work on this show, I got the inside track on a signed copy of 1929.
Yes, you do, sir.
From Andrew.
Coming your way.
All right. Appreciate that. All right. So to Becky's point, let's talk a little bit about the kind of push and pull that's happening right now in the markets right now. We do know things are predominantly to the downside. Meanwhile, what you have right now are ARM holdings on the chip side of things moving to the higher to by 2.5% at this point. This is a report from The Information that is working with OpenAI to develop custom CPUs as part of its 10 gigawatt deal with Broadcom that was announced yesterday. It is just the latest collaboration relationship for OpenAI, who announced that 6 gigawatt deal with AMD last week. So the chip ecosystem with AI continues. ARM holdings up 2% this morning. Meantime, Polaris is surging after separating its Indian motorcycle into a standalone business and then selling a majority stake in that company to private equity firm Carolwood LP. Now, Polaris says the deal will add to its annualized EPS, its earnings, by about $1. It's going to retain a small stake in the spun-off Indian motorcycle business. So Polaris shares are up 10%, due in large part to that bit of news. And DoorDash shares are moving higher after JP Morgan resumed coverage of the stock at an overweight rating. Its prior rating was neutral. JP Morgan says they're bullish on DoorDash's recent acquisition of UK-based delivery service Deliveroo. Its target of $325 a share is well above the street average of around $302 from data from FactSet. So keep an eye on DoorDash shares, up 1/3%. Now, for more on that and other top analyst calls of the day, subscribers can head over to cnbc.com/pro for more of the detail and context around those big upgrades and downgrades, Becky. So amidst the sea of red that we're seeing right now with trade tensions and everything else, there are a handful of green specks out there. I'll send things back over to you.
Yeah, you have to mine pretty hard for those today. Thank you, Dom.
You got it.
All right, when we come back, the buying frenzy around rare earth miners, from tariff threats to public and private investments. We're going to take a look at why the sector may have more room to run and what we can actually do about this from a national perspective. Squawk Box will be right back. Welcome back, everybody. Shares of U.S. rare earth miners jumped yesterday and have been on the move for the past month. The sector getting an initial boost after President Trump threatened tariffs on China, and JPMorgan Chase yesterday released a $1.5 trillion plan, including up to $10 billion for critical mineral investments. Yesterday on Squawk Box, Wharton's Jeremy Siegel told us that, in his words, it is scandalous that the United States doesn't have a rare earths reserve. Joining us right now is Ben Emmons. He is FedWatch Advisors founder and CIO. And Ben, right about the time Jeremy was saying that, I was reading through a note that you put out yesterday that really shed a lot of light on how we got to this position and some of the roadblocks that would need to be removed before we can fix it. I was hoping you could kind of walk us through that. Thank you for being here this morning.
Absolutely, Becky. Thank you for having me, and good morning. Well, you know, we had rare earth mining in 2002 in the mountain passes that, you know, let's say the only mine really active at that time. And China was already producing a fair bit of rare earths and was dumping it out there on the global market. So the price of rare earth mining went down significantly, put that mine out of business. And so we stopped doing this rare earth mining altogether. And I think if you look back at that decision, obviously there was a very strategic mistake, if you will, because today we're dealing with a shortage of rare earths that we critically need, particularly for military equipment. So if you kind of walk forward now from where we are today, the US maybe produces about 1 or 2% of the actual amount of rare earths that it would need to match what China produces today, which is about 270,000 metric tons annually. And then importantly from that is actually what they call the heavy rare earths, which are needed for military equipment. Now, that we don't have any kind of capacity in the United States to get that out of the ground. Not only that, but we actually don't have it in the United States.
Yeah, we don't geologically have it in the United States, was what really caught my attention. That we stopped doing this because China was dumping it in our markets, and it was no longer, from a capitalist point of view, something that was worth pursuing. We don't have a national policy the way China's centrally run government does. So we got caught off guards by that. But even if we wanted to ramp things up, we don't geologically have the heavy rare earths, and those are the things that are important for defense. So what do we do about that? What are the options?
Well, maybe a few. Now, as we don't have it here, then we have to go elsewhere. So Greenland has been a focus because that holds about 38.5 million of unexplored heavy rare earth deposits. And you know, the White House has put out some ideas about this compact of free association with sort of a special status agreement that they could perhaps go to Greenland without taking its sovereignty, and then in exchange with Denmark for some infrastructure investment, start doing this rare earth mining, exploration. But as you say, it takes really time to actually get that sufficiently out of the ground. The estimates are anywhere from 7 to 10 years to have a mine fully operational and to produce what we actually need. So we're going to be reliant on Chinese rare earth minerals for quite some time.
Yeah, there is a Defense Act, under the National Defense Authorization Act. The United States has to eliminate Chinese-sourced rare earths from all defense magnets by January 1st of 2027. How long does it take to find another source for that? Are we going to be able to do that?
I'm not sure we actually will, Becky. I'm afraid that this is kind of a difficult situation. You sort of analyze the data, right? It's like they want to remove it by 2027, yet it's drastically needed because the Pentagon has stockpiled some of this. But by estimates, it's running out by sometime around that time, 2027, 2028. And so you're going to have to go to Greenland and mine it there. And as I mentioned, it takes a long time. Otherwise, you're going to have to buy it in from other countries. And China is the main producer. And there's not any other country out there that produces it the same magnitude as China does. They're readily available. And so this is, I think, an alarming situation. Obviously, it's got the attention from the administration, takes the stake into one of the rare earth companies, but that's not sufficient. That's more for the private sector. For the military, it's a different story.
Yeah, so the investments we've seen from the U.S. government to this point are one thing. What did you think of JPMorgan's announcement yesterday that they'd be willing to make significant investments in this as well?
It was somewhat surprising because you would think this is really an administration initiative because it's for national security. So JP Morgan sees, I guess, a commercial opportunity here, in addition to support to the country, I presume, but it is actually a more private, initiative to gain, because, you don't invest without making return on it. So for JP Morgan, this is I guess they see a capital investment opportunity here. But even though they do this, it's an interesting story, but it doesn't really take away the issue we were discussing, that you may get these lighter earth minerals out of the ground and help the EV sector or the auto sector, or maybe some other industries, but I think you still deal with the shortfall for the military, and I think this is the real bottleneck. Unless we find other sort of types of technology to get it faster out of the ground, which is, again, very daunting. It seems to be really challenging compared to, let's say, to mine gold today. It's a much easier way to mine, but there's a lot less available of it. So rare earth minerals, by the way, is actually abundance in supply. There's a fair bit of out there in the globe, in Vietnam and Ukraine and Argentina. There's also pockets there, but it takes a long time to get it out of the ground.
Yeah, Ben, thank you. It was very enlightening to read your note yesterday. We do appreciate your coming on today.
Thank you, Becky.
Coming up, did you check your Oura Ring stats this morning? The wearable tech company raising more money in its latest funding round, lifting its valuation in a big way. Oura CEO Tom Hale is going to join us for a first on CNBC interview. My readiness reading is not very high, folks. We'll discuss that in just a bit. To 73, which would get me a C, I think.
Goldman Sachs releasing its quarterly results. Guess who? Leslie's back. She's got that report too. This is like an absolute marathon and a sprint rolled into one for you today, Les.
It is. It only happens once every 3 months, so we power through. But you're right, Becky. Goldman Sachs out with its report. Significant beats here on the top and bottom lines. Revenue grew 11% in the third quarter to $14.1 billion. That's thanks to sizable gains in the firm's global banking and markets business. Fees Goldman generated from advising on mergers and acquisitions were up 60%. That's 60% year over year. Revenue from equity underwriting and debt underwriting gained 21% and 30% respectively. Fixed income, currencies, and commodities trading also saw significant gains thanks to trading around interest rate products, mortgages, and commodities. The firm said its investment banking fees backlog was essentially changed quarter over quarter. Goldman has been building its asset and wealth management division, which generated a record quarter for both management fees and private banking and lending, and that division's revenue gained 17% in the quarter. With Goldman's better operating performance, though, comes higher costs, which did miss analyst expectations for both compensation and non-comp expenses. Part of the reason non-comp was higher, though, was due to charitable contributions, which appears to have been moved up to the third quarter this year, where it's typically toward the end of the year. Chairman and CEO David Solomon noting in the release that, quote, longer term, we are prioritizing the need to operate more efficiently to seamlessly deliver the firm to our clients, helped by new AI technologies. Goldman is the best performer year to date of the big six U.S. banks, up 37% going into today's print, and appears to be moving higher from there, about 0.5% right now, guys.
Every 3 months now.
Right.
I'm going to give you the option. Do we go? If I'm Trump, or I'm regular. Are we going to go to 6 months, or do you want to stay with 3? What would you rather do?
I gotta admit, Joe, I kind of like going through the weeds, as you mentioned. I like going through the numbers and all the things. I like the 3 months, but that's just
Well, okay. How about every month?
Every month. Well,
How about every day?
I don't know about every month, but
All right. But you stick with quarterly. Okay.
well, I mean, just it's fun to get these snapshots and see what's going on.
It is.
I feel like every 6 months, so much changes that always feel like I'm missing something.
I would think the same thing. I'm kind of a fan of the 3 months.
Yeah.
I agree with the too much emphasis on short-time management, but you can correct that, and what Jamie Dimon and Warren Buffett wrote about, suggesting that is just give us stop giving us earnings guidance, stop guiding us and kind of leading us around by the nose, because that's what's really hard. How can you predict what's going to happen over the next 3 months, 6 months, 9 months?
Well, you can't beat expectations every quarter if you don't guide people lower, right?
But you don't need to be spoon-fed.
Huh?
Here's what's going to happen in the next year to the penny.
Or just update when you have something to say.
Right. Don't you think there's going to be some companies that would then be updating every month?
Yeah, some do.
I mean, I think some are. I think if you take away the rules, some will do it twice a year, and then others will do it like all the time and try to create these almost like marketing moments for the
We used to get monthly sales from all the retailers, and we would look at them very closely, and then when a retailer would pull back and say, we're only going to do this quarterly, everybody said, oh, it's because they have lousy numbers.
Well, but that's the thing. We love when a CEO comes on our broadcast, rain or shine.
Yep.
Right?
Yep.
And that's very valuable, the rain or shine piece.
And we appreciate the people who stand up
And
and
what
talk
will
about
happen,
that.
or could happen, is you get announcements twice a year, but then you get like only announcements when things are good otherwise, or other sort of strange things.
Yeah, I don't love it. I know there's a lot of regulation. It's hard to go through all of these things, but you kind of need to tell your investors what's happening on a quarterly basis. Anyway, Leslie, thank you. I think we're going to keep it for 3 months for now.
I'll mark my calendar.
Okay, sounds like a plan.
Okay, here we go. I told you my readiness score was a 73.
What is it normally?
I like to be in the 80s. Oh, today I'm better than that, 76, but still not great. We'll see what this guy's readiness score is. This morning, wearable tech company Aura announcing a $900 million Series E funding round, bringing its valuation to $11 billion. We watched this company's valuation rise now for many, many years. Joining us now first on CNBC is Tom Hale. He is the CEO of Aura. Of course, they make the wearable rings, and we always discuss how good or bad people's readiness is in the morning. So, Tom, $11 billion. When you got there, what was it?
My readiness score today is 80. And
Okay.
if I thought about the day that we actually closed all the arrangements, I guess my readiness was about 11 billion.
11 billion. Okay. No. But when you first got to Aura, what was the valuation of the company?
It was about 2.5 billion. So that was about 3.5 years ago.
Wow. And so, look, one of the big questions that I imagine people are going to ask is, this is still a private entity. At what point do you say to yourself, you want to be a public company?
You know, we want to focus on our customers. We want to continue investing in innovation. I think we're very happy to be a private company right now. We don't have to report earnings monthly or quarterly or every 6 months. But at the end of the day, I think we want to be ready to go public when the time is right. But we've got some work to do before we get there.
When you say you got work to do, what kind of work?
You know, we're scaling the business so fast and adding new employees, new business, expanding internationally, introducing new products. I think we just want to stay focused on that and not let the distraction of being a public company affect what we can do for our customers. Our mission is to improve human health, and that's where we want to spend our time and energy.
So this is an emerging space. There are a whole bunch of competitors. You do it, I would argue, best on the finger as a ring. There's the Whoop. Apple's got the watch. Samsung and others have other devices. Garmin's now in it. So many people are trying to play in this space. How do you see the competition over time?
You know, what's interesting is I think every American should have a wearable. It's part and parcel of living a healthy lifestyle and fostering healthy behaviors. Honestly, we know that the ring is the most accurate, and that measuring from the finger is the best place to measure for long-term health management and health measurement. But anyway, if you can understand that everyone should have a wearable, I think we're supportive of that. Now, that being said, with this money that we've raised, I think we're going to head towards investing more and more in AI features and more in healthcare and more in international expansion. We think we can cover the world and put a ring on any of your fingers. We've only sold 5.5 million in the last 10 years of the company's life. We think we'll sell another 5 in the next year. This category is exploding, and mostly what's interesting is that we're growing roughly twice as fast as we have been in the past, and we're gonna continue to gain share from other wearables. And I think that's just a function of the ring being comfortable, being attractive. This is our new ceramic model. People like to have expression with their wearable, and also that we're going to see expansion as the healthcare market and the healthcare industry adjusts to the reality of everybody having a wearable.
In terms of the economics of the business, what kind of margin do you get off of the device itself versus what really is become a services business, because you charge a monthly fee for most users of the ring? Tom probably doesn't like me as a customer because some of the if you were an original owner of the ring,
grandfathered in?
they didn't charge back in the day, and you got grandfathered in. And so I don't know what percentage of your business, Tom, is some of the OGs that started wearing these things many years ago.
Andrew, we celebrate you as a customer, and we're so happy that you get to pursue your health pursuits without having to pay a subscription. That being said, we are a subscription business with a significant portion of our revenues. Our margins, as a result, are better than best in class for hardware companies by a country mile. We do make a real investment in the product on an ongoing basis. So every month we're shipping new features, shipping new capabilities. We just introduced last week the ability for you to have multiple rings on the same account, so you can switch between your ceramic ring or your metal ring or your daily driver, your workout ring, and make that really easy. We introduced new blood biomarkers. So we're going to continue to invest in the product so that every month you're getting new value. And that's the difference with our model. If you think about most hardware companies, that's kind of a ship it once, pay for it once kind of model. And for us, the ongoing value that we deliver supports an ongoing subscription membership fee, which really is an investment in your health.
How far are we away? And I know, look, now you can obviously put the what do you call it, devices on, like a Dexcom kind of device in your arm to figure out what's going on with people. But how far are we away from being able to measure a lot of things without actually having to prick us?
You know,
what else is out there?
Well, there's lots of interesting technologies around non-invasive monitoring, and we're starting to see new technologies that are on the workbench right now that are not ready for prime time. The one that everyone has always been after is a continuous glucose monitoring and measurement. That's very difficult, not just to achieve, but to do it at a level of accuracy. Obviously, if you are measuring your glucose for insulin, if you have diabetes, it's a life and death kind of situation. You want to be extremely careful. So the bar is very high, but there are additional sensing modalities. There's electrodermic activity. There's people who are working on near-infrared lasers. There's people who are working on Raman spectroscopy. These are all new techniques that I think in the next 5 to 10 years we're going to see arriving on various wearables, and it's going to unlock, I think, new dimensions of health.
Hey, Tom, great to see you.
Becky.
I mean, I'm always attracted and drawn into these things, but then I wonder if I'm getting too freaked out by too many things. There's so many things you can do, whether it's like to poop in a box and send away to find out what's in your biome, or to get your blood tested to find out if you have 96 different types of cancer. Are there any of these things that you think are a step too far or just aren't ready for prime time?
Well, there certainly are a raft of wearables or tests that are not FDA regulated, that are not cleared or approved. We are not either. We've always made a promise of being clinically accurate. However, I do think that more information is a general good, even if it's just to remove fear. But the reality is that what we're trying to do is to change your behaviors. We're not trying to kind of like get you to be obsessed about your scores, even though I know Andrew is obsessed with his. What we want you to be able to do is to be able to change your behavior for the better, because the way to live a healthy, long life is to make sure you're doing the basics, to sleep well, to eat well, to make sure you're watching and getting exercise, make sure that you're surrounding yourself with people who give you some kind of uplift as opposed to stress. Those kinds of basics. They're fostered by healthy habits, and having something that's sort of in the background, think of it like a guardian angel. We're not there to kind of like constantly interrupt you with all sorts of information. We're there to sort of help you feel better. I'll give you an example. Just a couple days ago, I'm traveling a lot. I got a notification saying that I was getting sick, and I took about a day off to rest. I just, drank a lot of tea, a lot of water. I recovered really nicely, and I didn't end up getting sick. And I think that kind of like insight about your body, that these kinds of devices can give you a perspective view of your health, and you can modify your behaviors as a result and have an outcome. I think that's really powerful.
So Tom, just to follow on your story, I don't know if you remember, we were all sick. You weren't sick, but Joe and I were sick.
Yeah, I was sick before, but I didn't have
2 days before I was sick, Tom, the ring actually said you have major signs.
You didn't modify your schedule.
And
That's why you got sick.
And I didn't, Tom. I woke up and I thought, oh, I feel fine. What's it saying? It doesn't. And I was looking through the numbers and I was like, my heart rate wasn't that much higher. What does it know that I don't know? I was like, maybe it was just a blip, like it didn't get it. And then 24 hours later.
You were traveling that entire time.
I was traveling. I worked out that day. Anyway, dum-dum.
I mean,
Tom, thank you.
The body doesn't lie. The body doesn't lie.
You can tell that the immune system is important, and if you're tired, you're exposed to like these viruses and testing it all the time, and most of the time it doesn't get you unless it gets season opening. Can you improve your, like, let's say you get this crappy rating, you're 75.
Yeah.
Can you like do exercise or something and get is that the only way? So if you get up in the morning, you can't get it. You can't like do push-ups or something, get it above 8.
Makes it worse. Andrew's right.
Yeah, I think you're not supposed to do anything. I think if it comes up as your reading is not good, the sleep.
Okay.
And hydrate.
The poop in a box, what is that, for colon cancer or something?
I've never done it, but you can get like your gut biome.
Yeah.
You don't see these ads.
Do you remember the Justin Timberlake SNL?
That was a different thing in a box.
That was a different thing. Hey, Tom, thank you for joining us. Sorry, we've gone a little off the rails here, but we appreciate it.
Right away,
Nice to see
Tom.
you.
Very much.
Hi.
Yeah, it's great.
Oh yeah, that's right. Right now I remember. Senate is expected to hold another vote today in an effort to end the 14-day. That was pretty funny. That skit. No, the government shutdown. Emily Wilkins joins us now with the latest. Good morning, Emily.
Good Good morning, Joe. Yeah, the Senate returns to D.C. today. They're trying to find some way forward to end this government shutdown. The votes we're going to see today, they're going to be the first since the White House fired more than 4,000 federal employees. Oh, that was on Friday, with cuts going across the government, including at a key agency helping tech companies with cybersecurity. But the Trump administration also alleviated some of the major pain points that we were expecting to see this week. And that means that the standoff between the parties is likely going to continue. Now, Trump announced over the weekend that the military, our troops, will be getting their paycheck, and that a food assistance program for low-income women and children will also get a boost of funds. Meanwhile, House Republican leaders have yet again canceled votes in that chamber, in part to keep the pressure on the Senate. And while you have seen a small handful of Republicans publicly say they want to be back in D.C. doing legislation, Speaker Mike Johnson is holding firm.
I've heard a criticism from, I think, 3 members on our conference call, and since our conference calls leak and they're always spun, that's the fact. You can poll individual House Republicans, maybe you should, and 98.7% of them will tell you that this is the right thing.
The House hasn't been in since September 19th and likely won't be back until the shutdown is done. Guys will be keeping any eye out for any movement today, but at this point, we're not expecting much of a change from what we saw today on Capitol Hill versus what we saw last Thursday, which was the last time they took a vote and failed to reopen the government. Guys?
Okay, thank you, Emily. Joining us now with more on the impact of the shutdown, Olivia Cantrill, PIMCO, head of U.S. Public Policy. We could go down a list of things to talk about. I guess the latest I saw was that President Trump said some of these agencies are not coming back. If Democrats take a note of the possible negative effects on them from keeping it closed?
Yeah, I mean, I think that just in general, both sides think that they have a winning hand here, and our expectation is that the government may stay shut down at least until November. We may actually go into Thanksgiving with a government shutdown. Republicans have, rightly said that they have passed a funding bill that historically Democrats have supported, a clean funding bill at current levels. Democrats, however, obviously have been sort of in the wilderness, have had a hard time coalescing around an issue, have had a hard time sort of resonating with their base, and they believe this is a political winner by drawing attention to the expiring ACA subsidies.
When Congressman Lawler walked up to Leader Jeffries and said, here's a 1-year extension of exactly what you want. Will you sign on to that and reopen the government? And he didn't say yes. Could they do that? Was that an actual offer to Leader Jim?
I mean, my view is whatever happens in the Senate is the most important indicator. I think that the House is a little perfunctory right now. Obviously, the House is gone. Yeah. And the fact that the House is likely to be gone at least until next week shows you that this government shutdown is going to be much more long-lasting than people expected.
Why? The Senate could vote on it today if they got 5 more Democrats.
Yeah, and I think what Leader Thune has said is that may not be such a simple vote for Republicans in the Senate. I think this is the issue, is that this is not just about government funding. This is about Obamacare and about this extension of these expiring subsidies. And many Republicans historically have not supported either. And so this is not something that is going to be super straightforward for the Republican leaders in order to get passed. So this is why, again, kind of all signs are pointing to, from a markets perspective, all signs are pointing to a much more prolonged shutdown than what people expected, and that obviously has then nonlinear economic impacts the longer this lasts.
So the Senate soon might not be able to promise that we'll do something with the subsidies, because he might not have the support with
Yes, and this needs 60 votes, both the funding of the government, but also the ACA subsidies. And so this is, again, this is not going to be straightforward. We've been, sort of warning our clients into the, before even the fall and the summer, that should the government shut down, there was no sort of natural catalyst for it to reopen, and that is proving correct. Now, again, I think the market is sort of shrugging this off. This is not a big deal, but our view is that the longer this occurs, the more that you have 1.5 million people not getting paid,
Well, the military.
CPI data collections not
Yeah,
happening. I mean,
right.
this starts to actually have an economic.
Should
effect.
Trump have found a way to, the president have found a way to pay the military, or if they weren't getting paid, would that put more pressure on Democrats to come to the table?
I think he just made the calculus that it's better to not play politics with
the military.
with the military. Probably a good political choice as well. But yeah, I think that's probably what the calculus is. I think there's some questions about, can he actually reappropriate some of this tariff money to pay for this food, supplemental nutrition program? I think there's, maybe some questions about that. Again, is anyone going to litigate that? You can't just
take longer to litigate it than hopefully it'll take the government to reopen.
Well, yes, I know, and we're not trying to be Chicken Little here, but again, they're just, the political incentives are such that both sides are quite dug in, and that's pointing to again a much longer.
Okay, so let's talk about that. The assumption that the government was going to reopen is one that we've all been victim to, that we've all kind of played along with.
Yeah.
You saw things otherwise. But the assumption that something would get done with the healthcare vouchers was also something that people are making. You think that's not the case? Because those two things are both.
Well, I think
headwinds.
I think any sort of resolution to this is going to require some sort of compromise on healthcare. It's just a question of how long it takes to get there. And maybe it is just a 1-year extension. Again, I would sort of discount what the folks in the House are saying. I think that all of the action is going to be in the Senate. And the Senate is back in session. The House is not back in session. So again, it's not to say that this is completely out of touch or out of reach here, but again, it seems like it's going to take
Andrew,
longer to actually get it.
when is that No Kings rally? That's coming. Is it?
I don't have it on my calendar.
It's not.
I'm not sure when
I believe
that's
it's.
happening.
I believe I know. I think it's Sunday.
Is it Sunday?
And I think it's. Is it?
Getting ready
this weekend?
Yeah, exactly. No, I was kidding. That was funny though, right? Kind of funny.
Kind of funny.
But again, I think
Is there something to it that Schumer and others don't want those people coming into town if they've caved? And they want, because you said
yes. I mean, yes, Joe.
What do you mean?
You know better than I do.
No, I know. So this is, this is a softball?
totally.
You said they're in the wilderness and they're waiting for these left crazies to come in and to be able to say, we're standing up.
Those are your words, not mine. I think
You already said that they're in the wilderness and it's all political.
Well, I mean, I think that look, there is still obviously a lot of debate within the Democratic Party about the loss in November and what was the catalyst last November. So this is the one kind of issue that voters really care about. If you look at the sort of the top issues that voters actually vote on, healthcare is always in the top 3. So they are sort of making the political calculus that even though it's inconvenient for the government to shut down, and again, I think as a markets practitioner, we're just worried about these sort of non-linear effects, both in terms of data collection, in terms of consumption behavior. Also, you're already having some headwinds to the economy going into the end of this year.
It's not good to have all those videos of the same Democrats talking about they would never, if Republicans shut down the government for this, it's the worst, they're the worst human beings on the planet for what they're doing to the government. No one's going to fix health care in the next week.
In 3 weeks. Yeah,
you need to get the government open, and then, I'm sorry, then, Republicans are in charge. Then you got to work with the other party. I'm sorry.
And Joe, as you know,
it's a big, mean world out there.
On how things are, not how they should be. I mean, I think that this is intractable. And as a result, pointing to a longer shutdown.
I think it's like, I actually looked it up, I can't remember, it starts at a specific place. It's in a lot of different cities, but in DC it starts at a specific place at a specific time. I believe it's Sunday, because I looked it up just in case you ask me when I'm going.
When you're going.
When I'm going. Libby, thank you.
You got your posters and your markers and all the things you're gonna.
I got my pink hat that I'm gonna put on.
Wow.
Whatever. Yeah.
What else you got?
Poop in a box.
Wow. She shows up big for Squawk Box. Now we know.
Poop in a box.
Now we know.
Poop in a box to throw.
Here we go.
Like a monkey, yeah.
Thank you for playing along.
At the zoo.
We got so much more coming up on Squawk Box. Another big deal between OpenAI and a chip maker. This time it's Broadcom. We're going to talk to an analyst about the sector next. And later, former economic advisor to President Biden, Jared Bernstein, is going to tell us why he is calling AI the third bubble of the century. He joins us at 8:30 a.m. Eastern Time this morning.
The book 1929 is out today, and I already had my copy. I guess I got an advance copy.
You got an advance copy.
I got an advance copy. It's not signed.
I'm going to get you a signed copy.
Oh, yours was.
I have mine. You can just sign it.
I can sign it. I want to thank you.
I
Can I just thank you just for your support of this whole thing? And the truth is, you know, I kept you in the dark about this project.
I know.
Oh, not for
like
that long.
about 7 years, maybe
I thought it was
last
10
year.
almost, yeah.
I worked on it for about 8 years, and I didn't want to tell you that I was
Well, I
working
kept
on
asking
this.
about the TBTF2.
I know, but to be honest with you, when I first started this, I didn't know if I'd finish it. I didn't know if I'd be able to get the material that I wanted to get. I mean, I was trying in my own way to write the prequel to Too Big to Fail, and I wanted that kind of detail, and I would travel all over the country.
It's kind of a prequel to that.
It's written, I mean, the goal was to try to bring you inside the room of 1929, because most, I mean, I think
And no one's
we all,
ever done that, which is
we all
weird.
have this general conception something terrible happened in 1929,
Right.
and people like, look, Kenneth Galbraith wrote a brilliant book. He was an economist.
Yep.
There's a whole bunch of people who have made different types of efforts in the 30s and the 40s. There's a good book that was written in the 70s, but I went on vacation years ago with my wife, like a real nerd, and downloaded all these books to my Kindle, and sort of left thinking, I want to know more about these people and what's really happening here. And I don't think I told you what happened, but I was up at Harvard giving a speech, and I got there early, and I'm always late for everything, as you know. But I was there early, so I had all this time to burn, and I went into the Baker Library and asked the archivist if I could look through these documents about Thomas Lamont. Tom Lamont was the guy who ran J.P. Morgan, and she brings me these boxes. I open up the boxes, and inside these boxes are transcripts that Tom Lamont had, that his secretary was keeping, of his conversations with Hoover and Roosevelt. And you could actually see them talking to each other, literally like what they were, and I thought, okay, that's, by the way, what I needed for Too Big to Fail to work, that kind of thing. But back then I could interview the people. And she said to me, Andrew, you can't write this book. This is not really going to work out for you. I read Too Big to Fail. You're not going to be able to get the granular detail. And she was right in
The
that.
librarians said?
That's what the archivist said. That's what the librarian said to me. She said, I read your book. You can't. It's not going to work out for you. And it was almost like a personal challenge when she said that to me, because she was right. There wasn't like 3 or 4 or 5 sort of major archives that I think most historians would. You go and you excavate the archive. It was like a sort of a puzzle piece situation where you had to go. Oftentimes you'd have to think to yourself, okay, there's this great character, Charlie Mitchell, who runs National City, which becomes Citigroup. There is no archive. There are no diaries of his. They don't exist. And so you'd have to say to yourself, who would he have been corresponding with? Who would have been in his orbit? And then you'd have to go to their archives.
See the letters.
And pray to God that there was some letters or other materials from these people. But it really, that was what I was trying to do the whole time. And I would do it on weekends and nights.
Who was he corresponding with? What was your best treasure trove with Mitchell?
With Charlie Mitchell, actually, the best treasure trove turned out to be depositions that were taken during a civil case. So that was the other thing. I made a great mistake in this project. Early on, I was looking at just stuff from 1929, maybe 1930, 1931. You realize, actually, that you had to go and find materials even into the 1950s or 60s, because some people had done oral histories that were in places I didn't even know existed. There was all sorts of like material that sort of like came out later.
But a deposition from a lawsuit that came later, a civil lawsuit.
A civil lawsuit. There was criminal cases, you know. So all sorts of, and by the way, then you'd see the interview. They'd interview his wife. They'd interview him. They'd say, "Where were you when this happened? What did you say? What did you say to your wife?" And then they'd interview the wife, and the wife would say, "This is what I said to him." And then all of a sudden you go, "Okay, I have a scene."
Right.
And it's this really interesting story, not just of Wall Street, it's also Washington, because it's actually almost pits Charlie Mitchell against a guy who you all probably know, Carter Glass, who ultimately breaks up the banks. Carter Glass was a senator in Virginia at the time. He was the Elizabeth Warren of his time. And he would rail about this thing called Mitchellism and how he thought that Charlie Mitchell was going to ruin America because of debt and credit and the leverage in the system. So
Congratulations on finishing this, but having the vision to go do this and the tenacity to drag out all these details.
Thank you.
And then do it in such a beautiful manner.
Too Big to Fail became a movie.
It did. I think we'll see.
Is that the right
Could it be a movie? I mean, there have been people.
Limited series type.
We've had a couple literally in the past couple weeks. There's been a whole bunch of people who've approached us about different kinds of things. Maybe you can make a movie. Maybe
something that happened that long ago. It's you're bringing it back out, and it hasn't really. It needed to be done. I think that's what you thought anyway on a personal.
That was my hope, and I hope that by the way, that when people read it. I'm not trying to say there's a crash coming at all, but there are these sort of eerie parallels between things, and I do think there's some lessons embedded, and I try not to do it with a strong hand. I just try to tell you the story, and then hopefully you can see it. But if you're a nerd, you might like it because there's lots of endnotes, and hopefully if you like it as a beach read, it's a thriller too. So
it's a thriller. But we know
even though you know the ending, there's lots of things I think that'll shock you. To be honest, I mean, by the way, you have people killing each other. Not killing each other, but killing themselves. There's affairs happening. All sorts of wild things are taking place. So it's kind of fun.
Jesse Livermore, how did he kill himself? Was that a gun or something, or he jumped?
Sherry Netherland. Fifth Avenue.
Yeah.
Walks into the Sherry Netherland to the cloakroom.
Yeah.
Giving away the ending of the book here.
Yeah, don't do that. But is there anything like the opening scene in Billions?
Is there anything like no.
We're back to in a box again?
No, you brought it up.
No.
You're talking about when the guy's peeing on the...
No, I will say this.
On the cigar?
My kids noticed that in Too Big to Fail, there's a lot of F words and cursing.
Yeah.
And they said, Dad, is there cursing in this book? And I said, no, and I hadn't thought about it. And I realized that because they were writing letters, no, but I think they probably did curse just as much. But they didn't put it in their letters and memos and notes and diaries.
Do we have all the same curse words?
That's a good question. They smoked a lot of cigarettes.
Yeah.
A lot of cigarettes.
Oh, great. The actors will love being in this. They still love smoking in those movies. I think they're clove cigarette.
Anyway, the book is out today. It's 1929.
Thank you.
You should get your copy quickly. Citi just reporting earnings. Leslie Picker joins us right now with more on that. Hi, Leslie.
Hey, Becky. Yeah, Citigroup beating on the top line with all 5 divisions posting a record third quarter. Revenue overall up 9% to $22.1 billion. As for the individual units, banking, which houses investment banking and corporate banking, the biggest grower in the quarter with revenue up 34%. Markets comprising sales, trading, and financing was the highest earner, generating $5.6 billion in Q3. The other 3 divisions, services, wealth, and U.S. personal banking, each grew 7 or 8% in the quarter. Net interest income, the profitability metric from loan making, was up 12% and beating estimates by about $500 million. I think that's why you can see shares up about 1% on these results. Credit costs were $2.5 billion, largely due to losses in U.S. cards and a small firm-wide allowance for credit losses. Now, we're not comparing EPS at the moment. There's this impact of a goodwill impairment charge related to the selling of a minority stake of Banamex, a step toward a full divestiture of the Mexican subsidiary. Citi recently rejected a bid for the business by Grupo Mexico. The non-cash charge didn't impact capital, but it did boost expenses by 9%. So excluding that one-time item, expenses were up by about 3% for Citi due to some higher compensation and the impact of a weaker dollar. Now, Citi shares were up more than 36% year to date, second best performer among the 6 U.S. banks, the largest 6 U.S. banks going into today's print and moving higher in pre-market trading, guys.
All right, Leslie, how many are we down now? Is that 3?
Hey, what do we got?
4 down.
4 down.
2 to go. We're done for the morning.
How many do we have for the rest of the week, Leslie, after we do this?
Well, 2 more for the big banks, plus a few regionals. BNY reports on Thursday. So it just depends on exactly how many you guys want to break out. I'm here for it all.
Better you than us. Thank you, Leslie.
All right, let's check the futures this morning, which have been under some pressure, but I think we're off the lows a little bit, but still quite a bit of pressure with the NASDAQ down almost 300, bigger percentage loss than you're seeing in the Dow, which is also down, S&P down 60 points or so. Treasuries, the 10-year did not, at this point, it was 4.005. Now it's up a little bit from there in yield. That is, so holding above that 4% level. And then energy, we saw 57 for a while. It's 58.35 now on WTI. Gold was, I think, above 4,100, still is.
Yeah, it's almost 41.50.
Almost, in silver, all-time high, eclipsing the Hunt Brothers high of 1980. Let's get to Dom Chu. Oh, crypto, you can see is weak. Really pretty weak. 111,000 now in Bitcoin. Dom Chu has a look at this morning's pre-market movers. Say, Dom.
All right, so Joe, Becky, Andrew, we're going to start off with shares of Domino's Pizza, which are moving higher after a beat across the board for its quarterly results. Strong U.S. performance was a bigger boost there. Comparable store sales in the U.S. came in well above estimates as well. That helped really set slightly weaker than expected same-store growth abroad in terms of counterbalance overall. So Domino's Pizza on balance up 3.5% on that bit of news. Albertsons, another earnings winner, after announcing slightly better than expected revenues in its second quarter and increasing its profit outlook. Digital sales were up 23% for the grocery giant. Albertsons also announced an additional $750 million share buyback authorization, increasing its prior authorization to $2.75 billion from $2 billion. So Albertsons shares up 6.5%. And General Motors shares falling this morning after a filing it made in an SEC filing revealed in its third quarter profit report coming up next week. It will include a $1.6 billion impact as part of a reassessment of its electric vehicle business following changes in tax credits and difficulties in the EV markets overall. It further said that the reassessment is ongoing, which could mean possible additional impacts in the future. So those filings and everything around that sending General Motors shares down by roughly 3% in the pre-market trade. Joe, I'll send things back over to you guys.
Okay, Dom, thanks. Chip stocks, meanwhile, giving back some of yesterday's gains. The sector moved higher after OpenAI and Broadcom announced a custom chip deal, and Broadcom was sharply higher, but it's down today. In the last few minutes, Oracle announcing it's going to deploy 50,000 graphics processors from AMD starting in the second half of 2026. Joining us now, Stacy Raskin, in Bernstein U.S. Semiconductor Managing Director and a senior analyst. And I don't know if you were ever wondering why'd I get into this this area of finance, but God, the last couple of years, this is where it's at, Stacy. It's hard to even keep track. It's been
unbelievable. It's certainly been a ride.
I mean, it used to be. You remember memory? It used to bore you to death. I guess there were those, we used to call them field FPGAs, field programmable Gatorade, we called it, where you could pick orange.
Yeah.
You could get grape if you wanted, if you're out on the field. But they were gate arrays. Then graphics chips and CPUs, but now AI changed everything. And I don't even know, I mean, I need to go back to school to really understand it. Did you do that? Some remedial work?
Well, you know, it's... My graduate work in semis is probably 20 years out of date at this point, but we've been here and there on it, yeah.
So AMD eclipses Intel. Intel's got some government help and maybe inducing some private companies to get involved, or they're public. But I mean, it's how do you navigate it at this point? What are your favorites?
Yeah, it's been pretty wild, right? And you're right. We've got winners and losers like massively changing place, and we've got government investment, if you maybe want to call it government interference, but that's there, and a lot of crosstalk between a lot of the companies, especially in the AI ecosystem. There's a lot of cross investments and things like that where it's sort of tying them all together. They'll all sink or swim, I guess, in one piece at some point. In terms of what we like, my general call this year has mostly been own the high quality AI names and ignore most of the rest. And by and large, like that's kind of worked. Like we've liked NVIDIA, we've liked Broadcom. I still think that the AI cycle, I think we're still early. I think it's still got legs, and all of these new deals that we've been seeing announced, they actually, I think, have the effect of extending it even longer. Most of these don't even start to ship until the end of next year. So if you're worried about air pockets or digestion or anything like that, it's clearly not this year. It doesn't seem like it's next year, and if these big projects don't even start to ship until the end of next year, it's probably not 2027 either. I think we've got some runway on this still, so we still like those high quality AI names.
Hey Stacy, we have Jared Bernstein joining us in, I don't know, maybe 20 minutes, and he has an op-ed out that says he thinks it's time to call the third bubble of our century the AI bubble. He says in financial markets, a bubble occurs when the level of investment in an asset becomes persistently detached from the amount of profit that asset could plausibly generate. Why do you think he's wrong?
Well, I mean, it's certainly a concern that people do have. I think there's a few things. I think it really is that question on profitability. There's no question on demand right now, right? Nobody can get enough. That's the one sort of overarching theme that we're hearing from everybody in the space is demand for compute is off the charts. It's not like the tech bubble maybe where, I mean, we have dark fiber sitting in the ground today, from 2000, 2001. Fiber that was installed and never used. Everything is getting used. Like nobody's buying GPUs and sticking them on a shelf in a warehouse somewhere. Like they are all getting deployed and getting used and they can't get enough. So it really is that question on profitability and the revenue that this can drive. And yeah, I guess you could compare it. You could make the argument that the revenue will never be there. At the same time, though, it's still early in this, and you can look at other build-outs. Like you can look at the build-out of AWS back in the days. That required heavy investment, and it wasn't profitable at the first. And nothing's profitable when you're on the early phase of ramp.
OpenAI says it needs at least $1 trillion to invest in data centers that provide the electricity, computing power, and storage in it. But they've only got $13 billion in profits this year, in revenues this year, not in profits.
Yeah. But again, we're early and we're in ramp phase, so that becomes the question: can they actually drive revenue? Is this actually going to be something that is completely ubiquitous, or is it not? And I think time will tell. We'll have to see. I tend to be more on the bullish side of AI. I actually do think the demand is there, and I think there's enough, effort chasing this that we're already seeing evidence, frankly, of at least on the enterprise side of returns. Like it's early, like it's in the experimental phase, but we're seeing evidence on the enterprise side. And then on the hyperscale side, I think there's already getting returns on this. You have to remember the folks that are building this stuff out, and this is one other difference maybe from, say 2000, 2001. The companies that are doing the bulk of the spending are some of the most well-funded and most profitable businesses that humanity has ever developed. And they're not idiots, right? And they can see things that we can't. And they've also got other businesses that are running this stuff through that they're already getting returns on. Google's getting returns on the stuff. Meta's getting returns.
That sounds like it's different this time. Some of the circular financing and some of the companies that are in these weird incestuous relationships with each other where they're each dependent on the other for. It reminds me a little bit. Remember the mergers back in the .com? You would exchange two overpriced cats for one overpriced dog, and none of the stock was real. So none of the valuations were real. I don't know if any of that's similar, but even yesterday, Pat Gelsinger said there's no doubt we're in some type of bubble, not one that's ready to pop, and maybe. I get everyone points to Nvidia's valuation is not anywhere near stratospheric. In terms of the multiple to earnings or sales, it's not so bad.
Maybe. Look, so I'm not sure Gel's ability to speak on this, frankly, but that's neither here nor there. Like we'll
I hear you.
Okay. In terms of some of these like, quote unquote circular range, I mean, look. So the biggie was Nvidia, right? And that $100 billion number kind of raised eyebrows. Remember, it's not $100 billion right away. It's $10 billion. It's actually at first. It's actually stayed with the notes. So I think that's good. And look, like Nvidia doesn't have anything else to do with their cash, right? They're generating hundreds of billions of dollars of free cash flow, right? They can't do M&A. They have a dividend and a buyback, but relative to their market cap, it's tiny. So like I'm hard pressed to think of anything better that they could do with that cash than to grow and support the overall AI ecosystem. And the money's not going into the ether. Like they're getting what will presumably be valuable OpenAI stock. Like I guess at that point. And you have to remember, even with that $100 billion, assuming they deploy it, OpenAI is going to need a lot more money than that. Like they're not going to be the only investors in there by a mile. To me, the AMD one raises a little more eyebrows. AMD actually gave OpenAI, well, they gave them equity, like in return for being allowed to sell them stuff. Although I kind of understand that as well. Like AMD, I mean, look, like Lisa has to be on the OpenAI rocket ship. It really is OpenAI and Altman that's driving a lot of this. And if AMD is not there, they completely lose out. So Lisa had to get on that rocket as any way she could. She bought her ticket. It's working. Like I'm not going to knock them. Like this is going up, but I would read that in some sense in terms of like the relative competitiveness of the products. Like nobody else had to, give up something in return for the privilege of selling to them.
Okay, Stacy, thank you. Good choice. Semiconductors. Good. I'd like to cover like freedom to read. I do. I am, and I do a lot of research.
You are an expert.
I do a lot of research on it. There's a little twisty honey barbecue.
Frito pie.
Frito pie. Yeah. Coming up, breakdown of this week's big geopolitical news, from the peace deal in the Middle East to the president's planned meeting with Ukrainian President Zelensky. That's next. Squawk Box coming right back. Ukrainian President Zelensky expected to join President Trump at the White House later this week for talks on the Russia-Ukraine war. This is after the president's visit to the Middle East and the ceasefire deal between Israel and Hamas. Joining us now to break these issues down, as well as the latest tensions with China, Heritage Foundation National Security and Foreign Policy Vice President Victoria Coates. She served in the first Trump administration as Deputy National Security Advisor, and it's good to see you. Victoria, thanks for joining us.
Great to see you, Jim.
I think initially most people were, or at least the president was focused on Russia and Ukraine, and all of a sudden the Middle East, did it become, I'm not sure what happened exactly. I guess a confluence of different developments with the decline of the proxies and the Israeli war and Fordo and all these things happened, and suddenly is the Russia conflict on the back burner, or is Putin is it impossible to deal with this dictator?
No, I think you're right. I think this is a confluence of events that the president found coming into office in January. He had the Ukraine war, he had the war in Gaza to deal with. Both very difficult problem sets, but as the year has gone on with the Gaza war, he had as you said, the action in Iran, which definitely changed the battlefield. And then, his trip to the Middle East, where he was able to sort of lay the predicate for the diplomacy we saw on display yesterday. So he got to a resolution of that conflict. But I do think these things are related, Joe, in that the momentum behind resolving the Gaza conflict, I think, can help get to a resolution of the Ukraine war. I think at the rest of all these other countries that the president was meeting with yesterday, getting behind conflict resolution, maybe putting some pressure on Putin to come to the table. So this can have a positive effect on Ukraine.
So the Gaza war, I don't know, can we say that's over? Hopefully that's over. But is the war in the Middle East between, I guess, revolving around the existential threat to Israel, is that over? Won't Hamas, someone's going to step up and decide Israel has no right to exist? I just don't, at least in my view, it's been going on for so long, since 1947 or something. And I was mentioning Anwar Sadat and Menachem Begin and all the things that we've seen happen over the years. The switch just doesn't get flipped on this, does it?
Well, it might. So it's 1948, the formation of modern Israel, more than 75 years ago. The thing that's different now is all those countries that the president met with in Egypt yesterday, they're not trying to wipe Israel off the map anymore. They're trying to find a way to make friends with Israel, because Israel really is the powerhouse in the Middle East. It's a thriving democracy, also a thriving economy. And interestingly, even during these 2 years of war, the Israeli stock market is the best performing market in the Middle East. 2 years of war. This is an incredible achievement. So all of those countries would like to make money with Israel. They'd like to have technology sharing with Israel. That's different now. They don't want to destroy Israel, and Hamas is really the outlier now. Nobody particularly cares. The president used the word irrelevant in his speech to the Knesset yesterday, that they just don't matter that much anymore. And if they won't come to the terms that all of these countries and Israel agreed to, that 20-point plan, if they don't get on board with that, no one's going to pay any attention to them, and Israel's just going to go in and mop them up. That's going to be ugly, but that is the option there for Hamas. So I think we might actually see that switch flip.
That's amazing. I mean, it really is that everybody was hoping for it. It just seemed like it would never come. But I guess, and it's happened, like I said, I think I said that yesterday too. Things happen gradually and then all at once. But I mean, you can throw Syria in there. You can throw all these, I guess, the Abraham Accords in the first administration. Saudi Arabia wanting to come into the 21st century in a more realistic way. It's really an amazing time to be alive to be watching this victory. I mean, are you surprised that it happened or not really? It's the Arab Spring we've been waiting for, isn't it?
Well, yes. And I mean, I'm a little bit surprised that it happened this quickly, but no, I mean, this is really the big change from the first Trump term, which is he decided he wasn't going to wait on the Palestinians to get to additional peace deals between Israel and Arab neighbors. So that's how we got to the Abraham Accords with Morocco, UAE, and Bahrain. And the great thing about the Abraham Accords is, again, during these 2 years of grinding war, they've endured. Nobody pulled out, nobody froze them. They've continued on. And last year we saw the biggest trade between UAE and Israel in history. They've really expanded economic ties, even given the crisis. So I think that was really the turning point. But now I think the president's work at the United Nations last month, where he really put the foundation in place for this deal, that's what has gotten us to what happened yesterday. And the sky's the limit going forward. And the question is to the Palestinians, do they want to take what's on offer to them to build a more secure, prosperous future for themselves, or do they want to stick with the failures of the past? So that's really up to them.
Because it was only a couple months ago, if I remember, the president talking, I think it was Keir Starmer, and a reporter asked, are you going to back the two-state solution? And he wouldn't really answer the question. And then all the Euros did come out and sort of break with the United States and back that. What happened to that? Did that get rectified in this latest agreement? That's off the table now?
It really was a pointless kind of episode of diplomatic posturing at the United Nations last month, where you had Canada, the UK, as you said, France, Germany, Australia, all countries that should have known better, come out and recognize some kind of Palestinian entity, which was totally non-binding. They didn't have the authority to do it. So it was, as I said, theater. And it really could have set back the president's effort, because it encourages the Palestinians to think that they can continue to resist, continue to attack Israel. And instead, as the president laid out, there is no Palestinian state in the 20-point plan. There is a recognition that the Palestinians want a state, but they have to meet all sorts of requirements to get to that point. And so instead of trying to put the cart before the horse, if you will, and say, oh my goodness, they have a state. Instead, no, you're going to try to create a governing body. You're going to create this board of peace. You're going to create the aid flows that need to go into Gaza and the rebuilding effort, and then maybe we can talk about a state. So no, that was an absolutely ridiculous episode, and as I said, they should have known better.
Well, we're going to talk Zelensky and Russia, Ukraine, but I don't know if there's any, things just seem stuck in the mud there, for so long, and it's depressing to even talk about. But something's got to give eventually. You would think. Well, let's do that next time, Victoria. And we'll focus on the positive events in the Middle East the last couple of days. Thanks.
Thank you, Joe.
Okay.
When we come back, a CNBC scoop on Disney's succession calculus. Alex Sherman joins us with the details right after this.
Unheal. I'm healed. I'm here. Snake, breakout, pullback, boom.
Instagram Instagram rolling out more protections for users under the age of 18. It will prohibit them from seeing content that would be considered inappropriate for a PG-13 rated movie. Parent company Meta will use AI to determine whether content qualifies as PG-13. Those new settings will also hide posts with strong language, certain risky stunts, and drug content. Teenagers will automatically be opted into this new stricter settings, and they won't be able to change them without a parent's permission. Meta previously announced that it would use AI to determine when teens might be lying about their age to circumvent the restrictions. And yes, applause for this. We like to see anything like this that is put to good use for that. So yeah. New this morning, CNBC has learned that Disney has considered a co-CEO structure to replace Bob Iger. The company plans to announce a successor early next year. CNBC's Alex Sherman wrote that story, and he joins us right now. Alex, good morning.
Hey, Becky, there has been a trend of co-CEO structure namings over the past month or so. You've seen it with Comcast, you've seen it with Spotify, you've seen it with Oracle. Oracle had a co-CEO structure even before, but now there's two new people there. And so you've got Disney coming up with an announced succession plan. Disney has said they plan to name a new CEO to replace Bob Iger as CEO in early 2026. So it was only natural, I think, for me to think, well, look, maybe Disney is next up to do a co-CEO structure. So what I learned is that last year, Bob Iger had a discussion with Netflix co-CEO Ted Sarandos. Netflix, yet another company that has a co-CEO structure. And Iger asked Sarandos, how does this work? What do you think of it? And basically, Ted Sarandos told Iger, look, this is how things have worked at Netflix. It's at least an indication that the Disney board is considering a co-CEO structure. And the logical two candidates, if Disney were to go in that direction, would be Dana Walden, who is the co-chair of Disney Entertainment, has long been in charge of the Disney TV side of operations, and Josh D'Amaro, who's the head of parks. It has been since Bob Chapek left to become the CEO several years ago. Insiders say that these two candidates have really long been the two favorites for the job, at least internally.
So it's still speculative at this point that they could be considering this. I can see where it would make sense, but you could also see where if they did something like that, maybe Bob Iger would stick around as chairman. Because frankly, the co-CEO roles rarely work, rarely last for long. And when there is a co-CEO that works, you kind of know who the real person in charge is.
That's exactly right. And that's what my story is about on CNBC.com this morning, which is that even with these examples of other co-CEO structures working, Disney has a lot of reasons not to go in this direction. First is that, as you mentioned, in most of these situations, the co-founder or controlling shareholder ends up being the executive chairman of the board, because general corporate governance professors will tell you that co-CEOs are basically no one's CEO. In other words, if two people
remember, Jimmy thinks Disney sucks.
Make one person the chairman, the real person in charge, the
Is the
chairman, and two
chairman or the
co-CEOs. That's
co-founder.
basically just great inflation.
So they're pumping Disney again. And the fat cats all own Disney. Because they love this idiot right here.
A Reed Hastings at Netflix, or Brian Roberts at Comcast, or Larry Ellison at
Yeah,
Oracle.
but they missed him when he was gone.
They certainly did, and they may want to keep Bob Iger around for as long as possible.
No.
And maybe this is a way that you could do
You need to get rid of him.
They first tried this in 509 BC.
Exactly.
Remember you looked up?
That is. Co-counsels in Rome. And guess what?
One of them got killed.
It didn't work then.
Yeah, it didn't work very well.
I'm the same way. You need to get rid of Bob Iger. But they still won't address the wokeism. Disney already has been branded for children. So it's a tough job, and we are at support. So this could bounce. I mean, I'm at my bottom support right now. I hate to say it, Disney Tron stumbles. Can Zootopia? Oh God. Disneyland's Taylor Swift era tour. Oh God. Walt Disney shares are trading higher after the company announced on social media that it will stream Taylor Swift. They're getting desperate. I mean, another slut puppy for Disney. Hello.
Hi.
I was calling to wish you good morning. Yep. I'm home now. Whoa. Slow down, Jim. Don't overdo it. But I am putting some Coach cologne on right now. I'm putting on some cologne. I gotta smell good when I'm trading. Yep. They're pumping Disney this morning. I don't, Taylor Swift and yeah, her stupid movie. Disney of all people. Why would you pump? Yeah, why would you pump a shaded person like that for a child company? That's the way I look at it. But we're out of support, so fat cats love it. KN? Okay. Oh God.
Looks pretty good right now.
I'll look at it.
$349. So that could be one to watch for a stock scalping. It has news.
Yep,
Right?
yep.
So if it has news, it might make some moves today. The penny traders are chasing it.
Alrighty.
Anyways, 177 month old.
I'll check it out.
So, what's that?
I will check it out.
Yeah. Also, AREC is a mineral earth.
Yep.
One to watch for long term. Okay.
AR.
AREC. Eric. AREC.
You better not be seeing him.
Pardon?
You better not be seeing no Eric.
No. And then the other thing to watch is AMD has news today. Okay?
Yep.
They got news with Oracle.
Oh yeah.
They're going to ship 500,000 AI chips.
Whoa. And TSM got earnings coming up on Thursday.
Yeah, but AMD was on the move today. That news of the chip with Oracle.
Yep.
So it's sort of like that, Nvidia's on competition. It doesn't matter.
Yep. Just like you. Jim, I nailed it twice. I nailed it twice now. Gucci doing better? Gucci back to normal? Okay. Yep, you never know. No. Yep. Okay. We'll catch you later. Bullseye. If I get a bingo trade, if I see a bingo trade, I'll tell you. Yeah. Whoa! It's all right. If you can catch a 3, you can trade with me. Oh, yeah. Bye. Yep. Bye. Oh, this guy's on. Are we in an AI bubble? CNBC up to its own dirty. Are we in an AI bubble? How long have they been talking about a bubble? For almost a year. I'm so sick of it.
The Mag 7, not so much NVIDIA because...
Oh, shut up. My name's Washboardjim. I am the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and being in the now. You know, if I had the real money, I'd start up a network. And I'd call it True News, where we don't pump fat cat stocks. They've been on this bubble thing for almost a year. They've been on this tariff thing for almost 2 years. But you can't fool this sneaky snake trader. I did some pretty good trading Friday. I got stuck in that last trade, but it paid off. But I was kind of worried because I was on such a winning streak. So we're going to clean it up. Clean up your act, Jim. We're sick and tired of it. I see it. Inverse head and shoulders. So it's now 7:42. I hope everybody had a blessed night last night with a good night's sleep. We have a symmetrical flag. We have an inverse head and shoulders. You know, I don't like listening to you. I think you're an idiot. You shouldn't be on here talking stocks. Because you're a Trump hater, for one. Oh, is the bell rung already? Oh, that's yes. We're in a market bubble based on AI exuberance.
I'm moving my 200K IRA to the money market account. Can you believe this? There's a lot of money sitting on the sidelines, okay? Leon Cooperman a month ago said he was out, that the market is overbought. A lot of Wall Street has the Trump hatred syndrome. A girl comes out on CNBC and says, tariff this is going to show up in this quarter's earnings. And what's BlackRock do? They had a 25% increase. Oh, with you. That's a nice deal. I'm feeling good today for some reason. If anybody did anything good for me over my last week's speech about doing something good for somebody or making up with someone that you've been into it with or broke the ice, please let me know. Did you do something extra special for the old lady? Did you tell her, stop fighting, honey? Let me know. I love you. Good morning, Robert. M12G. Tell me if you went out of your way to make somebody happy. Is 6585 a strong support on SPX? I'll be the judge of that. Randy, did you do something special for the wife? You did? Oh, you remodeled her bathroom. That would be very good. Well, I'm seeing a 1, 2, 3. I think it might be a little bit lower. No. 6575. $65.75.
That's what I have. And then a 60, then the bottom line of 65, a little above 65.50. So I went out and bought some coffee this morning. I forgot even the name of it, but it was an espresso. I said, I'm going to try this out. So I went to pour it in my bag, and I got a little bit. I got the last of it. So it's an espresso coffee. So I've told the lady at the register, I said, this is the least amount of coffee I've ever bought my whole entire life. And and it come to $3.36, $13.50 a pound. And I'm gonna see how many cups, pretty good sized cups of coffee I get out of it. It's about a tablespoon piece, so big old heaping scoop. Not a tablespoon, but a scoop. I might use a tablespoon and see how many tablespoons, and every tablespoon would be a cup of coffee. I want to see how many I get out of that. And I just ground up what I had left in my other one, so I'll drink it first. I didn't see what the weight was. I should have checked the weight. But I took the last of it to the very last bean. I've been drinking more coffee. I got on it for about a half a year. I didn't drink but 2 cups a week. Now I'm having 1 or 2 a day. It's supposed to be good for your kidneys. But I doubt adding creamer to it is. For I'm Washboardjim. I am the founder of the Sneaky Snake trading strategy, where I talk about chart patterns, moving averages, and being in the now. Jim, you say that so elegantly. I would like to know if you'd date my grandma. How old is she? She's 101 years old. And she watches you every day on YouTube. It's kept her alive for the last 11 years. Randy, today's first support. You ready for this on the SPX? I'll have 3 here, basically. $66.25. 65.75 and 65.50.78. I can't leave that 3-headed snake out. Oh, that's perfect. Really, 68.24.19. I mean, you can't beat that. I'm going to put my alert right above it.
So, all in all, peace breaking out in some parts of the world. Some of these things can come back and
Peace.
be,
Yeah.
yeah, can come back and be
Weekend.
positive.
Yeah.
Can't they? How about just in general?
What do we do? Get some good news?
Confidence in the new environment here. Is it because I hear that they're just scared of Trump, so they don't criticize him, or are some of them embracing what was in the big beautiful bill and some of the deregulation? Not the tariffs, maybe.
There's a lot of, it's a tremendous amount of noise around politics and execution of policy and things like that. But, I'll go back to banks for a second. I was in the UK last week.
That's your fort, yeah.
Yeah, I was in the UK last week. And you look at the performance of the US banks versus the UK banks or the European banks. It's still something that is very, very, this country should be very proud of, is that the banks are executing very, very well in an environment that's pretty positive. So corporate confidence is strong. I think the confidence of the CEOs of the U.S. banks are strong. We're still very, very positive on regional and community banks.
Very, very
I think,
positive.
Secretary of the Treasury Bessent has been outspoken in terms of the importance of regional and community
What's that
banks
mean,
and
sir?
how much he's going to support the consolidation in that sector. It's a good time.
Diamond, thank you.
Now, she told me AA.
Stock price is right now.
Now, this is an old one I had on watch. A real old one. 2019, maybe? 18? Okay. This is Satra Skin Science, a medical technology company dedicated to developing, commercializing, and marketing innovative products for a treatment of dermatologic conditions. Announces a groundbreaking clinical case study published in Case Reports of Oncology. The study reports the successful use of 308 RM excimer laser to treat a rare and under-recognized form of Coots's cell. Where's my sweetheart, Sue? Sue, are you here? You know I love you. You mean so much to me. Every breath I take, spits out the word Susan.
Breaking on Squawk Box this morning, General Motors announcing its third quarter results will include a $1.6 billion charge because of a pullback in its electric vehicle ambitions. Johnson & Johnson CEO telling us that the company plans to separate its orthopedics business into a standalone unit. And Oracle Cloud announcing that it will deploy 50,000 AMD AI chips next year. AMD shares rising on that news. Woo! Look at the markets before we hand things off, and it's been in the red all morning. Now the Dow futures down by more than 375 points. NASDAQ futures off by 300. The S&P
Dow 394, you dingbat.
Goldman Sachs was the biggest decliner on the Dow. It was down by about.
Can't you read?
But we'll continue to watch this because this is obviously across the board.
The Dow component.
A lot of companies.
Goldman Sachs. Yeah. Yeah.
Right.
Okay, thanks for that.
Now it's down by 2.4%. So there's
JP Morgan's off a little bit.
a little bit too. This is some weakness basically across the board. Folks, that does it for us today. We will see you right back here tomorrow. Right now it's time for Squawk on the Street.
Goodbye.
Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber here at Post 9 of the New York Stock Exchange. Kramer's in San Francisco as Dreamforce gets underway today. Futures giving back most of Monday's bounce as China rhetoric heats up. Besson says the shutdown's starting to hit the real economy. And the commentary from banks this morning is mixed on this first busy day of Q3 earnings. 10-year 402. Our roadmap begins with
Jimmy said they were priced in already.
JP Morgan's trading revenue hits the record. Goldman and
The
Wells
banks.
also beating the street.
Plus, we have more deals. What else is new, of course, in the AI
I said it.
industry? It has a number of chip stocks that are on the move this morning. We'll try and break all those down for you. And BlackRock's assets hit a record of almost $13.5 trillion. BlackRock CEO Larry Fink will join us exclusively right here at Post 9. We'll talk about the results and get his outlook for the markets.
Let's begin with the big banks kicking off earnings season today, including JP Morgan Chase posting a quarterly beat, helped by strength in trading and IB. Jim, a lot to dig through this morning. I don't know if you want to start with the banks themselves or some of your commentary on how speculative parts of the market, as you say, wagging the dog.
Right, well, I do think that I want to start with speculation, only just because seems to be driving what happened even early in the morning. When you wake up and you see crypto down and you see the quantum stocks down and you see the stocks that are related to flying cars. Dave and I always like to make fun of those, or nuclear. What happens is you just say, wow, did something just go wrong last night? And then you start working.
What's wrong with the Jetsons?
Or you work backward to maybe something in the Middle East, and frankly, I'm not working backward. I just think right now that what matters, and it's just the craziest thing, David, is that the speculation bubble was, and it was a bubble yesterday, somehow burst. We don't know yet why. It has nothing to do with treasuries, but David, it's just gotten to the point where it's nauseating, and I think that even a Jamie Dimon would tell you it's just too excessive at this point.
Well, I want you to be more specific when you say something has burst. You're talking about a speculative. What are you talking about specifically there? I mean, I heard you say flying cars and things like that. You've talked a lot about sort of the peripherals of the market, I guess. That's what you're referring to, Jim?
Well, yeah, I mean, look, we don't want to say it's the Palantirs, because Palantir is actually making real good money. And we don't want to say it's the Robinhood, because Robin itself is making a lot of money. But it's the kind of stocks that we would describe as being hope and prayer stocks. That we hope that quantum grows into something. We hope that the nuclear power plants put everywhere because it's cleaner power. We'd like to think that every single version of Bitcoin would move up. All crypto, Ethereum. We'll talk to Larry Fink about that. But David, these are the things that trade at 4 a.m., they trade at 3 a.m., and suddenly the futures are down. Now, you can also say, listen, the futures are down because it's a sort of deflationary thing. Look at oil. But there was a time when if oil were down to 57, we would be exuberant.
Yeah,
so
we'd be
maybe,
rejoicing. Yeah.
Right? So, I mean, I do think we got a little aggressive in the last few days. Yesterday was one of the most hideous days I've seen because it was led by crypto and it was led by the stocks that I'm talking about. And, it started with a thing called Bloom Energy, which is a company that makes non-combustible hydrogen energy. That got a big contract, and suddenly everyone said, you know what? These aren't speculative, these are mainstream.
And we got $5 billion from Brookfield and their infrastructure.
That's
it. Obviously, the fuel cells that will help data centers. And Carl, as you know, everything comes back these days, it seems, to the data center. I had that long conversation yesterday with the two CEOs of Oracle, certainly, and so much when you're talking about it, also seems to come back to OpenAI, which drives the news cycle almost every day. Yesterday, of course, the Broadcom deal. I know Jim spoke with Hot Tan on his show last night. I want to hear from that. We obviously had a conversation as well, Jim, with Greg Brockman and the president as well of Broadcom yesterday, and then on to the Oracle guys. I mean, that's where it all sort of germinates from. OpenAI, I can't even keep track on a daily basis of the commitments that they have to all of the companies out there in terms of what they're going to be paying them for so many different services.
Yes.
Go ahead, Jim.
Yeah, well, I've been doing some noodling on what OpenAI would really be worth in the IPO market, and I have had my this morning I've had some of these bank CEOs just tell me, "Stop it, Jim, stop it." I mean, you got a company, you're trying to say it could be worth $1 trillion. I mean, the revenues would say that it should be worth maybe a couple $100 billion max. So I don't know how much that talk is pervading. I do feel that people are saying, Carl, let's put a break on this. Let's stop saying that a company that might be earning 10, that might have 30 billion in revenues is worth $1 trillion. We've got to stop that. People, I think, are trying to say, wait a second, OpenAI, as David said, is driving everything to be able to make it so that Oracle can order AMD chips. We have to just say, wait, this company cannot be driving this economy. It just doesn't deserve that role yet. And the IPO that you think's coming, it's not going to be nearly as big. It'll also be the 28th largest company in the world at this price.
What company's you're going to start life with that kind of a debt load? I mean, I don't even know where it's all coming from, and neither do they, by the way. Amazing.
None of us do.
What they've been able to accomplish in
Jim
terms of
Cramer.
getting these deals on paper, at least to some extent, Carl. But there's so much on the come.
Watch your mouth. Don't use cum anymore. I disagree with all these guys. They have no clue what it takes. My speech yesterday about innovation, I see a buying opportunity, but I'm not ready to swing yet. We'd have to have a bigger correction, at least 10%. But we're not in no bubble. They said we were in a bubble when NVIDIA was at 150. They said we were in a bubble when AMD was at 120. They keep saying it over and over and over and over. And over and over and over, to where they're going to talk the traders in to shorten the market, and then they're going to get stuck. And all the fat cats are going to turn coats on you. They couldn't even pick the bottom. I did. None of them called the 200 this year. None of them. Excuse me. I just ate some butter. On the weekly time frame, none of them. They said we were going to go down more. And this only went on for about a month and 2 to 3 weeks, and we bounced back up. So if we do dip, it'll be this previous resistance of a triple top. If they talk the market, that's what they want. They want a pullback so that the ones that are sitting with cash can get back into it. They're not going to fool me. I'm going in the kitchen and cook me breakfast. Earnings, because I wanted to talk about NVIDIA, because their earning power is much greater than Jared Bernstein thinks. But I do think that Well, Bernstein sucks.
has more business than it can handle. It offers a full stack that includes a lot of software. I think AMD's, their next model that comes out in the middle of next year has got the same capabilities as, of the hardware side, but NVIDIA offers a lot more than just the hardware side. And by next year at this time, NVIDIA's going to have a new chip that's going to be much faster. But look, everybody needs every single chip because this is one of those situations where you can't afford to not have chips. And right now, it's too hard to get NVIDIA chips. You can't get them all. But Lisa Su, congratulations to her, David. An unbelievable coup. She did say that this could happen, but no one thought it could happen within the next year.
It's happening, and the stock obviously got a real bump on the news they had, as we've reported, of course, around what else OpenAI from last week as well, and that opportunity that then OpenAI has to buy stock over time in AMD. It's hard to keep track of. You can forgive people if they can't, Carl. You've got to keep a daily stat sheet in terms of where all this is.
Right. And
what's
sometimes
going where and how.
back and forth, back and forth.
Yeah.
To circle back to the banks, Jim, some of what we're talking about has been reflected today in the qualitative commentary, particularly out of JP Morgan. Early signs of excess. Not sure we'd want to buy back stock at these prices.
I know. I mean, it's just, I think that they're being kind of a bummer. I think that Jamie Dimon, and the tricolor actually is a fraud. He talked about something that happened that knocked some stocks down. But I think Jamie Dimon is saying when it's this good, you have to be careful. And there was a big run-up in the stock yesterday off of that $1.5 trillion infrastructure. By the way, that thing really got things going too. We should talk about that in a second, David. But the $1.5 trillion initiative that talked about quantum, that talked about critical metals, that just took up every single speculative stock. Certainly that was his meeting. The bank that is producing the best earnings this morning is Wells Fargo. And the reason why that is because Charlie Sharp laid out a vision which just says our stock is cheaper than we thought. He actually bumped his what I thought he was going to buy back aggressively. He talked about having $30 billion more cash than he needs now that the cap is going and reinventing the bank. No longer just doing nothing but mortgages, but now doing a lot of exciting things, including M&A, a lot of corporate stuff that they weren't doing before because they weren't run by Charlie Sharp. So, David, the contrast here, Charlie had all that capital locked up because of the cap put on by the government. Now that's freed. Jamie Dimon, the stock has been such a horse. I don't blame him for one bit for saying, whoa, let's just be a little careful. And froth, they even mentioned the term froth on the City call just now. So, I mean, everyone talking froth except for Charlie Sharp.
Yeah, I mean, we point out and that Jamie is typically perhaps more cautious than a number of his peers, to the extent he has any peers at this point. Not clear that he really does.
Oh, what a cheap shot at everybody else.
Well, no, look at the market cap. Look at the market cap.
It wasn't a joke.
It
was a joke. Get with the program.
I'm sorry, I got to get with the program.
Sorry.
That said, he does tend towards being more cautious, but Carl, not without reason. We've had a credit bull market for 20 years, says Jamie Dimon. The early signs of some excess, talking about that, the First Brands bankruptcy, of course, which has reverberated a bit through the capital markets of late, impacting certain areas, both in private credit. Talked about Jeffries a bit. Jim, there are no shortage of things to at least be focused on as concerning, perhaps, but here, we keep going higher, generally speaking. And to your point, it is
fat cats keep talking bearish.
Markets numbers of whether it's
you got to keep that in mind today. We got Powell coming out today.
Moving ahead, we talk about the debt financings alone that are being put in place, for example, for data centers and everything related to it. It's enormous. It's an enormous pull on private credit. It's an enormous pull on the banks. It creates a lot of business.
Right, and I think that one of the themes of the Goldman one that we got to talk about, and Goldman stock is looking down. Look, I don't know. Today's a down day. What am I going to say to you? The Goldman quarter was good. Everybody knows it was good, except for trading. Big deal. That fluctuates. But Goldman's making a point that M&A is just going to be incredible for the rest of the year. And David, I think it's important that they usually have a pretty good vision. You can tell me, what vision do they have into that? What's the visibility that David Solomon can say, listen, the M&A is just going to be spectacular between here and year end?
What's the visibility they have? Well, I mean, you get a sense from your corporate clients is their willingness to do things. They always call you for conflicts, clear your conflicts. I mean, you hope, you're working on things. You don't know necessarily, Carl, if they're going to get to the finish line. There does seem to be a lot more optimism right now that this quarter is going to be a big one, but we're going to see a number of big things announced. We did have the largest go private of all time announced only last week. We seem to have sort of moved on past that, Electronic Arts getting bought by the Saudis.
Although this shutdown, Jim, I mean, SEC registration will be interrupted unless this thing gets resolved quickly. I think that might have been part of what Bessent was trying to get to today as we are now in day 14.
Well, Bessent did remind us, wait a second, there is a shutdown. And I have to tell you that when I look at companies and try to figure out what they're going to do, I wonder how they're going to get a lot done that does need the government checking off. Now, the SEC seems to be a little bit, I'd say a little bit willing to let people do what they want, but that's also at a certain point you have to stop it. You know, David, we don't talk about the shutdown and what it does to the economy because it's never been thought to be as long as this one's going. And you know that there's going to be no resolution with the president not around. I just think it's kind of, you can't just table the darn thing, David. There is something to closing the government, isn't there?
There is, and we said many times when it originally happened, Carl, that we'd have to wait a few weeks to get a sense for, and it builds. And maybe we're in the building part of it now already in terms of the real risks.
I mean, not only are TSA and military paychecks due in the next couple of days, but this is a reference week for BLS. So employment, we'll see if the people who are being furloughed now will be counted as unemployed. We are going to get CPI because they're bringing some of those people back, but we don't know. I think we do know the date. It'll be in time for the next Fed meeting. But just a larger picture, Jim, it is a headwind.
Oh, my, I mean, when you're talking to companies that are trying to do Okta, I've got on tonight, they're trying to do business with the Department of War, Defense, whatever. Like, how do you do business with someone if they're not there? They're not soldiers. They're just bureaucrats. I think bureaucrats, they get, see you later for a while. It's crazy.
All these topics we're going to cover in a few minutes with Larry Fink of BlackRock and an exclusive right here on set. We'll talk some earnings, the state of the economy, the markets, asset prices, digital asset regulation, and a lot more. That's coming up. Get to some consumer names this morning as well with Albertsons, Domino's, a lot of news in autos with Ford and GM, Meta too. We're back in a minute.
So right now we've created a Darvis box on the, well, that's Tessa. And we got a downward megaphone with a uno, dos, tres, cuatros top. If you can count to 4, you might make a little bit more. Resistance channel today on the SPY is 659.78 to 661.04. Support to hold 654.52, 56. And that'll be an inverse head and shoulders. Do you understand? Say yes. For I'm Washboardjim, the founder of the Sneaky Snake Trading Strategy, where I talk about chart patterns, moving averages, and I got to turn my egg.
at some NASDAQ 100 laggards. This brutal sell-off in crypto really began on Friday, taking with it some shares of strategy this morning. We'll talk about the weakness behind some elements of chips as well, with Microchip and KLA-10 Core also on the list. We'll get Kramer's Mad Dash and count down to the opening bell in a moment.
Ten more minutes left.
All right, let's get to it. A cross-country mad dash as we get ready to ring the opening bell here. What do we got? About 7 and a half minutes or so. Jim, you want to talk a little dominoes?
Yeah, look, I think that Russell Winter's doing a fantastic job. The CEO doesn't get a lot of credit for what he's doing. Maybe that can change with a much better than expected quarter. $4.08 versus $3.95. What I really like about this, David, is that Russell has figured out, I'm going to talk about it tonight when he's on the show, that you need to have an offering that's less than $10 in this country if you're going to be able to do well for dinner. And he's got this best ever deal at $10. I've had it. It's really fantastic. And Domino's to me is amazing because I've got one near me, so it comes in about 30 seconds. But the idea that America can't afford more than $10 pizza is what is really in sync with what I'm hearing about. You can't afford more than a $10 hamburger, not more than a $10 dinner like they do at Brinker. So, David, this is the have-not thing. And you and I both know it's true. There's a part of the country that cannot afford a $12 pizza and can't.
I spoke about the has-nots. Who is our mole in this room?
There's another whole part of the country where the inequalities are just not going away.
Well, there's still 40% of our country that couldn't meet a $400 unexpected bill, Jim.
I know.
Thanks to Biden and Harris.
We've been mesmerized by all the different crazy things that are happening in the market. In the meantime, there's a whole other market, which is just the TJX World Stores market, and that's doing well. And it's doing well because people don't either. You could say that some people think they're thrifty and like value. I think they just don't have a lot of money versus inflation. We forgot there is inflation, David.
There is. No doubt.
Thanks to Biden and Harris.
All right, we got an opening bell about 5.5 minutes from now. By the way, don't forget we're going to have an exclusive. BlackRock CEO Larry Fink will join us. Keep it here.
They'll never get it out of their mouth. I remember before Biden and Harris were in office, I'd go get a bundle of hamburger for about $8-9. Same weight now is $22. 18 to $22. Same exact size. Same exact meat. I can go to the store up the street and pay $22 for a chicken breast when I can go to Walmart and pay 12 to 14. Same size and better chicken. But that's, I'm pissed off because this store sold out, Price Cutter sold out to another company that has I don't know, God, their prices were extremely high and they just gradually raised them up. I don't buy as much groceries in there as I used to. Like if I went to buy my stew, my soup I make every week, it would probably cost me $35. And I go to Walmart and it costs me about 14 to 15. That's with the chicken, the celery, the carrots, the spice. So I made 10 cups of soup for less than $15. It was the best soup I've ever had, ever. Even at a 5-star restaurant where I'd pay $40 for a bowl of soup.
We are in a wave, in a phenomenon, as I call it, I've never seen before. That it's not cyclical.
Let's see what Titellini's wearing today. Tell you what kind of mood I'll be in today. I think she wore a potato sack, she'd still look beautiful. SSKM just keeps moving. CRML. And we're off to the races. October 14th. SPY calls the two 660s. We got support down here for a double bottom. Snort that one out. Oh, I gotta look where SPX opened up at. Tedolini's covered her body up today, so it's not going to be a good day. She looks hot. Oh, she's gone. What the fuck? $6,675, Randy. What'd you say? I think Randy got it right. What did Randy say earlier? Randy. Around 6,600, 6,685. Well, you got that right. You nailed that. You nailed that one. Everybody give Randy a standing ovation. He's not scared. Washboardjim is strategically watching the SPY right here. We're at 91 cents. I'm going to go in there and make me a cup of coffee here. My alert's set. And I might move these up to the 659s. I like the 660s because it's an even number, but gets around 60 cents. Okay, get ready. Prepare ye in the name of the Lord. Amen. SPY calls 660 or the 659s. Can we get one more candle, please? Get ready. Prepare ye in the name of the Lord. Prepare ye. Okay, we're here. Something's going down. Something's going down. Uh-oh. Triggered. Triggered. $0.70. Okay, crowd's going wild here at the sports arena. I really don't have an indicator to take the trade. I'm just going off of a gut. But we're coming close to a double bottom. We need it to break out of this here channel. $61. Come on, give me 62. Peppolini, how come you showing no cleavage today? There's 62. $0.60, so I got 65 average. Whoops. Ah. Let's do it. Whoops. We're now at 70 cents. Keep going. 72. We got a tweezer bottom. Unbelievable. That's what you are. 654.70. Let's take it to the VWAP. She's not dressed appropriate at all today. I have an issue. I'm a little bit nervous here. We've got the snake breakout pullback with a fallen wedge with a double bottom approaching. What the fudge is this? Now what is it? Why is it doing that? I done something different here. Huh. That's very interesting. Wow. Might have to get out of this thing. And wait. We're about to get to 65 to 55 here on the SPX. Be careful, room. AMD hit the 200. I got a little bit more downside to the 179 on NVIDIA. These fat cats have been talking bubble all morning. So we've got to be extra careful. Well, we did hold 75. We're at the double bottom that I called. So we'll see if we reverse here on the SPX. I'm going to look at them right now. This is a major support. Let's watch it real close here. SPX 67.50.78. Come on. Lotto. Oh, these are cheap. These, no, that's SP. Okay, hold on. These are not cheap. These are not the SPXs. So the 6630s or the 25s or the 20s, I'd almost go a 20 and buy one. Three black crows with a tweezer bottom. Well, I tried to get 520 there. I'm still in the spies. I should have bought the dip there, but I did not. Come on, Peppolini, what are you doing wearing clothes like that? We got a lot of speakers, Fed speakers today. Michelle Bowman, Jerome Powell, Susan Collins, and Christopher Waller. China CPI and PPI coming out. Okay, we're back to 520 on the SPX. This thing's got a delay again. I hate it when it does this. That's like 3 seconds. I mean, that's a lifetime. Damn it. So when I'm trading the 3 black crows, I didn't jump into this, but I could have there at 520, 530 for sure. Each one of these crows is a resistance line. Like right there, you're at a double top. Next one will be breaking resistance at that, and then the third one's all the way up here on the 5 minute. You have a tweezer bottom. SPY's back to 61. 62. Let's go. We're at a double top. Oh, there we go. Come on. Come on. Now, if you're in this trade, I'm a little bit skitsy right now. So it's not a big percentage win, but it is a win. And we're coming up to the 63 on the 1 minute. So make a business decision. And regroup. Now, if I'd have bought that dip, I would be looking real nice. An additional, I mean, we hit 45 cents. So we're back at, there we go. Come on, give me the 200. That's a good idea to get out of the trade. If you know what I mean. Someone say yes. Someone say yes. $0.70. We got 3 white soldiers. I'm Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy, where I talk about 76 cents. I'm out. Woo! I'm out. I'm out. I'm out. I'm out. I'm out. No time to say hello, goodbye. I'm out. I'm out. I'm out. Today's song will be about Susan. We're at the 200 right here. Yesterday's song was about Angel. Today will be about Susan. For I am the founder of the Sneaky Snake Trading Strategy. I'm high on adrenaline right now. The SPX up $300 a contract. Anybody take that trade with me on a risk level? Did someone take the trade? Yes or no? Your entry sucked. You should be green though. We're at the 200 EMA, I mean SMA. This is really an exit idea. Take profit. Take profit. Woo! Good job. George.
Follow the biggest headlines, live analysis, breaking news, and sharp.
Oh, this is a commercial.
Minute by minute. With shows
No, no, she needs. Oh, look at the knockers on her. God, Marley. That was an inappropriate outfit. That was very inappropriate. Why would you dress like that? I guarantee it, she's after Nicole's job. I'm impressed. I really am. That was a toughie. So I'm going to ask a serious question. How many rooms have you been in where the moderator walks you through the trade like that? Tells you why he's getting in it and where he's going to get out. For you people that have been in experienced rooms. Sheba says it's very rare. Livid Goose says 2. M says hardly ever. They announce after they are in. That's a true room. I've been in a lot of rooms. And I don't think I've been in one that does it quite like me, but I'm kind of, you know, let's say, a narcissist. Woo!
Narcissistic Jim, with his ego and his wit, doesn't give a damn what you think of him.
Him one bit.
The market takes a dip, SPX Jimmy will buy. Bitchin' and Molly Carolyn, still the apple of his eye. Burp it
Look,
up,
Jim.
let it fly, let it roar, let it roar. Stocks tend to rise with a fart from his core. Narcissistic Jim doesn't care what you think. He'll burp and fart out loud until his room stinks. Candles on his screen bounce like titties in the night. Burps get so loud the neighbors say that boy ain't right. Bulldog bear calls or puts, doesn't matter one bit. Jimmy's face can't wait for Nancy to come and sit. Fart for a dip, ass making noise. Burp for a rip, cheer from his boys. Jimmy is grinding away on his washboard toy. Burp it up, Jim. Let it fly, let it roar, let it roar. Stocks tend to rise with a fart from his core. Narcissistic Jim doesn't care what you think. He'll burp and fart out loud until his room stinks. Lots of fun he has, his ego's ablaze. Burps and farts collide, the room is so amazed. Narcissistic Jim, the legend, the king, playing his old watchboard till that closing bell rings. Narcissistic Jim. Narcissistic Jim. Narcissistic Jim.
All righty. I'm gonna go make my coffee and come back and get at it again. Oh God, look at that! Oh no!
10-year rate futures, we are hitting a critical area.
$1.
At 4% level, as you mentioned.
Damn.
If you kind of go back and
I
look
didn't
back
see that
in
coming.
September, we really did not stay around this level for too long. So if you're a technical trader, you are actually looking for a balancing yields, meaning prices moving to
Wow.
the downside here, maybe a little bit of a
That
backing
hurts.
off of that trade. And if we do not have
I had 20
that
contracts.
stressed out or economic data that's being held
SPX is at 1050 though.
to the downside when it comes to yields. But from a technical standpoint, key area of support from Powell in his commentary, obviously we're still going to be focusing on the data. We're not getting a lot when it comes to the government.
Almost 100% on
They
it.
do have third-party data. I'm sure that he's probably going to reinforce the fact that they do have some insights as to what's happening with the economy, probably also signaling to the fact that if we do see a prolonged shutdown, as we are in 13 days now, it could actually have an impact when it comes to the labor market as well as consumption growth here in the United States. On the back of that, and here's the curveball, if we do see
Curveball.
potential tariffs kind of coming back into the picture, especially for China, does that provide a little bit of uncertainty when it comes to the inflationary picture, and how do they balance out that risk? He's been talking about that a lot. So the shutdown just does not seem like it's abating anytime soon here, and hopefully we do come to a resolution, but
10:10, 10:30.
Powell's probably trying to calm the markets as much as possible, not create more volatility.
Yeah, and look, Neil Duffer made the point last week, which was interesting, that you don't really need the official government data to tell you that we're seeing a slowdown in the labour market. So obviously that is the area where they are emphasising as part of that dual mandate. So let's see what they say and what Powell is going to be commenting on today. But you mentioned the tariffs.
Burp it up, Jim.
So as the IMF has been reporting on its sort of world global economic outlook, that it is very much talking. I've seen a New York Times headline suggesting that they are seeing the impact of trade tensions being limited so far, but they do expect growth to slow moving forward. So shifting gears to what we're seeing as far as crude oil, I'm just wondering what you make of
Good
it
job.
remaining below that $60 a barrel level right now.
Good job, O.
Yeah, we saw once again a little bit of a bounce yesterday. I think that was probably more short covering activity. At the end of the day, the supply that's hitting the market, that is within the market right now, is pushing prices a little bit lower. And there is
Good job, Rob.
global growth in some pockets of the market, especially when you're looking at China. China has been one of the bigger importers of oil over the last
You're welcome.
8 months or so, but now they have pretty much topped off their reserves, and they're just not consuming as much. Now, is that going to change over the next couple of months? That could be the case, but if you're looking at it from a trader standpoint, this $57 level, $56 level is another area of major support. You can look at a potential bounce there to the upside. Maybe rig counts over the next couple of weeks go lower because of the fact that prices are going lower as well. So production, or those that are
Can't beat that.
to offset some of that that price pressure, if you will, to preserve margins. But this is not really a good signal from the.
So let's talk about this trade.
If you will, anything.
I like to talk about them after we do them. So 3 white soldiers with a tweezer bottom. This is on the 5-minute time frame. So I want people to get not stuck on one time frame, but move around. Move around in the time frames. That way you kind of get an odds like, okay, it looks good on the hour. It looks good on the 30-minute. It looks good on the 5-minute. And those are confirmations, and the more confirmations you get when you're looking at the time frames, the better off you are with the trade. So the hour wasn't developed yet. But you got a 30-minute, and it's not hardly developed either, but you got a hammer with a tweezer bottom on the 30-minute. So that's bullish. That's called a hammer with a tweezer bottom to the top of the orb. 15-minute. $15-minute is giving us an indication that we got a tweezer bottom, so that's good. 5-minute. We have 3 black crows with a tweezer bottom. That's even better. With a spinning top. So you have 3 different reasons. That's called a harmonic candlestick pattern. When the second candle is inside the red one, that's called a harmony. So you got a tweezer bottom with a harmony with 3 black crows. 3 reasons to get in that trade. 1 minute. You have snake, 3 black crows with a long leg doji and a breakout candle. And they're all tweezer bottoms. So that's 4 reasons that was a good idea to take that trade. So go back and forth. Don't get, you know, I've been called just a people hate the 1 minute time frame. I've been scrutinized with many traders, and they're too scared to trade the 1 minute time frame. All that tells me is they don't know candlestick patterns and they don't know chart patterns. That's what it tells me. So the more you get familiar with the candlesticks and the more you get familiar with the chart patterns, you'll see you'll see results, better results in your trading. I don't know too many traders that trade with candlesticks. I really don't. And I know a lot. And I don't know too many traders that point out chart patterns. And I definitely don't know many that use moving averages. So that's why I make it simple. If you can count to 3, you can trade with me. And if you can count to 4, you just might make a little bit more. If you count to 5, you might take a nosedive. So I'm going to go into the kitchen. I'm just telling you, take time out. Go on the weekends and study. Type in bullish candlestick patterns, bearish candlestick patterns, bullish charts, and bearish charts.
Yesterday, off the back of that tie-up with OpenAI, and Goldman Sachs on the back foot to the tune of 4% this morning, even though we did.
So you listened to CNBC this morning. All they had to do was talk about fear. They're swing traders. They don't pull up the scalpers. The day traders, the retail trader are day traders and scalpers. And then you have some that swing trade. We're at the 63 right now. We're at a double top on the SPX. But I listened to CNBC this morning, I just couldn't stand it. It just drives me batty. Bubble, 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 bubble. Everybody said bubble this morning. All of them. They're just giving us opportunity.
In the market, not just down to sort of renewed US-China tension.
I guarantee if they had day traders and scalpers in their firms, that they'd be making a lot bigger percentage than you are just by swing trading.
I have been a great proponent of artificial intelligence, but as I've come to realize, the AI, like every other debacle, frankly, travels in cycles. And so we are now enjoying what the specialists call an artificial intelligence spring, not a winter. However, this is cyclical. I think at some point, the scientists and developers will say, you know, this is a good thing, but it's not the cure-all. It's not replicating human thought. And at
oh, God. Humans make mistakes. I know because I had a picture frame shop. And I've never had one employee that I could sit there and trust to chop up a $100 stick and get it right to 1/8 of an inch. a 1/16 of an inch of a measurement. Not one. I always did all the cutting because that's where the bread and butter was. I mean, if you screwed up a picture frame, some of that can cost up to $100 to $120 a foot. I paid $500 or $600 for one stick of molding. And if they mess that chop up, if they don't get the perfect 45, or they don't cut it to exactly 16th and 1/8 by 20 and 1/8, to where I can fit a picture in, a painting, or whatever. So I always cut my frames first. Like if I had a job to do, and someone came in and wanted something matted, and it ended up being a 16 by 20 in measurement, I would still cut the frame first to make sure, because if I was off of a 1/4 inch or a 1/8 of an inch, I could always adjust that inner lining to fit that frame, because that's where most of my money was. Now, some of them mats can cost $20, $30 a piece. And you got 2 or 3 mats in there, you got $150 invested in a mat to mat up a piece of art. And then the foam core, you know. If I had a machine that I could point right at direction and automatically cut that frame at 16 by 20 and 1/8, I'd use that over a human any day. Any day.
Numbers, the past data numbers, all of them have been somewhat mixed, and I do not think there is a screen.
I end up buying a mat cutting system that automatically was run by a computer. I could cut any kind of detail on that mat. The cuts would be perfect. As long as the machine was set properly and the blades were in there properly and it had a sharp blade, I could do 50 times the work that one employee could do. If I had to cut 20 mats with a certain design and a little opening down there to put a plaque, I could get 20 of them done within an hour, where it would take an employee all day long and never get the exact cut the same. They would all be different. So I invested in the mat cutter, which was about $2,000 back then, and they're probably about $5,000 now. And I could take orders in. I could cut 100 mats in a day and have it done and back out, where it would take me all week with an employee paying them $15 an hour to cut a stupid mat. And that's run by computer AI, more or less. You just key in the numbers. Now you can probably talk to it. So that's my rant. I'm looking at them. 129 for the SPY and 1340 for the frickin' SPXs. So I left $300 on the SPX. And the SPY, I mean, that just kills me. That's $1,000. I left $1,300 on the table. Yeah, and I just paid my taxes Friday, estimated. deposit is what they say. Yeah, I hate getting stuck with 40 grand at the end of the year. That's last year's. $1,500 right now for them. I'm gonna go make my coffee. God, look at 147. Jesus. Right up to my resistance channel. I got a tear in my beer and I'm crying for you, dear. Look at there, perfect head and shoulders. That was nice. And if I would have added 20 more, I'd have had 40 contracts. So 40. That would really have done it. I'm going to show you the Mac cutter that I'm talking about.
Okay, so this is an Eclipse computerized mat cutter that's recently been restored and rebuilt by the CNC doctor. I will walk you around it. The monitor stand is right here with a monitor, keyboard, and mouse. And then the PC tower is right down here. These little bins are just for holding supplies. This is an accessory to the system anyways. This is the computerized mat cutter over here. Okay. This is the cutting head in the open position. And this is the part that holds the blade. There's no blade in it at the moment. The red switch controls the blade depth setting. And there are a number of steps on here for the blade. There's a 2-ply, which isn't used. A 4-ply, a 6-ply, and an 8-ply.
So that's the computerized mat cutter that I had, the Eclipse. And I got it on sale. Oh well. Jamie Dimon says the company bankruptcies reveal early signs of excess in corporate lending. I got to get up and go make my coffee and pee, and I'll be right back. Nancy, get out of the bathroom. When I get back, I'll go over my watch list. We're about to hit my resistance level on SPY. We'll see what happens. 659.78.
The 20-day SMA orange flag You look at some of these announcements that are coming out, and they're coming out, daily or a couple times a week, whether it's AMD and Oracle, whether it's Broadcom and OpenAI, et cetera, but the punch, the reward for these types of announcements, AMD is up, $1.50 on this news here. When you start to see some deterioration where maybe you don't get that much of a positive response, maybe you don't reward the dip buyers as often or as frequently, these are some of the early signs which you could see a near-term shift in sentiment or trend. It doesn't necessarily mean down, but it means, hey, maybe you could be a little bit cautious, pull some exposure. We could be going through some chop here for the next couple of weeks.
Okay, so we had the earnings starting in earnest today with the big banks reporting. I mean, looking pretty good as far as what they've been saying, although we are seeing a bit of a mixed performance as far as the share price is concerned. I mean, everybody's been talking about how the earnings is going to be sort of the next catalyst now, obviously in the absence of the data, with the big question marks still around Fed policy and also the tariff question as well. What do you make of what we're seeing, hearing from the banks and the reaction in the market today?
I'd say so far so good. Sam, if you look historically, the financials, yes, very important economic barometer. The results look pretty good to me across the board in terms of being firm. The price action, it's not uncommon to see, financials sell off or have a mixed response or a muted response post earnings. So it's a bit early. Let's get into some more of the cyclicals, and then we'll get into mega cap tech here in a couple of weeks. And it's not just what mega cap tech and that AHI, adjacent type tech plays report, but it really is that price action. That will tell us whether we're priced in or not. I would say more importantly, near term, what I'm keeping my eye on is the bond market here. Sam, I think that we've got the conjunction of now we have a fundamental kind of a uncertainty that is building a little bit. Number one, around China-U.S. trade. Number two, around the government shutdown. And then number three, what I'd point to is the yields on the 10-year, which is getting ever so close to that 4% level. I think if we breach 4%, normally we think lower yields are better for the market. But if you look at what the IMF said today about potentially we haven't seen the effects of tariffs, then you look at China escalating the trade relationship with the U.S. today, so it's going in the wrong direction. If you get 10-year yields to breach that 4% level, I think that could bring in some more volatility and potentially we can get a bigger pullback here in a couple of weeks. So near term, that's what I've got my eyes on. Of course, earnings are important. They're going to give us a read-through in terms of where we stand on this rally, in terms of whether we're priced in. But if you look at the estimates, they look healthy. FactSet looking for 13% next year. We'll keep an eye on those estimates and see how they fluctuate as we begin to get more of that economic data that comes in.
Nate, fantastic overview. Really appreciate your insights today. And we have actually recouped that 600 level in the S&P 500 today. So we are off.
I'd almost get a put here.
Thank you so much. Appreciate your time today. Nathan Peterson, Director of Derivatives Analysis, Schwab Center for Financial Research, joining us there. Well, coming up, it is time for the morning trade. We'll take a closer look at JP Morgan Chase and the rest of the big banks that reported earnings this morning. Morning
Right to the penny. Even the puts are expensive.
Trading at Schwab is powered by Ameritrade.
On the
Giving traders
SPX.
even more ways to sharpen their skills with tailored education. Get an expanding library
$1
filled with new online
That'd have been
videos,
$2,000.
webcasts, articles, courses, and more. All crafted
I didn't
just
expect
for traders.
that.
And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can
Disney hit my resistance.
directly with an education coach.
Called that out this morning.
At its finest. Tune in live or on demand. Head over to schwab.com/coaching.
Starbucks is another
Start
fat
learning
cat
today.
they can't live without. AMD bounced off the 200 that I called. Nvidia came close to hitting my support.
In the world, this is Opening Bell with Nicole Petalides live on.
I love your last name, Nicole. She's so cute. Oh. Marley.
Comments in a moment. I'll walk you through the numbers first.
Don't walk us through the numbers.
Year over year to $5.07 per share on revenue of $47.12 billion. That was up 9%. Now, investors needing to reposition themselves during the volatile third quarter led to a record in trading revenue of $8.9 billion. The bank's traders, they capitalized on people needing to reposition these portfolios for that record markets division. That includes both equities and fixed income trading and was up 25% year over year. Investment banking
almost got a job at Chase Bank
to $2.6 billion. And according to Deal Logic, JP Morgan has collected the most investment banking fees among all of the big banks so far this year. Now let's talk about what Jamie Dimon said, because this is important, and when he speaks, generally the markets listen. He said that while each of the major business lines performed well against what he called a good economic backdrop, he was preparing the firm for possible turbulence ahead. He said, quote, "While there have been some signs of softening, particularly in job growth, the U.S. economy generally remained resilient. However, there continues to be a heightened degree of uncertainty stemming from complex geopolitical concerns, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation. As always, we hope for the best, but these complex forces reinforce why we prepare the firm for a wide range of scenarios." And that comment's particularly important, Sam, because JP Morgan's provision for credit losses rose 9%, up to $3.4 billion, which exceeded the estimates. This indicates the firm could be potentially preparing for higher loan defaults down the road. So a signal that they may see those turbulent times coming, and they're preparing for it. But they also did raise their full year forecast for net income interest, which is being viewed positively. The call is actually happening right now. So, the market, in terms of the market's down overall, JP Morgan down about 1.33% right now, but that's likely as they're just learning more on the call, hearing more from Jamie Dimon and other members of management over at JP Morgan. But all in all, a very strong quarter with some record numbers.
Yeah, and shares down today. It was interesting that just ahead of the earnings report, they came out with this sort of strategic and resiliency type campaign to try to, really pump and secure the supply chains to reduce reliance on other countries, etc. So no doubt Jamie Dimon does see the need to address that as well, which is fascinating as part of that story. Marley, thank you so much for getting us across the numbers and the comments from the CEO. Let's trade it now. Tim Biggin is with us, options strategist, Pilot AI. How are you approaching your example trade for JP Morgan Chase? Good morning to you.
Morning, Sam. And yeah, looking at JP Morgan, which, beat pretty nicely on both the top and bottom line, as you and Molly alluded to, the loan loss reserves were really the thing that kind of torpedoed it right after the opening, as the stock opened well above 300. Then when that news came out, instantly kind of approached that 295 support level on the stock, which held, I think, the all-time highs kind of distant here around that 320 level. So I just am looking for kind of that range to hold the rest of this week. IV even post earnings still hanging in there. So I'm doing an iron condor trade zone, an out of the money call spread up around that kind of all-time high area, and a out of the money put spread at that 295 support area. Collecting at least on the opening around 80 cents. It's dropped a little bit since the stock has moved a little bit in our favor here. But I think, given the fact that IV is elevated not only in JP Morgan but across almost all stocks now, this trade structure where you can kind of take a look where the all-time highs are, sell that, and then position kind of down around support or just below the 20-day moving average for many stocks and collect some very nice premium on both sides, really not looking for a rip-roaring rally. And as we know, all these sell-offs, at least so far, have been met with some buying, so the downside looks muted until further notice from here as well.
Yeah, it was interesting. I heard some traders commenting this morning. A bit of a tough day to be reporting on what is a risk off with a few other things going on in the market. So what's your steer on the overall performance today? I mean, we are off the session's lows, but there seems to be a bit of caution out there right now, Tim.
Yeah, and I think more of the same going forward, Sam. I think that momentum to the upside finally looks to be broken. So I think that kind of Friday price action took a lot of wind out of the sails from the Momo guys. So I think you'll start seeing more of that, kind of big range, no change from day to day, not only with what's coming out of Washington, but with earnings season starting here. So valuations certainly stretched on most stocks. Earnings growth expecting to be pretty decent and at better.
They said last earnings that earnings weren't going to be too bad, too good, and they were great. The fat cats. Now they're telling us that the tariffs are going to be an issue with earnings this time. I think they're going to be great. Again. This guy's smart. He's saying they're going to be good. But if you listen to CNBC this morning, they were definitely bubble this, bubble that. Earnings are going to be horrible. Tariffs are going to kill their earnings. And it's all, let me say it in a polite way, bullshit.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Damn, Marley. You're a hottie.
Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moves to your brokerage account.
I'm gonna get my coffee.
in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome back to Morning Trade Live. I'm Sam Barnes, coming to you live from the floor of the New York Stock Exchange. It's time now to take a look at the sectors that are moving markets this morning. Alex Coffey joins me from Chicago today. Thank you so much for your time, Alex. And it looks like we're seeing a little bit more green on the screen today compared to about an hour ago. What are you seeing out there?
Yeah, market's really starting to pare back some of the losses here, Sam, as you point out. Earlier it was close to like 25% of the components within the S&P 500 were higher. That number looks closer to 60% now as you've really started to see a recovery under the surface. The heat map was bright red at the open. There is still some bright colors on the screen, and there's certainly some bigger boxes that we'll talk about in just a second that are red still. But for the most part, a lot of recovery in the other 493 is really started to show that, hey, it's a bit of a battle again, and we've talked about this for weeks. Under the surface, it doesn't always tell the same story.
Yeah, absolutely. I mean, I was just talking to Peter Anderson earlier in the show, who was sort of pointing out that, you know, perhaps it's not just US-China relations that are weighing on things today. I mean, particularly look at some of your Mag 7, I mean, your big cap tech stocks, there seems to be, you know, a bit of risk off in some of those names today. So maybe this is a bit of a, you know, show me the money, show me proof of all that spend type story is starting to emerge as well.
Yeah, perhaps. I mean, when you look at the Magnificent Seven names as a cohort, they were all lower, rather, just a moment ago. Alphabet has flipped positive, so it is, you know, slightly working against its peers in terms of trying to bring down some of these losses. But as a group, they're down about 1.25% in total if you were to index them. And if you were to convert that movement to S&P 500 points, they would basically account for about 30 points of the, you know, currently 32-point down day. So the vast majority of the selling can be attributed solely to, you know, these 6 names that are red on the screen, with NVIDIA itself being about 17 points just to the downside alone today with its 3% decline. So it begins and ends when it comes to analysis in this space. That's no different today.
Okay. I see the financials have also turned green throughout the course of the session, now sitting up about 0.5%. We are seeing, you know, among those who have reported.
Still at my resistance on the SPX.
Top movers as far as the gainers on the S&P.
I'm sorry about getting out of these trades earlier. That could have been one heck of a day right there. Yeah.
By both sides seen as leverage plays ahead of the expected talks between Presidents Trump and Xi. Samsung out with better than expected earnings guidance. Meantime, the company saying it expects to see its highest operating profit in 3 years, citing a recovery in its chip segment. Analysts crediting the higher pricing and demand for DRAM and NAND products, along with the launch of Samsung's foldable smartphone. Samsung will report full earnings at the end of the month. And the information reporting that OpenAI is working with Japan's SoftBank and its British chip designer unit ARM on the deal with Broadcom to build AI chips. OpenAI is said to be partnering with ARM to produce CPUs, which will work alongside the AI chip being developed in collaboration with Broadcom. ARM shares rallying off the back of that news. Here are where things stand in Europe. In the final hour of trading out there, we've got the FTSE just on the unchanged line to the upside right now, but we we have got the German DAX down over 1%, and the French CAC also down about 0.1%. So a bit of a mixed picture across the board out in Europe right now. Coming up, it is time for Inside Out, and we'll take a closer look at Oracle and bring you an example trade for that name when morning trade line returns here.
Hey, investors, you know the market moves, and Schwab is here to help.
It acts like it wants to break out. We're at the 200 EMA. We've been hovering up here for the last 10 minutes. On the 1 minute. Got down to 1800. The 6620s I was in. Now we're at the 22. 6650s. I didn't want to break it right yet. This is the 63 EMA and this is the 50 SMA.
Sort of run up that we've seen.
You talked about
Larry Ellison's keynote today, Larry's box office at this event, there'll be a buzz in the room. He'll do a fantastic job. But it won't just all be hype. There'll be some fundamentals, that partnership with AMD that I talked about, investing in the core infrastructure. I spent some time over dinner with some of the executives from the OCI part of the business last night. Real fundamentally different approach to how they're building and deploying that architecture. They were late to the game, and I think that's actually benefiting them. We talked about it last night, this modularity, the ability to be able to deploy these sovereign clouds into regions at a smaller footprint and be able to bring all of their service portfolio. Some of their peer group, more infrastructure, less services. Oracle, more their complete portfolio, and be able to also do that on a smaller footprint. Small technical details in how they deploy, but they make a difference. We're also going to be here, and we got a preview yesterday in the closed door analyst session around the AI data platform. Oracle's got 600 agents baked into its Fusion and NetSuite applications. We're going to see that with Cerner as well. They're going to announce today 100 partners. We're talking the likes of IBM, Accenture, PwC, and others partnering with Oracle to bring agents into that framework. So this is a real push against the agent force, particularly from people like Salesforce, and I think really cements their position as not only have they got the infrastructure, they've also got that AI framework and the ability to bring that to industry applications.
Okay, so there's a lot going for this company. I'm just wondering if you could give me a very, very quick answer on what you're hearing from your conversations about this report.
I'm watching these.
Came out of nowhere and put a lot of people on edge about seeing razor-thin cloud margin.
The SPXs, we got the 63 and the 50, and then the orb. So if it don't hold this, I might jump in and get two of them there, the 6650s. Prepare ye in the name of the Lord. And I'll have a tight stop. $4.30. We're getting real close, if we're not there yet. Randy. $4.10. Randy. Oh my, look at there. $5.30. Chart patterns, moving averages, being in the now. So that's off the 63. And you're up $240 if you got 2 of them. How do you do it? Well, it's basically, if you can count to 3, you can trade with me. I want them, 2 bits and a freebie with a tweezer bottom off the 63. So in 2 minutes it went to 530. We're at $5 a contract, $5.10, $5.20. So if you're in the trade, exit. If you're not, hold it or sell some. It's done. $5.40. Amazing grace, how sweet thou sound. Can we break this resistance, or do I sell it now? I got out at 570. It was a risk off the 63. Boom, a chicka boom, boom, boom. Oh yeah, it'll be peace in the valley for me someday. It'll be peace in the valley for me. Oh Lord, I pray. I don't know how he does it, but he does it. I woke up this morning, walked in the kitchen, warmed up the water for my coffee, and I didn't wake up a bitchin'. I looked at the charts this morning, listening to CNBC. They were talking bubble, and I thought an opportunity for me. I'm bullish at heart, straight from the start. I woke up, took a shower. It took me 1/10 of an hour. Boy, did I smell so good. How does he do it? I drink my coffee, listen to CNBC talk about a bubble. Options are at 670. Again, I sold too soon. I left $220 on the table. It's almost noon. I'm going in the kitchen to make me a hamburger with cheese and CNBC said we're in a bubble. A bubble. it's time for lunch. I jumped in it at the 63 MA. If I would listen to CNBC today, I would be thinking we're in a bubble. Buy the dip, you're hip. Never regret your trade, 'cause we're in a bubble. Whoa! Another hit record by Washboardjim, the singing day trader. I don't know how he does it. And the stock keeps going to another new high. The market keeps going and never dies. Washboardjim, the singing day trader. So I think I'm just going to have a bowl of soup instead of a hamburger. That way it's a lot easier. All I got to do is cook some toast. So I'll be right back.
As the Oak Tree founder was saying yesterday, one of the critical elements of good long-term returns is not to have any blowups.
And so you mentioned financials. Are you bullish on financials? What's your stance there? And if so, who do you like in that space?
Well, we were, for about 2 years, correctly bullish about the investment banks because I used to be an investment banker. I could see that boom coming. That boom is pretty well priced in, as you saw by the action of Goldman Sachs today. But where there's a huge opportunity, we believe, and actually the stocks are finally doing well today, is in the private equity stocks, particularly KKR, is not in the blast zone. So everybody's panicking about these bankruptcies. They're really fraud driven, not necessarily economy driven. And they've sold off all the private equity firms. And these are great companies with long-term locked up assets under management. So we're super bullish about those stocks. And like I said, today they're really working for the first time in at least 2 weeks. And we do think when they report earnings, they'll say, well, we don't really have exposure to receivables financing or asset-backed financing, which is really what blew up. They don't have significant exposure. And their core business continues to grow. And they're trading at really modest multiples for great franchises.
And how about in tech? We continue talking about how tech is one of the primary drivers here. Is there anybody you like in tech?
Well, it's a little bit of the same dynamic. We were very bullish about Broadcom for a couple years. It's pretty fully valued. It's not bubble type overvalued, but it's close to our target. But Marvell is a competitor to Broadcom, and they gave some conservative guidance. The stock got absolutely smashed. It's starting to bounce back. So we like Marvell, much more reasonable multiple. Again, back to basics, growth at a reasonable price. So we have a 120 target on Marvell, and that stock has been acting much better than it was when it bottomed out after earnings. And if you go look at the call or listen to the call, you can see that the CEO really said that they're being conservative really to protect client privacy. So we do expect strong earnings, and you've had insider buying, share repurchases. So there's some signals coming from the company that people really got too bearish about that stock.
Jay, we appreciate you being with us this morning and taking the time. That's Jay Hatfield, CEO and CIO of Infrastructure Capital Advisors. And we've got plenty more to come here on Trading 360. Next, of course, it's time for the big three. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat will go through the technicals, and Jessica Inskip will be joining us to take us through the trades for Walmart, BlackRock, and Citigroup. That's next on Trading 360 on Schwab Network.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to
Believe me,
love crawls away.
We're retesting the resistance level on the SPX right here. We're retesting, please. We're retesting the old resistance. We have a yin yang off the 200 EMA. We're retesting. Prepare ye in the name of the Lord. Jim, I thought you were going to go get lunch. Well, I was. And the best of me said, stick around for a second. That there could be a trading opportunity waiting for us. It did not hold. It did not hold. Now, we are holding the 50 SMA here. We hit it once. Will we go ahead and hold this, or I give it, the 50 SMA crossed the 63 EMA. Is that a new indicator? Is that a new indicator on the 1 minute? I could have jumped in them at $4.90, but I did not. I think I'm getting ready to belch. A small one that you could not hear. It's very unprofessional. I better put a message in here saying, where's MA? Yesterday was a Jewish holiday. Did anybody know that? We're at $4.80. We're at $4.80. Oh, there's some big old beams. So there's this chick at the IRS. She can't stand cologne or any kind of smell. It just drives her nuts. She goes into a panic attack. So I went out and I spent a couple $100 on some cologne, and I put it on, and I couldn't smell it that much. So one of the girls upstairs told me, "Man, you smell good. I could smelt the hallway down there and smelt your cologne." And I said, "Oh shit. No wonder what's her name was throwing a fit the other day." So I quit wearing the cologne. And I went out and bought me some deodorant for women that didn't smell so I could wear it, so I wouldn't have any kind of body odor. She sits at her desk and she really gets into her work. So if you even try to disturb her, she freaks out. She's one of them jittery kind. I mean, anything will set her off. And I've known her for a long time, and she just got worse about it. But she's really into her work. And if you disturb her, she goes into like shock. She gets, I don't know what it's called. You know how you get startled real bad, because she's so keyed into her job. So I got to where I just avoid her entirely. I mean, I'll walk around her, or not even try to walk by her, because I don't want to disturb her or, have her freak out. So this morning, and I've been doing it for about a month, stay away from her. I have to watch what the cleaning solutions I use, make sure that they don't smell. I mean, I go way out of my way for this girl to make her happy. She has real bad asthma, I think, or something. A lot of people think it's in her head. Because when it first started her, she'd put some kind of incense, that stinky stuff. It's just it smells like that hippie incense. She'd have that around her, and it'd just drive me nuts. I couldn't stand the smell of it. So this morning I walk in there, and nobody's there because the government shut down. She's the only one there in her section. And I avoided her like I always do, to put the chairs back after I shampooed the carpet Friday. And she jumped out of her seat. "Next time you're in here, tell me you're in here." I feel like I'm damned if I do and I'm damned if I don't kind of situation. I didn't want to go up to her and say I'm here, and have her freak out when she's glued to her computer. So I did like I always do, just kind of walk around her, and I was putting the chairs back. "I'm the only one here today. Tell me when you come in." I said, "Okay." They're at 440 right now. But you ever been around somebody like that where, this one chick that worked there, I'm watching this off the 63 again. She was a sergeant in the military, and she was huge, big old woman. Well, I wouldn't want to get in a fight with her. Ugly as a bat. And one day I cleaned off her desk, and I grabbed her keys. They looked like mine, and I put them in my pocket, just habit forming. I went home and got a call. "Jim, do you have her keys?" And I said, "No, I checked all my pockets." And then I said, "Well, I better go back and look again." And I looked in my pockets, and there they were. And she kind of intimidating in a way. Her and I didn't get along one bit. Not at all. But I just kind of ignored her and did my job. And one day I go in there and I forget to get her trash. And she comes out and grabs her little trash bag and throws it at my feet and says, "You missed my trash." I said, yeah, I guess I did, didn't I? Don't ever do that again. Stomped off. And something else come up. So I skipped her trash again. And she started screaming at me. And I looked at her and I said, you're nothing but a bitch. And 2 days later, I get a call from the head honcho at the IRS. He says, Jim, you ever thought about just jumping over the counter and just punching her right in between the eyes? I said, no, no, not really. In my mind, I did. Just give her a good smacking, you know. And about 2 weeks later, they fired her. I guess she was rude to customers too and was getting a lot of complaints. We had a little bounce off that 63. But I called her a bitch, and everybody else kind of looked around, looked, smiled at me, and patted me on the shoulder when she... You know, I've been wanting to say that to her for months, she says, one girl said. Well, I did it for you. I didn't care. I made the decision if they were going to get rid of me, they were going to get rid of me. Because I ain't going to be abused.
In the market, the equal weight index, the S&P 500 equal weight index actually did not, it failed to sustain a higher high and dropped below the 13 weekly moving average, which is just a flag of caution for me to see the next support lines. So when that happens, I like to make sure that I smooth out volatility with high quality dividends. So that's why this came into play. Now I do
this
like
girl's a smart trader.
Show impressive operational strength and capital discipline. They've got great earnings momentum. They've got attractive shareholder returns. They announced a share buyback. They increased the dividend. That dividend is supported by free cash flow. It's ever increasing from a percentage basis, and they have a lower payout ratio, which tells me that they have room for growth, which is the metrics that I look for when I'm pulling these types of screens.
I love you.
All right, Rick, so as we look at the charts, you know, we're seeing a very different pattern here in Citi's chart. Obviously, Jessica mentioned, you know, part of their broader turnaround story as well. What did the technicals show?
Well, it's kind of funny that this scan was looking for more of a high-quality dividend type name, but when you look at the chart, we doubled in 6 months from the lows to the highs.
Come real close to hitting my support.
Price growth there. We have taken a bit of a pullback now, but now we can also see 96, our green line. That was about our high point from this range here. That is about where we've stabilized after our pullback here, and we are establishing some.
Him and I are right on spot.
We are breaking out potentially.
Well, his is a little bit higher. I can see why.
Between our two lines there, starting with those highs near 105.59. So
I would have paid attention to this. I'd have took this.
Setup here because we had a strong breakout, and now we've pulled back to a prior resistance area, and so far it seems to be holding on. So is this the point where you might want to try to buy the dip in this name here? You know, that would be one thought to consider here. You could also see that we have stabilized around our orange 63-day EMA there, but we've topped out near our yellow 21-day EMA. So those come in at around 95 and 98 respectively there. So some potential technical bookends to consider. RSI has not once again exhibited quite what you would want to see like our last chart here. What you would want would be a strong price breakout to correspond with RSI breaking its trend line and breaking above the 50 midline. So momentum not really cooperating just yet here, but that remains to be seen. The day is still pretty young. Volume profile shows 95, 96 is the heavy trading area. That's about our linear regression line, our fair value line as well. So this would be a key area to hold here. This general point right here really stands out from many technical levels here. So 95, 96 is the point to watch. Volume picks up again up here near 103.
All right, Rick, right now trading about 97.38 for Citi, and as far
as
their
here we go again.
Records in their markets.
Now we're touching this the third time. So this is a triple bottom off the 63. This is where it's going to make up its mind if it wants to go ahead and dip on down or break out to a double top. So if I was to go in, I'd go in small. Once we hit that 63. Right about now. At 430, 420. I'm in it now. I'm in it now. This is a risky trade. This got to make its mind up here. I should have waited. Still bearish long as we're under the 63. God. Man, it's got a trigger finger on it like nothing I've ever seen. Gotta be something wrong with my computer or something. Oh, this is almost like a descending triangle. This is bearish. Pretty close to being bearish. Come on. Stop it. I'm feeling bearish. Got a new one here.
Of investors that are very interested in biotech, and we own multiple novel molecules, and one of them that is already in phase 1 clinical trial. And because it's showing such incredible data and has the opportunity to be life-changing in terms of its impact on patient healthcare, we wanted to find an innovative way to combine our new digital asset business line with our legacy business line of cancer research. So we have an opportunity here to bring our expertise in digital assets into the biotech side of our business and help fund it for the long term and bring it into phase 2 clinical trial.
And you mentioned that you have a goal of having your first patient dose
470.
in Q1 of 2026. So in the very, very near future, how does blockchain integration play a role in reaching that milestone?
Triple top.
The role that it plays is that right now it is very difficult to raise for biotech, and it is very easy to raise for the digital asset industry.
Good job.
With its explosive growth.
Smart. You get a triple top. You see the triple top? Now, if we break, we'll go higher. But a triple top is an exit idea. You either scale out everybody's asking the question, how does he do it? How does he do it? Golly, man, this thing's really bothering me. Uh-oh. Uh-oh. 490. Oh. How does he do it? 510. How does he do it? $570. Okay. Woo! I'm out. Jim showed up to the party and they asked the question, how does he do it? 570 and 640. God, 720. Damn it. For my name's Washboardjim. I am the founder of the Sneaky Snake Trading Strategy. God. Woo! Woo! So let's talk about this trade. I want to talk about it. Marley, shut up. So, if you can count to 3, you can trade with me. If you can count to 4, you might make a little bit more. So as we approach the 63 EMA for the 3rd time, I was saying this is going to be it's got to make up its mind. Because it's retested the 63 3 different times. So I jumped in the trade knowing that it was kind of risky. And it did drop on me a little bit. There's nothing really here. Maybe this head and shoulders right here. Yeah, the head and shoulders. I just now noticed that. So you got the left shoulder right here. And you got the right shoulder right here. Using the bodies of the candle. So it came down and touched that. Now we're coming back and we're touching support again right here. So it's making up its mind again if it wants to move back up. So we got to the triple top. And that's the strategy. Either you get out of the trade or you hold on and see if you break the triple top. So this is the sweet spot of the trade. I was also looking at almost a formation of a descending triangle, but it turned out to be a fallen wedge. This low is a little bit lower than that one, creating a fallen wedge. So on that 3rd dip, I still held the trade, and then we broke out. So to me, that was an excellent call out right there, because it's either do or die on that 3rd dip. And when you retest the 63 for the 3rd time, you don't know which way it's going to go. In this case, it did form a fallen wedge off this here inverse head and shoulders. And that right shoulder is a confirmation that it needs to go up. If not, this could fail real hard and be a drastic sell-off. So it's the 2nd time it touches that right shoulder. That's the sweet spot too. So I had 2 confirmations. 3, I had the head and shoulders, the right shoulder. 4, I had 3 black crows. I had a wedge, and I had a tweezer bottom, and I had a 1, 2, 3. So I had many confirmations. Then we came back and retested the old resistance, which was the triple top breakout. So off the 63 again with a doji. So you got a doji right here with a tweezer bottom off the 63 EMA. And the body held the 200 SMA. Does that make any sense? Somebody say yes or no. I have a yes, it does. You see how important it is to learn them candlesticks and learn chart patterns? That's why I got like a 90-95% trading rating. Most say you're good if you have a 60 to 70. And if I'd have held them 2 calls I had this morning, I'd be up $4,000 today. You understand why it comes back in whatever every breakout retest, not every, but most breakouts retest. And there you are retesting that previous resistance of the triple top. Off the 63. I mean, that's a no-brainer right there. To take the risk, not go in big, but you know, keep scalping it. So let's say you did get out early. You got out at the triple top and it breaks out. You're going, oh shit, man, I left money on the table. Well, keep in mind that every breakout pulls back and you have that second chance to get in that trade that you got out earlier. So you're still playing it safe. God, look at that. I'm yakking teaching you how to trade, and I'd have jumped in that trade. I guarantee it. I guarantee it. I guarantee I can make twice as much, 3 times as much money if I wasn't on voice. So I'm sacrificing my time for you all. That's why I want a free vacation. I'll be right back. I'm gonna go make my lunch.
And with that said, the unit economics and margins are improving overall. It's more of a pure play food delivery company outside of.
The only news I got is the fat cat's got it wrong. Beautiful squeeze, God. We might get to 66.50. We're at a resistance here, though. Man, look at that. $10.40. Again. That's another grand on the table. Make it 5,000. We're about there. I mean, we're definitely close. Inverse head and shoulder at resistance. And it almost is a triple top. I'll be right back. I gotta get away from here. I'm mad. I mean, I could be killing money.
So
But
progressively, it's moving from the bottom left to the top right. So basically, I'm going to go out to November with 38 days to expiration. I'm going to buy the 270 call, then I'm going to sell the 280 call against it. It would cost you about $5 a share or $500 a contract. So in essence, trend continuation is the objective. 275 is break even if you do hold it to expiration at 38 days. And you're outlaying basically $1 to make $1. So $5 to make $5. And that will manifest into full profit if the stock gets 280 or higher by expiration in the third week of November.
Well, George, we appreciate you walking us through that note on DoorDash and also the example trade. That's George Phillips, our senior markets correspondent. And now it's time for our 360 round. We're going to bring in our panel to discuss Albertsons earnings, posting a really impressive earnings beat in a competitive category. Shares up 12% so far. Joining us now, Arun Sundaram, the equity research analyst at CFRA Research, and Catherine Black, lead food, drug, and mass market retail at Kearney. Thank you both for being with us to talk Albertsons this morning. A good quarter for them. Catherine, we'll start with you. Just takeaways overall from their performance and their report they put out.
Yeah, look, as you say, very strong performance. And I think Albertsons, like a lot of grocers, are reporting a couple trends that we're seeing. One is strong growth in pharmacy, driven by GLP-1 and other trends. But also consumers are really price sensitive right now, and they are starting to react to the economy. And grocers are benefiting from that at the moment because dining out is prices in dining out are rising much faster than in grocery. And so I think we're seeing some trade down, and we're seeing it into e-commerce, which they definitely reported strong growth in. Other grocers have reported strong growth in. And so, great numbers from them. And I think those are two of the general trends driving it.
And Arun, before we dive into specifics, I'd love to just get your overall thoughts as well.
Yeah, I think it was a decent quarter. I wouldn't say it was a strong quarter. I think that there was a revenue and EPS beat, but I would call it more of a lower quality revenue and EPS beat. Still their core grocery business is not performing well. Volumes are down there. The reason they beat on the top line is because of stronger than expected pharmacy and digital growth or e-commerce growth, which is good, but both of those businesses carry low margins. So that's why we saw some margin pressure this quarter. And then the EPS beat, that was, I think, largely due to share buybacks. They had a really large accelerated share buyback implemented earlier this year. Today they announced another large accelerated share buyback program, and I think that's partly the reason why the shares are up over 10% this morning.
All right, Arun, so staying with you, knowing that this Kroger-Albertsons merger is finally called off after this 2-year saga that they were in, how does Albertsons' strategy change going forward now that it's going to have to operate as a standalone company, piggybacking off of what you just said, that it was an okay quarter?
Yeah, and that's exactly what's happening this year. This year is a big reinvestment year for Albertsons. They're learning to operate as a standalone company. So you're seeing heavy reinvestments in areas like higher wages, store remodels, technology expenses, things like that. And that's largely why this year earnings are expected to be depressed. This year will likely mark the third consecutive year of lower year-over-year earnings or EPS. But the expectation is that next year, 2026, is that Albertsons should get back to their long-term growth algorithm, which calls for their identical sales to grow about 2%, and then their EBITDA to grow a little bit faster than that 2%. So really, all eyes right now are on next year to see if Albertsons can get back to that growth algorithm.
And Catherine, you mentioned the importance of the GLP-1 sales, things like Ozempic for their pharmacy business, helping with their performance this quarter, but they're also hurting their margins. How sustainable is this trend for Albertsons?
Well, like every grocer is dealing, that has a big pharmacy business is dealing with this same trend. And I think Aruna's exactly right. Margin pressure is going to be the main focus over the coming year, not only because of that, but also because we're seeing inflation go up across the board. And you hear a lot of grocers talk about how they're not as impacted by tariffs and whatnot, but their suppliers are with their raw materials and whatnot. So that's a trend that we're seeing. And then the other thing is, AI, reducing expense and SG&A. You're seeing some other retailers make really aggressive moves in reshaping their SG&A. And we also anticipate that over the coming year, we're going to see a rise in agentic commerce or consumers shopping through bots, and you're seeing lots of news around that. And that really stands to also be a margin hit to a lot of retailers. So I think that is the thing to watch, and it's all of those components.
Catherine, I want to come back to that e-commerce thing, but I want to jump over to Arun for a second about margins. With margins under pressure, where can Albertsons find cost offsets or efficiency gains?
Yeah, I mean, earlier this year they did lay off about 1,000 folks in their corporate business. That's driving some SG&A savings.
Wow, that's just nuts.
3 years, they're expecting about $1.5 billion.
200% on that call.
Savings. A lot of that's going to be.
$66.50, baby. We nailed it, Rob.
Bread next year, because right now I think that the risk is they're in that core grocery business, they're losing market share to specialty grocers, to super centers like Walmart, to club stores like Costco, BJ, Sam's Club, and really those businesses, those other businesses I was talking about, they're the ones that are gaining significant market share right now. And then the upside risk is if you look at the stock, it's trading at about 9 times forward earnings. It's a huge discount to Kroger, which is trading at like 14 times forward earnings, and Walmart's around 40 times forward earnings, and Costco's like 50 times forward earnings. So the expectations are really low from investors. So I think there's upside from the multiples there. Again, it's going to be whether they can get back to earnings growth next year. And I think if they do, then multiples can also expand. And if that happens, then there could be upside to the stock.
Well, we appreciate you both being with us to walk through Albertsons earnings this morning. Right now, shares trading at $18.97, up almost 12%. on their performance during the quarter. A top and bottom line beat here. That's Arun Sundaram from CFRA Research and Catherine Black from Kearney. Thank you both again. And I want to thank all of you for joining us on Trading 360 today. I'm Marley Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. I'll be back at 3 Eastern, 2 Central with Market on Close, but Fast Market with Donnie King Hall is coming up next. Stay with us.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
Them 6650s were like 6 points out of the money.
Risk-defined way here going into earnings.
So we got a triple top here. That's where support is, right around this area. Oh man, this is perfect. I never made it. I mean, I just rave about this soup. If I ever if I ever hit the Powerball, I'm gonna open up a soup kitchen. Feed the homeless. But they're going to have to read the Bible. Hired me a good preacher. And every time they come and have soup, they're going to have to listen to a preacher talk about the Bible. Until they're converted. And then house them. It's amazing how good this shit is. That's a $300 and some trade though. Could have been 2,000.
The schedule for it. So I just think this is negotiations at the highest level. And like I said, the Trump administration believes in pressure. I think they're both countries' goal is to strike a trade deal. I think unless they're both piling up chips for the big negotiation, I think that's what you're seeing playing out. And for investors, we have to navigate these waters and understand what this is. If you get caught being whipped by rallies and sell-offs, you're not doing it right, Diane. You got to play a longer game here. Buying the dip this morning looks like the right call.
And let me ask you this: I'm glad you.
Now you say that, bald-headed eagle.
Because we're at the front end of one of the heavy parts of the earnings season with the financials in focus. So let's take those first. So you had JP Morgan Chase out, you had Citigroup out, you got Goldman Sachs out with its results, Wells Fargo, BlackRock, a slew of them. And there's really just strength across the board, especially when you think about M&A activity, IPO activity, firing on all cylinders there. This most recent quarter, the strongest quarter for IPO since 2021. Citigroup's higher right now. They had records in all their divisions, so whatever Jane Fraser is doing over there is working, right? Wells Fargo had pretty solid numbers overall, so you're seeing Wells Fargo move higher, Citigroup move higher, going under a little bit of pressure. JP Morgan Chase under some pressure, but it often sells off the back of its quarterly results. What's your take, or what trends did you notice, Tom, in these results on the banks?
Well, it's just earnings beats. That's the trend, and it's kind of reflective of what we're seeing in the economy. We talked about this yesterday before we talked about J.P. Morgan and Goldman Sachs. The fact that the environment right now for these banks has been pretty robust. You've had a steepening yield curve. You've had M&A activity pick up. You've seen IPOs start to reaccelerate throughout the year, and that's all positives for this. J.P. Morgan. A 16% increase in earnings, revenue rose 9%. You look at the investment banking side of all the businesses, especially J.P. Morgan and Goldman Sachs, those were pretty positive on that. Global banking and markets revenue surged 18% for Goldman Sachs. I mean, that's a positive. You mentioned Citigroup. Jane Fraser has done an excellent job. They're trying to divest parts of their business that aren't in growth mode, and that includes some of the overseas banks that they have partnerships with. But then the Wells Fargo numbers, if you start looking at loan growth, that was up 6%. And that was really key for Wells Fargo because that makes up a majority of their profitability on that side, even though they're starting to pull back from.
I don't know. I'm thinking about having another cup of coffee.
They have as far as mortgages goes. But you start seeing that investment.
I want to try that
from
new
the
stuff
consumer,
out.
and it doesn't really scare you off. You've got
I think I will.
Wells Fargo up 7%.
I'm going to go into the kitchen and grind up some espresso and have me a latte. I have a frother, so I'm going to froth up the cream. I'm going to have me a latte.
Remember, this stock in mid-2023 was $38. Every division saw growth.
Oh, shut up.
Now, she's been doing this for a couple of years. This is a pretty large-scale restructuring turnaround that city's going through, and they're finally starting to see the benefits.
Spy broke my resistance channel.
JP Morgan put up good numbers. I think that has a lot to do with
The new one is right here.
Goldman, a little softness, but the stock is off its lows. I think we'll get Bank of America and Morgan Stanley tomorrow, but I think Citigroup is the star here today out of banks because this turnaround pretty solid. It's a different company than it was 2 years ago. Jade Fraser deserves a lot of credit.
I think that's a great point.
Now, CNBC brought on a very skeptical. I mean, she acted like she knew what she was talking about. Some of these people are set so deep in their ways that they think like we're trading back in 1930. And she's been hypnotized about the tariffs. Tariff this, tariff that, tariff this. That this earnings are going to be affected by tariffs. This coming earnings. And again, I think she's full of bullshit. She really got me angry. The way she was jacking, I mean, just like she knew it, like kind of like Marley does sometimes. Because Marley reads analysts, what analysts say. She doesn't know what to think on her own if you asked her to. I think you become a good trader when you can figure it out on your own. You don't. I use analysts, yeah, and I do almost the opposite of everything they say. And then when some of them actually agrees with the way I'm thinking, I'm going to honor their opinion. If you know what side of the street I'm on. I'm on Wall Street, Main Street, not Wall Street.
Narcissistic Jim, with his ego and his wit, doesn't give a damn what you think of him one bit. The market takes a dip, SPX Jimmy will buy. Jimmy is grinding away on his washboard toy. Burn it up, Jim. Let it fly, let it roar, let it roar. Stocks tend to rise with a spark from his core. Narcissistic Jim doesn't care what you think. He'll work from far out loud till his room sinks. Lots of fun he had, his ego's ablaze. Burps and farts collide, the room is so unmade. Narcissistic Jim, the legend, the king, playing his old washboard till that closing bell rings. Narcissistic Jim. Narcissistic Jim. Narcissistic Jim.
Oh yeah.
I don't know if I would have believed that because, you know, you would thought that they would be a front runner, especially in terms of where we go next in the AI arms race, but it certainly hasn't been the case so far this year. Kev, let's actually talk about Micron. That's getting a downgrade today. You got New Street moving to the sidelines on this one. They're downgrading it to neutral from a buy rating. This has been an outperformer year to date, so maybe this is a valuation call. What's your take on this one, Kev?
I want to just say one thing about Salesforce because I think 3 words that will haunt people in the AI space. Failed to materialize. That's what should scare all these AI players because Salesforce put money into this and they're not showing any benefits from it. Now, let's get to Micron. Micron is doing extremely well, and this analyst note that downgraded just said they're fully valued, and the valuations, and eventually they're gonna, these margins are gonna come down, and this is not gonna be. He said they're basically at peak of what they're looking at here, and even though they're doing extremely well, the valuation has got away from them. And so here's what they use. The multiple compression is what may be the next stage for them as AI keeps going, and that is why he downgraded Micron.
Okay, yeah, so there we have it. That's a valuation call there. But what's interesting is you also have Cantor Fitzgerald out raising their price target on Micron, and they're still overweight. They're raising theirs to 240. All right, we'll bookmark this. Coming up, Bull versus Bear. The guys who get their example trades put together for AMD after it landed another win in the, you guessed it, AI arms race. We'll have more fast market after this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Shares of AMD gaining ground today after another big AI win. The chipmaker revealing a major expansion of its partnership with Oracle. Now, beginning in 2026, Oracle will start deploying 50,000 of AMD's most advanced AI chips to power what it's dubbing the world's first publicly available AI supercluster. The deal puts AMD squarely in the mix alongside NVIDIA in the race to supply chips to meet data center demand. Oracle plans to add more AMD chips in 2027 and beyond. All right, let's throw on those trading glasses now and welcome back in our co-hosts Tom White and Kevin Hings. It is bull versus bear time. All right, before we get to those example trades, we have to talk about AMD. Before the market started shaking off the back and forth between the U.S. and China, AMD was up. Ken, I'll start with you. Your take on this.
I think this is another day, another partnership announced, another deal announced. We've seen a pretty steady flow of that. I don't expect that flow to slow down at all. And the question that's lingering for traders out there is this. Can AMD do to NVIDIA what it did to Intel? Right? Can it start to compete and chip away at market share and be a true competitor? And maybe this, remember, what they did in CPUs with Intel, can they do with GPUs with NVIDIA? And if they can, then there's a great pairs trade coming here because NVIDIA, or AMD is about 1/6 the size of NVIDIA. So if they can at any point start to compete, then that makes this whole relationship really interesting. So yeah, another day, more good news from AMD. The question is it a big, remember the stock has already rallied incredible. Does it have room, does it have the ability to rally from here? Because the valuation is getting a bit pricey, Diane.
Yeah, and this is another one that is having a very different year, this year versus last year, but to the winning side for AMD. And look, some would argue that they both can be at the table, but, AMD's been trailing for NVIDIA for so long, so it needs these kind of wins. Tom, what's your take?
Yeah, this is a big win. It's not until the later stages of 2026, so you've got to keep that into context. But this comes after they announced that deal on October 6th to roll out 6 gigawatts worth of chips as part of that multi-billion-dollar, multi-year agreement with OpenAI. Also, so Lisa Su starting to get some wins here, Diane. I think that's what investors are focusing on. We're just below those all-time highs. Remember, this stock was actually lower pre-market with the overall market. It's not immune to moves before this news came out and broke this morning and now sending the stock higher. But yeah, as Kevin mentioned, getting a little bit frothy up here, but I don't think that seems to stop investors from wanting to get into this name, especially if they can compete with NVIDIA and start to take maybe some of that high-end AI chip that NVIDIA has got basically a stranglehold on about 90% of the market. If they can get into any 20, 30% within that segment, that's just a bonus for Lisa Su and AMD.
Okay, all right. So I know you guys both have example trades that you built on this one, and you made some excellent points on, one, how it's performed year to date, but, there's clearly strength to come. Tom, you want to take that first trade example?
Yeah, sure. So I'm going to look at something that's a little bit more bullish. If you think this extended run that AMD's had is going to continue, you look at the stocks up 84% this year. had that big 23% gain after that deal was announced with OpenAI on the 6th of October. Starting to get a little bit overbought. RSI is still about 71 level, but has pulled back from those peak levels. But I looked at a strategy where I can offset some of my costs on a trade like this while avoiding earnings on this one. So I went out to the October 31st weekly options that expire in just 17 days. We're going to buy an unbalanced or broken wing call butterfly to offset some of the costs, as opposed to maybe buying a bullish call vertical. We're going to use the butterfly to lower the input cost. But in that October 31st weekly options, I'm going to buy one of the 220 strike calls, sell two of the 235 strike calls, that's where you want it to go, and then buy one of the 240 strike calls. So in essence, you're buying a bullish $15 wide call vertical, selling a $5 wide call vertical with that same common strike that you sold two options on at 235. Now you're paying a debit of roughly about $450 on this trade. It's probably trading closer to $490 right now. Stock has moved higher as the market has pushed higher. But if you pay that $450 debit, there's your risk, $450 per spread. If you pay $490, whatever debit you pay is going to be your risk. If you pay $450, it takes your break even to $224.50 over the next 2.5 weeks. So you don't need a massive move on a percentage basis to get back to that 235 level where you get the apex of profitability in this one. Kevin, you look at this one, it's directional, you're offsetting some costs, it's costing you a little bit more than what we've got up here, but at the same time, it does give you that upside exposure. And hey, Kev, you only need about a 1% move to the upside to get above that break even.
Yeah, you're taking advantage of the long call vertical that's wider than the short call vertical, right? The risk is going to be the debit page. You're looking for a move towards that short strike, Tom. And then the fact that you're selling a tighter vertical than you're buying gives you that locked in profit if it were to just run. Remember, a lot of the problems with a butterfly is it runs up, and if it runs through your strike in that time, you never really get to big profitability, and then you lose all your money if it runs. If this one, because it's unbalanced, if it runs, you stay profitable, Tom.
Yeah, no, you make a good point. Even if it does go above the 240 level, yeah, you want it to be around 235, but it's still more than a double in profitability if it goes above the 240 line. So almost like a measured bullish trade. But Kevin, on the flip side, you've got something that's a little bit more neutral to bearish. Walk us through your example trade.
Yeah, it's got earnings on November 4th. So what I did, I stayed away from that, similar to what you did, October 31st, and I just sold the 240, 250 call vertical, Tom. Now, if you look at the expected move out to October 31st, about $25. So I'm about $18 above the market is my short. Can you move it up? Of course you can, but remember the trade-off is you'll collect less premium if you do that. I put this in for about 170, trading about just over $2 right now because the stock has rallied. That's why yours widened to the upside and got a little expensive. That's why you could sell this for a little higher. So selling a short call vertical, you need to move, the stock would need to move through $240, which was the old high a week or so ago. It'd have to move through that for you to lose money, Tom. So yeah, selling the upside call vertical, not a long period of time, only 17 days ahead of the earnings event, Tom.
Now let's break this one down. October 31st, same weekly cycle. So Kevin's example trade here, which is neutral to bearish, and my bullish call butterfly, both take place ahead of earnings, that event risk that's out there. So keep that in mind. Expires in 17 days. Kevin's selling the 240 strike call, buying the 250 strike call, collecting roughly $1.70 credit is what we have on the screen here in the risk profile. That's where it was trading, but now it's trading over $2 at this point. So you can get a little bit better because the stock has moved higher. But if you collect that 170 risk, you can see here the risk profile takes a break even up to 241.70 with basically if you collect the 170 risk, you got $830 in risk on this trade. If you collect that 170 credit, which is your profitability, got a lot of risk on this one, Diane, but at the same time, in Kevin's example, got that better probability of success than the call butterfly that I looked at, because that short 240 strike in the October 31st weekly options, about 73% probability of finishing out of the money. So those are those trade-offs, Diane, that we talk about when you're risking more than what you can make on the short call vertical.
And what I like about your example trades today is that you guys really did take, two ends of the coin here. This was a true bull versus bear. I know there's some neutral tilt to some of this, but I like it. Good stuff, guys. Coming up, we've got cash tags. The team from Lightfolio will be along with sentiment data on Carvana. That stock has been a big outperformer year to date. Can the momentum continue? We're about 2 weeks away from its earnings. Keep it right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by giving you even more specialized trading
eyes.
Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand.
18 bucks.
Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming
660s are 406 now.
Anywhere at schwabnetwork.com.
From 70.
Welcome back to Fast Market here
From
on
65.
Diane King alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, we want to bring in our next guest, and that is Landon Swan, co-founder of Lightfolio.
Got my latte.
Today with the latest sentiment data on Carvana. Listen, Carvana has had a really strong year, and I was looking at a chart where you go back to 2023, 2022-ish, where they had, really difficult time, and they have had, it's been quite the comeback story. I know Tom has used the platform, but Landon, let's jump into your data and talk to us about the trends that you're seeing. Is the momentum still on the side of Carvana?
Yeah, I mean, this is a wild story for this company. I mean, they basically sold off to near nothing. And somewhere out there, there's someone who bought shares at $4 3 years ago and rode this thing all the way up to 400, and it's holding at 340 now and is very, very happy. So this is quite a comeback story for Carvana, and it really comes down to their approach. CarMax really shook up the used car business by making it very simple and no haggling, and they give you you can have a 7-day return policy, all kinds of things. The CarMax really did a great job. Then, years later, Carvana stepped in and said, you know what, we're going to do everything digital, online. Shop for a car, buy for a car, sell yours even online. And it's just the way of the world. And frankly, it's a big leap, when it comes to used cars. I remember the first time I bought a new vehicle online, sight unseen, and I was like, all right, I hope it's okay, right? Like, I didn't test drive it, I just got it. I can't imagine the process for a used car but people are very happy with it. They're doing it, and I think it's a key is that there's
with a huge markup
problem when you buy from Carvana online. You're not going to get a lemon, or if you do, they'll take care of it. So they're a reputable company. The happiness is extremely high compared to CarMax, and when you compare the two on a web visits basis, you know, which is very indicative of consumer interest, CarMax is down about 12 points year over year, whereas Carvana is up 18 points year over year. I mean, this is CarMax again. They shook it up. They changed the model. They were the leader. They're still the leader, but Carvana is absolutely taking over. I mean, they are taking market share continually every single quarter. I don't think it'll be long before they pass them as the #1 used car dealer. I mean, you just look at last quarter, their quarterly revenue was up 42% year over year. Their earnings per share were 14 cents a year ago. It was $1.28 this year. I mean, they are just doing all kinds of things right. The only, I guess, negative that we've seen, they had the insider selling by the CEO, which you never want to see. That helped, along with a little bit of a market sell-off, that helped move the stock from 400 down to 340. But all the data that we have is very, very bullish on them. High consumer happiness, very high web interest, consumer purchase intent, especially compared to the competition. So I more see this pullback as a buying opportunity than anything. I love, you know, I thought it was decent at 400, maybe okay at 380, but I like it a lot at 340. And you can see here on the chart that the dotted line is the stock price, the blue line, the solid blue line is our data. So we think all-time highs are justified right now, and so this pullback again is a very strong buy signal for me.
Landon, you know, your data kind of set the tone after they went almost bankrupt a couple of years ago. But the question that I have is, if you look at CarMax's recent earnings, they said that they had to ramp up maybe some of their loan losses, right? And then Tricolor, that subprime auto lender, going bankrupt. Are there any concerns here? Because I know from your data previously that CarMax or Carvana actually makes a lot more money per car that they sell than CarMax does. And it's not by a small margin, it's by a lot margin. Is that a concern moving forward, that the consumer getting stretched here, you know, might eat into some of their business? Because there's always been questions about Carvana's financing arm, which I believe maybe, I think it's Dad's part of it. I'm not sure, the owner of Carvana. I'm not sure the entire story, but is that a concern according to your data?
Yeah, I think that there's been a sort of a history of head scratching with this company because of the turnaround that they made and some of the numbers that they posted. For a long time, you know, there was a lot of doubt as to the authenticity or how real the numbers were. But they continue to print and they continue to get it done at 12% margins. They're definitely doing things way more efficiently. And the thing is, it's not that they're selling a vehicle that's more luxury than the ones at CarMax, and that's why they have the higher margins. No, they're actually coming in cheaper for the same car. They're just doing things more efficiently. They're buying them cheaper, they're selling them cheaper, and all the process in the middle is just far more efficient. So this is kind of a story of the better mousetrap, where Carvana has figured out how to be far more efficient than CarMax, and it really makes sense. I mean, if you look at a lot full of cars with 1,000 cars or 500 cars and 25 salesmen working, that's the CarMax model, whereas the Carvana model is mostly a website. I mean, which one of those is going to be more efficient? So that's how they're able to get those margins. And yeah, I mean, you look at what happened with CarMax. Their sales are down 4%, their net income is down 28%, demand's down, margins down, everything's going the wrong way. Whereas with Carvana, it's going the right way. So this is just the more efficient company eating the lunch of the slower, less efficient company, which is, again, wild because this is a business cycle thing. I mean, this should be in business classes. The CarMax reinvented things, but now they're kind of the dinosaur, and Carvana is now reinventing things. And so they're kind of taking over. I would say that just the general market, as you talked about, used car prices slipped about 0.2% in September. They're still up about 2% year over year, so they're not in a bad spot. I do worry a little bit about tariffs that could add some cost to cars, and that could squeeze the consumer a little bit more. And of course, that's going to hurt margins. It's going to hurt demand, no matter what, no matter which company you are. But if you're neutral at all on the economy, I think Carvana over CarMax is the clear bet, especially with this pullback right now.
Landon, I'm so glad that Tom brought up that point, because earlier this year, there was I can't think of the term for the opposite
Winning.
of effect around Carvana because of that, Hindenburg.
Jimmy is winning. MJ Trader.
Significantly, and the fact that they're able to get so much more per car than the traditional companies is really mind-blowing. And I think that's what's really throwing everyone off, is like, how can you do this when no one has ever done it before? And I think, if you look for the logical answer, it's going to be efficiency, and that's what they do. The fact that you can go online and buy a car and get it delivered same day, and you can sell a car just as easily. It's just incredible what they're able to do. Again, it's a leap for me. I haven't done that with a used car yet. I did it with a new car, but we'll see. But yeah, overall, very positive on this company. And with the significant decline, 15% off of highs, I think. That's a pretty good spot to jump into this one, because the data on our end, again, what we can see, consumer demand, consumer happiness, basically all-time highs, very, very high for Carvana.
Tom, I don't know if you had a follow, but okay, we'll leave it there for today. Great conversation.
I don't think nobody's listening to you, old man.
Data. That's Landon Swan, co-founder of Lightfolio. So great perspective there. I know you have personal experience as well with Carvana. I checked it out, and I was, that was one of the places I was searching for a vehicle myself, and thought about that, but I did still like the idea of test driving a vehicle in person. But let's talk the trading perspective on all things Carvana. Let's bring Kevin back in here. Kevin, I know you've got the example trade. We've got a lot of insights from the Lightfolio team. Quick thought from you before we get to that example trade.
Yeah, what Carvana's been able to do, what do you compare it to, right? CarMax was first in the used car business like this, much like iTunes was first. But here comes Spotify, that's basically made iTunes irrelevant. That it looks like Carvana is slowly but surely making CarMax irrelevant. It's amazing story about, and what's the difference? Probably humans, right? The fact that they're doing it online versus human and salesman and the human element, it's probably what allows them to do it for bigger margins. So based on that, and I like the fact that Landon brought up that the stock had sold off from its recent highs. It got as high as $413. Now it's, in the right around 340. So what I looked at here was something very similar to what Tom did at AMD, the unbalanced butterfly, where you buy a bigger vertical than the vertical that you're selling in the butterfly. So I went out to November 7th. This is after their earnings release. Their earnings release is on
SPX is hitting yesterday's high.
After, so this move,
the SPX is hitting yesterday's high.
Event in it. So what I did is I went and bought the 340 call, which if you look right at the money, it's trading 339 and change. I bought the 340 call, sold the 390 call, so a $50 wide call vertical, and then against that, sold the 390 400 call vertical, so a $50 long call vertical financed by a $10 short call vertical. And so I put that in around $15.90, trading about just over $17 now. So it's already moved to the upside here. So this is a bullish play, but still, even at $17, it's still a triple if you get this to move towards the 390 strike, guys.
Take over here, Kev. Yeah, it is the same setup as my unbalanced broken wing call butterfly that we had in AMD, but let's walk you through it. November 7th weekly options. So right now, tentatively, they're scheduled to report on, as Kevin mentioned, on the 29th. So this will capture any potential catalyst from that, as opposed to the one that we looked at in AMD, which avoids earnings. So this captures earnings. So if you think it's going to rebound, it's down about 17% from those all-time highs that we saw just about a month and a half ago. Buying one of the 340 calls, selling two of the 390 calls, buying one of the 400 strike calls on this unbalanced or broken wing call butterfly. Paying roughly $15.90 debits, what we got up there, just like Kevin said. It's trading over 17 bucks right now. So the debit you pay is going to be a risk. So if you pay just under 16 bucks, you got just under $1,600 in risk. If you pay $1,700, got $17, you got to pay $1,700 in risk, but with the expectation that it's going to grind back towards 390. You've got 3.5 weeks in this position. Kev, real quick here before I let you go. This is one of those trades we talk about butterflies. They don't expand until later on, but even if this thing rallies above 400, as you mentioned, it's more than a double in profitability, even if it does continue to spark to the upside.
And here's one thing for our viewers. The butterfly, the unbalanced butterfly costs you right around $17. If you just bought the 390 call vertical, about $19.50. So you're saving over $2 in terms of the net debit that you pay by doing the butterfly versus just the call vertical. Now maybe you want to just do the call vertical, but that would cost you about $2 more, Tom. So that's the way you chip away at that net debit. And when you chip away at the net debit, you chip away at the break even, Tom.
All right, good stuff there, guys. That's an example trade there in Carvana. Coming up to break down, we'll be taking a look at ASML ahead of its earnings. Those are due on Wednesday. We will be right back after this break.
$26.20. Woo! Do 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 do. Man, that was good. I need to make more of them. Do 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 do.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Schwab Network. Diane King Hall here at the New York Stock Exchange. We have some breaking news on the Fed front. Federal Reserve Chair Jerome Powell speaking at the National Association for Business Economics in Philadelphia. He talked about normalizing the balance sheet, and he said it doesn't mean going back to the balance sheet before the pandemic. As far as what the markets will really be paying attention to, employment and inflation. He talked about the outlook for that. He said based on the data that they do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since the September meeting 4 weeks ago. So in other words, that reinforces the odds that have been increasing, or the odds that are in the camp that we will see a rate cut this month. He said, though, that pre-shutdown data shows that growth could be a bit stronger than expected. So that's a little bit of a
Pow.
there. He talked about the policy shift toward neutral, and that the Fed's September rate cut reflected a move closer to a neutral stance.
He's so full of shit.
Downside risk to job marketing.
This guy is so full of crap. We could do without the Fed. We can just do without them. You know what I'm saying? Just leave the market at a certain percentage rate and leave it the frick alone. And I say, keep it at inflation rate, which is about 3%. And just leave it there and don't touch it ever again. And get the government spending down. I mean, what the Democrats did the last 4 years with all them illegal immigrants, costing us trillions of dollars in unfunded liabilities. Trillions. We can't afford that. I can't stand the fact that they're getting all that free stuff and they've not even worked in this country. Give it to the ones like me that have worked most of my life. I mean, I started working when I was 7 years old. And I'm constantly bombarded paying higher taxes. None of it makes sense to me. We just got new highs here.
Kevin, I think it's you who has the example trade in this one, right? Tom, you've got the example trade in this one.
Yeah, I got it. I'll take it here. Yeah, this is one of those stocks that fell 11% after earnings last quarter just because they couldn't give a good picture on 2026. So their guidance was a little bit weak. And this is based on the fact that, hey, they need those rare earth metals out of China. There might have some friction there. And then on the other side, Intel and Samsung, their best customers, they've actually shown some really good response on demand for these lithography machines that make these high-end chips. So kind of bifurcating. So I looked at a strategy that just takes advantage of higher implied volatility going into this earnings report. This will happen about midnight Central Time when they release. Remember, they are a European company. Plus or minus $70 move in the stock is what the option market's pricing in. So I just looked at something really short term. If you think it's going to consolidate post earnings, this takes advantage of that high implied volatility, allows you to collect more option premium. So October 17th, we're going to sell the 910 strike put out of the money to the downside. Buy the 905 put. So a short $5 wide put vertical, and then pair that with a short 1040 call, long 1045 call, short $5 wide out of the money call vertical. You're going to collect roughly about a 220 credit. That's what you can make on this, 220 bucks with $280 in risk on this trade, but that's outside the break evens of below 907.80 or above 1040.220 on this neutral strategy, Kevin. You know, it's a high price stock. It's $909 stock.
I'm saying puts.
Plus or minus $70 move. This is almost about that one standard deviation. But Kevin, you need some consolidation, right?
Exactly right. You're looking at about a $70 expected move, Tom. If you look at your short strikes, they're about $130 apart. So there you have it. You're just inside.
There you have it.
Move on each way. And what you're looking for, you're taking advantage of the high implied volatility, hoping for a range bound move. You got a pretty good range to deal with, and you want time to pass, implied volatility to come down, and the stock to stay at or near or in between those short strikes, Tom.
And what you don't want is more than one standard deviation move. You don't want it with one of those outsized move. If you look at implied volatility in the near-term options that we're selling in this, about 106% on aggregate. The next option series down to 71%. So it's reflective of that higher implied volatility on this. The idea is the stock opens up between those break evens and you get to buy it back cheaper at a cheaper price because it's positive time decay or theta. And if volatility falls, that's also going to contract the price of this four-legged short iron condor neutral. No bull, no bear. You just want some consolidation on this one, Diane.
And a great point that you made there, Tom. It ain't cheap at $990 per share for that one. All right, that's going to do it for us today on Fast Market. I'm Diane King Hall alongside Kevin Hinks and Tom White. Download the Schwab Network app. It's available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing.
Yeah. There it is.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Petalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn alongside Alex Coffey, and markets are fairly mixed actually, with the NASDAQ being our only laggard at the moment, with actually outside of some of the choppiness, and I would say mixed picture from tech today. We're having a pretty solid session. S&Ps are a little unchanged, up about 0.2%, but decent pop today in the Dow and the Russell, Alex.
Would you believe me if I told you 70% of the NASDAQ 100 components are higher, and let's call it 75% of the S&P components are higher? This is really a mega cap tech driven sell-off, and when you look at today's session, really it's Mag 7 dragging on the index. Now earlier, what is now a 0.6% decline in sort of the Mag 7 subsector, if you were to index those names, was closer to 2.2%. So certainly pair those losses, as the other 493 though are largely driving today's ship. Big drag, of course, when you have those big names weighing on things, Jenny, but for the most part, this has quietly turned into a powerful session under the surface, just masked by some big mega cap hyperscaler weakness.
I know, and I think that that is so well illustrated by the fact that tech sector is our only sector that's actually lower today. So, I mean, like, a great illustration is, I think, the heat map, because you can see how much green we're actually still seeing, but just...
And it didn't start this way, though. I think that's important to note. When we were down 80, 90 points near the lows of the session, it was a lot more red on this screen. It was bright red.
It was, but I think like the great power of being able to visualize, you can see, I mean, obviously the outsized performance or underperformance, frankly, of some of the largest names, the heavyweight tech names, which are pretty much all lower across the board. I know there's a few green in there, but a day of weakness for our tech heavyweights. But outside of that, there's a lot of winners to parse through. So we'll go through some of those winners throughout the next hour. We'll kick things off with some names exposed to tech that are seeing some nice sessions today, actually. Well, fairly mixed again as far as the tech picture is concerned. But a name that is actually taking off today would be our FOMO candidate, which is Domino's, which is now up 4% on a decent report on, honestly. So signaling that their turnaround effort right now has some real legs. We'll also be looking at sort of earnings season expectations as we are now in the full swing of things. And we'll close things out with a big winner of the day. That is Albertsons, of course, the grocery store chain, which is now up 11.9%. So basically call it 12% after seeing a really nice outlook. They're able to lift, actually, driven by some private label push that has boosted their sales. So a discretionary picture today, but actually everything from a discretionary standpoint, after being one of the worst performing sectors last week, is doing quite well today.
Yeah, outside of some isolated pockets of IT and mega cap tech, this is a nice session, and it's illustrated and highlighted by a lot of those things that we're going to talk about throughout the show. But we got to start in this hyperscaler build out. I think this is another example, Jenny, this AMD story as we kick things off for our movers, of what's good for one, not necessarily good for all. As you see pressure at Broadcom, you see certainly pressure at NVIDIA, but AMD perhaps winning some market share of 3%.
I know, and AMD is one that continues to be, I mean, a huge surprising name to the upside, as we're now up 82% on the year. I mean, this now makes it one of the S&P 500's best performers year to date, but another 38% in just the last 2 or so weeks, and another 3.7% on this week, up another 3% today. And this was the name I was like, well, we're talking tech, but it's not all bad, because obviously AMD is still a huge component of the overall tech sector and the overall tech trade. So lots of news today. The biggest, I'd say, sort of headline driving piece of news is Oracle's deploying roughly 50,000 AI chips that are from AMD. The stock is obviously jumping as a result. And also we're seeing, I mean, continuous, I'd say, partnerships strengthening the bullish case behind AMD. And that also speaks to Wolf Research with an upgrade today to outperform from Pure Perform with a $300 price target as part of their broader third quarter preview for the semiconductor industry. Following their OpenAI win, of course, early last week, they do now see a $10 plus really a benefit in earnings per share power for AMD, as the company now simply needs to execute. And estimates have upside if they find traction beyond OpenAI, which I think is really fitting, because now we see this pretty major contract with Oracle.
Yeah, and so this Oracle deal, if you were just to look at AMD and Oracle, and then you kind of looked at, hey, what are the impacts on the S&P 500, just those two stocks? AMD is contributing about 1.2 points to the upside. Oracle is contributing 1.2 points to the downside. But that's not the only thing that's going on today. You also have Broadcom down by $8.50. That would be equivalent to just under 5 points to the downside in the S&P 500. And then, of course, NVIDIA down $5 is almost 15 points. So it's a net story that's resulting in about 1920 just from those four names. And of course, that's not the only thing going on. But if you looked at it sort of in that vacuum, this story isn't net positive for the market if you just looked at those names.
That is very true. And actually, to speak to the other side of the price activity today, which is, as we keep mentioning, Broadcom yesterday with a huge jump to the upside, up 10%, I believe, is where roughly we closed on the session. As now we're giving back some of that strength from yesterday. So this, I feel like, is a bit more of like the rally taking a bit of a pause after you have a company as big as Broadcom has become, gaining 10% in one single session. I mean, that's a huge move. And we're still off of highs by now, about 6.9%, so roughly 7% we'll call it. But we're seeing a lot of analyst commentary, and a lot of it surrounding that OpenAI announcement. Morgan Stanley was a note that I saw earlier today. Broadcom's, their collaboration, they said, with Microsoft's backed OpenAI to develop that 10 gigawatt AI accelerator power is a momentum with some of their key customers, and unlocks the potential to really benefit from AI hardware's broader ecosystem diversification. So they did say that this new Broadcom announcement is certainly positive, but they believe this might be a case of the rising tide versus a major strategic ecosystem shift away from, say, NVIDIA was who they specifically called out. So that was one way of thinking. We also did see UBS raise its price target to $415. Citigroup also conveniently so raising their price target to $415. Morgan Stanley with a $409 price target.
You know, I love that there are analysts that are pointing to, hey, maybe this can still be positive for all of them, because the market's not trading it that way. And I think that's an important thing. If you see opportunity in these pullbacks because of good news for a competitor or a peer in the industry, perhaps it is opportunity. But when you look at Broadcom, surprisingly, this is actually a name that's up 3.5% over the last week, even after Friday's sell-off, even after some weakness today. You can't say the same about NVIDIA. You could say the same for AMD, of course, after its historic jump. The NASDAQ 100 itself is down about 0.5% over the last 5 sessions. So Broadcom's certainly an outperformer on that shorter time frame. Over the last month, though, a little bit more sideways to lower. It's down about 4%. So we'll see if this is just a consolidation period as it works its way back to the highs, or if we're starting to see a little bit of market saturation when it comes to how the market digests these headlines and is able to say, hey, what's good for XYZ, or I guess you can't say XYZ anymore since that's Square, A, B, C, D, E, F, G stock versus, stock 1, 2, 3. Is it good for both or is it good for one?
Okay, yeah, then that's a very good point. And I think that right now following a lot of these companies and these major developments is huge, yes, but like what do they actually mean for the company? What do they actually do to translate into that earnings power?
Net new. And this is what we discussed yesterday, where it's just like, hey, if I already have a huge working relationship with a company, and then I suddenly I announce this other new deal, and that new deal's specific goal is to do things more efficiently and save costs. Like, is that actually good for my business? Maybe, but maybe it has sort of downstream effects where it isn't great for other businesses that are working in that same space. So there's a lot of unanswered questions. I think the market is constantly wrestling this idea right now. And the reason that is because these stocks have had monstrous runs. Like, at some point, there's just not going to be enough growth to sustain the rally. I don't know that we're there yet, but those are the questions the market's asking.
Those are definitely the questions the market's asking. That's why I think CapEx, as far as guidance for this quarter, will be so critical for these tech names. But outside of the world of tech, we're going back actually to the staples, although I don't even know if you could consider Walmart a true staple. I never really have. I know they're up 4.4% today. A new all-time high, actually, was touched earlier today at 106.81 a share. So we've pulled back. I mean, we're pretty much at those levels right now, which is frankly impressive. But all that to be said, talk about other partnerships that we're seeing with OpenAI, as Walmart has now joined the latest string of companies. I mean, the growing roster, frankly, with deals with OpenAI. Walmart is now adding to the startups really growing list of partnerships as it does further this agentic commerce strategy. But users for Walmart will soon be able to shop and buy products from Walmart directly on ChatGPT's platform, in addition to those from Etsy sellers in the US. Over 1 million Shopify merchants like the Glossier, Skims, Spanx, and Vuoris are also coming soon, but OpenAI announced this in a blog post earlier this month. But Walmart did say the nature of e-commerce shopping experiences is about to change. There's going to be a major shift in your commerce experience. This was actually really read through the previous Amazon Prime Day, which I believe was like midsummer July, around that time, where they even said they were seeing a major way with the way that consumers shop using these AI tools. I'm not sure it like gets you to spend more money, frankly. I have used AI to try to find like various specific products, but it's definitely being seen as a win for Walmart stock today, at least.
Yeah, this will be one of those things like, maybe frame me as a skeptic at the moment, but, we were excited, the market was excited about VR headsets. It was excited about every time you announced a new electric vehicle or, Beyond Meat or
like
cannabis or, blockchain iced tea or, you start thinking about all these different hype cycles and all these different things. And some of them are big time winners and huge, disruptive technologies. And others are, maybe not. And, I don't know that ChatGPT itself, obviously I think that it's clearly a disruptive technology. We'll see if this is ultimately a use case for it. That said, I think Walmart's a clear example. I've talked a lot about how utilities are serving almost this barbell-like approach where they have a defensive element to them. They're typically lower beta. They have, solid, consistent revenue streams. They're income-generating stocks for many portfolios through the forms of dividends, and they act defensively as a result. They have correlation to interest rates, which typically go down in tougher times. But at the same time, with this huge power build-out of AI hyperscalers, they're serving as sort of a growth element too in the case of utilities. Walmart is the same. It has a core business that is hyper defensive and stable, but at the same time, you start thinking about what can AI effectively do right now? Not just these chat bots that don't generate any money, that cost a ton of money to run in research, but it can help you catalog millions of items that you're selling. It can help cut out busy work and do so in kind of an air-free, efficient way. Well, Walmart is the exact kind of company that can benefit from using AI in sort of these tedious, sort of mechanical ways whether that's in the warehouse, having, you know, an autonomous forklift, you know, make the workplace a little bit more safer, eliminate jobs that way. So in my mind, this is both a defensive company and an AI growth company, but I'm not sure a partnership on ChatGPT's platform to buy stuff is exactly how it's an AI company.
I completely agree with you.
It reads cool, though.
It does read cool, and that's, I think it's going to be like the latest, we had for a long time an NFT type of boom where we saw all this hype around anytime you could tack on like the words blockchain, NFT. I mean, like you just went through all those examples.
I think a better one is probably the VR headsets where it's like, you know, some things just don't land, right? Like some things just aren't the product that the designer hopes they are, and you can't know that the iPhone was going to just completely revolutionize the world, but it did. And hey, maybe this does completely upend how commerce is done in the US and worldwide, but I'm just not seeing it yet.
You need a proof of concept, and I think that's very fair to continue.
I will say, I salute Walmart and these companies for partnering and trying it, because the only way you know is by trying it.
It's true, and I think, frankly, from like I shop at Walmart. I also use ChatGPT. I don't really know how necessarily the entity becomes so much one force, but I do know that right now it feels like everything you watch, every type of ad you see is so targeted to you, and that, I mean, is a good or bad thing, powered, I'm sure, by the AI.
As a consumer, all we can hope for is options and choice, and if I want to use, you know, ChatGPT or Grok or whatever these platforms are to do this, and they give me that option to do it, awesome. But I also need to just be able to do it the other way too.
I think a very good point. And last but not least here, we're going back to more of our consumer-facing type of names as we're looking at now DoorDash. And DoorDash is one that has also been on a really nice run. We're up 62% this year. We're also up modestly about 0.6% today. And continuing to be such a force in the world of food and broader grocery delivery is now, I will say, DoorDash has so many interesting partnerships. Like, you can get things delivered from Home Depot, Lowe's. I know that's where like my interest goes, because I think it's amazing the way you can get anything delivered via DoorDash now. But price target today raised to $325 at JP Morgan, as they did also upgrade shares to overweight. And another pretty strong day. I mean, we're off of highs by about 3.5%, off of lows by 92% for DoorDash, which has continued to impress. I mean, the street, frankly, 200 and 50-day moving averages, both significantly still pointing to the upside.
And so this, I'm going to go back to last week. So last week, DoorDash announced this partnership for robotics and autonomous delivery with this company called Serve. Look, today, this technology is not there. But how does it get to where they see it? You have to start trying it. You have to start doing pilots. You have to start figuring out, okay, if we implement this technology, what are our speed bumps? What are our hiccups? What goes wrong? And how can we fix it? And the only way to do that is to start doing it. So it's one of those situations where at first it's not going to be a net positive. It's going to be a drag. It's going to cost money. Probably going to be more expensive. It's going to be a lot more expensive than just, you know, paying people to do it. But eventually the goal is it replaces the people altogether. It's more efficient. It's safer. It's cheaper. It's just not there yet.
I completely agree, and I think, hey, DoorDash is definitely also a place in my own wallet, my own spending as it stands right now, but with some of these developments, I think need to see how this further does continue to evolve.
Have you had any of the AI deliveries yet?
I have, and I love it. Because now I'm like a nerd about all things AI.
So how does I know we don't want to spend, but like, do you actually interact with the device, or does it take it out, leave, and you see it driving down the street?
No, you do have to interact with the device. You have to go up to it, and you have like a code, so not anyone can just like break into it, I'm assuming, and it just like hands you your order, and then it drives away. It's kind of amazing. I mean, I'm not sure.
R2D2.
I know, and I'm not sure. Like, I'm trying to imagine a world where these are flooding the streets. I don't really see that happening, but again, not a good thing for jobs, a great thing for consumers, because I do love interacting with those like robot type things. So definitely look out for that on DoorDash. But we'll leave it there for the top of our show today. Coming up next, though, time to look at two names with earnings out tomorrow before the open. We are talking the Dutch chip maker, that being ASML, as well as Bank of America, following a string of pretty strong financial reports from the major banks.
We bounced off the 63 here.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing
Technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time to dive into the technical latest with our chart master, of course, Rick Ducat, lead markets technician for the network. Rick, we're talking ASML and Bank of America, both pre-earnings movers or pre-earnings looks at these names. ASML, though, was one that just collapsed after earnings last report. And I remember it was also a bit volatile the report before. So walk us through what we're seeing here, because it's been in a pretty nice recovery since we saw its numbers reported last.
Yeah, and a quick recovery too. So we did hit a low point here around 935, our green line. But you could also say that the high point that's important to us for our current price situation here is about at 1001. That's the low point before we had our notable gap down. That's about where we topped out to previously. So 935 to 1001, pretty large price range here. But you know, this is a situation where we've had our downside breakout from our channel. We've pulled back to this old supportive area. You can see here, this was around where we had another gap form as well. So 877 was the starting point for the previous leg up there as well. So a chart that's had some pretty strong, pretty rapid growth here in a fairly short time. So if we were to look at some of our other studies, our moving averages, our 21-day exponential moving average here in yellow comes in at 952. That's about the closest commonly used one. We can see our RSI study, our measure of momentum, has also fallen off, but we're seeing a bit of a mismatch here. On one hand, we saw that there was a bit of a divergence here in the RSI versus price. Price was trending upward, RSI was trending downward, suggesting the pace of the gains was slowing, and we also dropped out of the overbought area, that threshold above 70. So now we have a bit of a mismatch, as I said here, because now the RSI trend line is being broken. It's pushing to the upside here, and price has not really made a corresponding breakout the same way quite as much. So you could argue that we have this very short-term trend line right here, but really the gap level would be more significant, I would say. So if we were to look at our other studies here, volume profile shows that there was a pocket of trading activity here near around 970. Our +2 standard deviation channel also comes in right around 980. So this could be another resistance area potentially here. Our +3 channel pretty close to those highs near 1059. To the downside though, 935 green line supportive area. That's the one that still stands out. That's nearest to closest price, our current prices.
Okay, and a name that is still hanging on to a modest lift. So again, not all of tech is seeing this mass weakness today, although I know we're not necessarily breaking out to the upside to the same extent as some of the other names outside of tech, but still a decent session for ASML today. So appreciate that breakdown, Rick. And now as we do look to ASML for example purposes, Alex, and of course trading this name, how do you think about things given the fact that we've seen some volatility on the back of earnings events just this year?
Yeah, if you look at where the lows were just in the last move lower, it's somewhere around in the 930s. And so say you think that could act as a support. I look at the 930, 925 put vertical for this week's expiration. It's neutral to bullish. This has been a space that has worked, whether it's ASML or its peers in terms of semiconductors and the build out around AI. If you believe their earnings are still going to be powerful enough to continue the rally, then neutral to bullish may make sense. But say you look at those strikes that I discussed, the 930, 925 for this week's expiration, you were able to get a $1.50 credit. That would be 30 cents for every dollar of risk. Creates a risk profile elongated Z with a max profit of 150, max loss of 350, and that break-even point there, Jenny, of 928.50. So you got some cushion. But as we know, this is a stock that can move quite a bit, and if they do have something that kind of, rattles the market in some way or disappoints the market in some way, it's certainly possible it can make a dramatic move, and that's why the risk definition is so important.
Yeah, definitely, especially because, again, we have seen some outsized move performances from ASML. So now entirely shifting gears, a name that has been more steady on the back of its earnings, that being Bank of America, which I believe is the second largest U.S. bank, just behind JP Morgan, but it's still a massive company, a great read on the broader strength of the financials from the broader U.S. consumer. All that to be said, we've gotten some pretty good results already. So we're up now 3%, still have earnings ahead. Rick, what are you watching for here?
So this is a good chart that gives kind of a case study of how old support can become new resistance and vice versa. You can see pretty clearly here we had this double top type of price activity here, but then the corresponding low points after the breakout lined up right around that same area. So 45 to the downside was one area of interest here. Then to the upside, we topped out near 49 twice. We had our breakout to the upside, and then we found support at that same level once again here. So for a while, 45 to 49 was the area to watch. Now we've kind of climbed the next stair step to the upside here. Now we have 49 and perhaps 51 to watch out for. We did have a breakout to the upside once again, but it was relatively short-lived here. Now I also kind of wonder if we could see perhaps a head and shoulders type pattern shaping up here with our neckline near that 49 level here. So look to see if we do have price surge back up to 51, and that would be the kind of inflection point there if you would be looking for the decline in that more bearish pattern here. Certainly not a guarantee that it's going to happen or anything. These patterns are just common setups that people can be on the lookout for. For our next chart here, kind of looking at RSI, we can see that our momentum indicator has crossed above our downward sloping trend line, but we've also stopped short at that 50 midline. So not really a convincing breakout above that dividing line between bearish and bullish momentum. We can also see that price still kind of within this range here. We have taken out our orange 63-day exponential moving average, but now we have stopped short at the yellow 21-day. That comes in right around 50, just above the 50 level there. Finally, when we look at volume profile, the heavy trading area that's closest to where we are now, right around here near 50. So you can see we have that spike on our blue bar graph on the right side of the screen. The point of control down here near 47, that's the very heavy trading area. That would be a significant potential supportive consolidative zone if price were to retreat. But to the upside, a small pocket of volume here once again near 52, but that's also where we find our +1 standard deviation channel. So once we start getting to that level near 52, that's when price will be starting to get relatively extreme based on its own history.
Yeah, and I would also say another name that is, seeing this outsized performance, trading in step with the broader financial sector today, but one that also does have a lot of hurdles still to clear by itself. So appreciate it to Rick for that technical help, as always, helping us look at some of the key price levels into earnings. And so now Bank of America, it's making a move like it already had its report.
Well, this is exactly what I was going to highlight. In many ways, these banks have more in common than they have differences. And so given the fact that we've already gotten reports from 4 of them, perhaps you have a situation where maybe the response isn't going to be that dramatic. So it's a neutral strategy, somewhat selling options premium that's still elevated going into this result using an iron butterfly spread. It's risk defined. Right now the stock's trading around 50. Looking at selling the 50 straddle, $3 wide wings, and collecting a $1.70 credit here. Max profit would be 170. Now, the likelihood of actually capturing that full max profit is not very likely. You'd have to have the stock perfectly pin at 50 and stay there through the expiration at the end of the week.
SPX double top, yay.
Of scenarios, but it does cast a net, and the closer it is to 50,
it's that
the
time of
bigger
day.
the profitability can be. So as you see over my shoulder here, it's sort of a pyramid-shaped risk.
I don't want to look over your shoulder, man.
closer to that max profit, which corresponds to that credit received. Break evens though, subtract and add that $1.70, you get 48.30 and 50.
Call, put. What do we got here? Iron Condor.
Outside your long strikes, so that'd be like a 6% move in either direction for that not to work. But somewhere in between there, chance to be profitable.
I'll be very curious to see. I mean, obviously, this is just preparing for either direction, but 6% move on the back of a 3% move, we'd be seeing some volatility in banking. So obviously, this just prepares for the expectation for either direction that we could move for Bank of America. But two names to definitely keep on your radar into earnings tomorrow morning. We'll leave it there for our chart and trades today. Now coming up next, it's time to discuss pizza, as we are looking at Domino's, now rebranded without the pizza, but with a 4% decline today on the back of a turnaround strategy that perhaps is starting to see some legs.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab.
Petalini.
Powered by Ameritrade. Unlocking the power of Thinkorswim. The award-winning trading platform.
Name just sounds so unreal.
Focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your
Well, we both read yesterday's resistance.
and track
That's a
market
major
trends with
support.
up-to-the-minute news and insights. Trade brilliantly with Schwab.
God.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions. Expert analysis and actionable context. From inflation data to sector rotations, earnings to policy. It's a comprehensive view of the market every trading day. Trading 360. In-depth market coverage straight from Chicago. Weekdays at
Another one heck of a run today.
Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Oh, yeah?
Hey, Dad.
Dad.
For you.
How come Grandpa doesn't sleep with me anymore?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. It's now time to discuss the latest with
Dad,
Domino's.
how come Grandpa doesn't sleep with me anymore?
We're all rebranding and a lot of the re-imaging they're trying to do right now to the public.
God, you got Marley sitting next to you.
Their overall rebrand. So for that reason, we're getting a pretty nice lift today. We've given back some of the initial strength. Joining us is Marley Caden, the host for the Schwab Network.
See Marley? She shows cleavage.
Specifically same-store sales. This is a big deal. This was not a trend we saw that was hugely positive for restaurants as a whole last quarter.
Yeah, in the sector.
I called it bullish yesterday. Marley.
They were one of the top performers after the results in the S&P 500. They posted better than expected earnings on those strong U.S. sales. That was a really important number for them. They reported EPS of $4.08 for the third quarter. That bested estimates, but the bottom line did decline 2.6%. Just to note, their revenue totaled at $1.15 billion.
Well, that don't sound too good.
Ahead of the estimates, up 6.2% from the prior year. But like you mentioned, Jenny, the U.S. accounted for the bulk of the growth that we saw in Domino's, which really is a counterbalance to the story that we're seeing from a lot of competitors, not necessarily in the pizza space, but just in the dining and affordable dining categories. We are not seeing a lot of U.S. growth. That is not the case for Domino's. International same-store sales increased 1.7%. From the prior year. That was a slowdown from the last three quarters. Domestic same-store sales, they accelerated 5.2%. That's the fastest rate they've seen since the first quarter of 2024. So really bucking some of the trends that we've seen more broadly. The chain also said its new stuffed crust pizzas and its best deal ever offer for one large pizza for $9.99 drove positive order counts in the U.S., and that resulted in that strong quarter of growth in both delivery and the carry-out businesses. Now, management emphasized
Well, that's a clean-looking store.
Execution allowed them to capitalize that pizza market globally in 2025, while also expanding their long-term value for shareholders and for franchisees. So
Okay.
I think Domino's really pleased here. They're up 3 1/3% right now on a bit of a mixed performance day-wise in the markets, but impressive growth, particularly in that they are going against the trends that we have seen for a lot of companies you'd argue are in the same space, maybe not a direct competitor to them, but seeing declining U.S. sales in Starbucks, in Chipotle, in Cava, but Domino's, Americans like pizza.
One of the things that keeps standing out when you kind of just skim through headlines, though, is this warning of tougher quarter ahead, despite the earnings beat. This talk of macroeconomic environment intensifying. It seems like the market's shrugging it off, though, obviously rewarding the stock. Is this one of those situations where this is a company getting out ahead of it, controlling the narrative, and sort of adjusting expectations, but doing so in a way that's shrewd enough that the market's kind of taking it in stride?
I think it's one of those situations that we've seen in other earnings so far, that when they are being honest and forthcoming ahead of any potential issues, that seems to be rewarded as long as it isn't a really bad issue. It's not a $1 billion hit to the bottom line or something because of tariffs. As long as it's not something significant like that, the honesty and the forthcoming nature of this management team seem to be being rewarded. So I think we are seeing a bit of a shrug off today, just in the numbers there. But I think that's probably driven more from those U.S. same-store sales. I mean, they're really bucking a broader trend that we've seen sort of industry-wide in terms of dining outside of the home, food at home really on the rise. And obviously you eat Domino's at home, but it's an ordered service. U.S. sales have been down for most places. So Domino's is doing something right domestically to get those numbers to be what they are.
I feel like it's all right now about feeling like you're getting a good deal. Like we're seeing even like McDonald's bring back these meal deals. We're seeing all of these companies trying to reinvent, repackage, frankly, what they already are offering, just in a deal-finding way. And I think that that's working because it does feel like if I want to dine out right now and I'm trying to be more cash conscious, I will try to find something that's at least discounted, which is, I know that like the thinking is like, it does bring you in the door, you end up spending more money, you never actually end up saving any money, but that's, I think, what's working, seems like for a lot of these restaurants right now.
This is a good point. I'll add into the stock was basically at its lows, so perhaps there was already an expectation of some of this too, but I think what you're circling here, and I think this is really important, and it's not unique to just restaurants, but I think some of these businesses, be that in quick service restaurant, be that streamers, be that anything, they found the point where consumers were kind of like, hey, like suddenly what was like pretty affordable isn't that affordable. And I think the big difference is we've talked a lot about like the Applebee's of the world or the Chili's of the world. It's almost like McDonald's got almost to the same point where it's almost as expensive as those experiences. And it's like, given the choice, if you have the time, that's an elevated experience versus McDonald's. Even if it's not an elevated experience, it is versus a quick service restaurant. And they've sort of found they've lost their way, is the best way I could say. The same way I would say these, Netflix, HBO Max, they're more expensive than a traditional cable package now, so you're seeing a lot more cord cutting even within streaming.
I mean, I think that's so well put, and I'm a longtime Domino's enthusiast, so I will never ever knock the quality of their pizza, because even before they rebranded, I was still a Domino's enthusiast. I was like the first rebrand, like 15 years ago, but I will acknowledge a 3.5% move today is at least a bar that is cleared as far as hurdles in front of the stock at least. So when we trade this name now for example purposes, how do you consider all of this?
Well, I think the fact that the stock was able to move higher despite it not being a flawless report in a backwards way is actually good news. It means that there is demand for this company, and perhaps you're starting to see a basing of it. But say this is the FOMO segment, only monthly options available, so you're faced with a choice. Do you want to extend time and go out to next month, or do you just want to go to the end of this week as it is a monthly expiration week? What I went for is the shorter term trade, kind of going with the near term momentum. And let's say that you think this stock can continue this run for another couple percent by the end of the week. If that does happen, the 424.30 call debit spread for this week would have a chance to be profitable. Say you did it for a $4 debit, it creates a little bit of positive asymmetry. You risk 400, but you have a chance to make 600. Your break even would be 424 on this example trade. Right now, the stock's trading around 422. You would only need about a 0.5% rally just to break even. And I think, again, most importantly, it is risk defined, though. If this $14 rally doesn't hold and it does fall back below 420 by the end of the week, you know your worst case scenario going into it, Jenny, and I think that's important. It is short term, it is reactionary, but this is FOMO after all.
This is FOMO after all, so I like that, and a good place to leave it, as I'm sure we'll also be watching, I mean, to Marley's point, the same-store sales trends for U.S. specifically for the coming quarter. Someone mentioned that to me like earlier this year. It was the greatest call ever. That was like, watch same-store sales growth for the restaurants, and it's been one of the more interesting trends to watch. So we will be following along as we're just really at the appetizer of earnings season. Appreciate it, though, to Marley Caden for all of the insights there. And then that'll do it for FOMO today. Coming up next, though, we'll take a closer look at the latest from the tariff back and forth. That, of course, is impacting the markets and more, as we'll also dive into some of the broader earnings expectations for this quarter.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a... Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
It's Schwab.
I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on.
Quit picking on Carl.
I'll get out there.
Where are you going?
Schwab.
Schwab.
Stop it.
Approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
It's all right, Carl. I'm behind you. Don't let them people do that to you.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome to Next Trend Investing, and now time to discuss the latest on the tariff front. And of course, for some more insight on the latest between Trump as well as Beijing and broader tariff forces, I'd like to now be joined by Dan King Hall, the host of Morning Movers, because she is our unofficial tariff correspondent. And so, Diane, it's been, I think, all of 4 days since we've gotten to discuss tariffs. So where to begin? I would walk us through the latest.
So I guess we'll start with the latest, because it seems like it's the promise of progress that has really turned this market around, and we see all the green on the board. I mean, it's a fight for the NASDAQ 100, but you know, you had all these plus arrows starting to happen, and I'm like, I talked to one of the guys on the floor. I was like, what just turned the market? And so you had that interview with the trade rep, Jameson Greer, on CNBC, basically saying, despite all this rhetoric that had been heating up between the U.S. and China, he had said that senior U.S. and Chinese officials held talks Monday over that rare earth, dispute that has been occurring. He didn't say which officials were at the table, but he also confirmed that President Trump and China's President Xi Jinping are still scheduled to meet, though, you know, there are questions about if things could be reconsidered. But he hinted at essentially cautious optimism here, saying, quote, "We've been successful finding a path forward with them in the past. We think we'll be able to work through it." So again, that optimism, returning the markets to the green. Now, you know, what led to all of this? That move, all the pressure on rare earths last week, and then President Trump had threatened to essentially double tariffs on Chinese goods. That would, you know, that's essentially a move that would halt trade between the two nations because it would just make it too expensive. In other words, you had all that red that happened on Friday. You had a recovery. On a Monday, then there was some kind of new ratcheting up of actions, not rhetoric, right, with China slapping some sanctions on U.S. Portion of a South Korean company, right? And then you also had the actions occurring. It's a lot of moving parts here with the U.S. versus China on ships today. So it sounds like right now we are still in the middle of negotiations, and it doesn't mean that there
That's
has
too
been
funny.
some kind of stalemate. Negotiations seem to be still able to proceed based on the latest conversation that we've heard from the trade rep, Jameson Greer.
Okay, yeah, and I think a really good point there, and I think a great breakdown of what we're seeing as far as the tensions that are still playing in the overall market and really lingering as this almost cloud, I feel like, that we cannot get fully out of, and I'm sure we won't be seeing that cloud to dissipate for anytime soon, but for that reason, we'll continue to have you on and have you bring all of the great discussion regarding the tariff latest. Appreciate it, Diane King Hall, as always. And now to shift gears and discuss more about the broader macro theme, but also how that ties into the latest with earnings. I'd now like to welcome in Luke Lloyd, the president and CEO of Lloyd Financial Group. And Luke, we always appreciate when you join our show. You always have wonderful insights. So as far as just the broader market right now, as we are on the brink of really the bulk of earnings, what are you looking at?
I mean, there just seems to be still this kind of buy the dip and optimism around the whole entire stock market. And it seems like the liquidity still is remaining very, very strong. It's contracted a
Very
little
strong.
bit late last week and early this week, but we still have so much liquidity in the markets. You can reference the money market accounts. You can reference the deficit spending still going on at the top, and you can reference the fact that the stock market
Triple top.
There's a lot of money flowing even outside of the U.S. markets into the U.S. market. So liquidities remain
Triple
strong,
top.
growth remains strong, inflation continues to come down. Not many scares around tariff inflation that we've seen the past couple of months. So you have interest rates, the fact that the Federal Reserve seems to care a little bit more about the labor market compared to inflation. So that's all very bullish for the stock market, which is why, from a portfolio allocation standpoint, you don't need to take on all of the risk in your portfolio 100%.
Yes, you do.
The way we are kind of positioning our portfolios, 80 or 90% of the portfolios is still almost the more defensive kind of nature, but like you know.
Okay. Enough with you already. So what we have here is we're getting that time of day. It's almost 1 o'clock, 2 o'clock Eastern, where it's going to make a business decision. It's either going to break out or we're going to have a nice little dip. It's almost like a megaphone here. I'm going to get rid of that. Remove that. Put the new resistance in. So that's your new resistance. And this is it the third or the second? It's the second dip to the 63 EMA, which means we could have one more. Maybe at the, is that the 63 or the 200? That's the 63. It's got to be. Yeah. Don't ever do that again. Do you understand me? I'm tempted to go back in there and have another one of them mochas. That was good. Very satisfying. I got to mark down on my little coffee calendar here. I got 1 cup out of the espresso. I got a bet going on with the lady at the cashier desk, because that's the smallest batch of coffee I've ever bought in my entire life. And it was 1/4 of a pound. So I got 1 cup. I said I'm going to have 7, so we'll find out. Okay, triple top. Triple top, are you sure? Here we go now. Triple top. Triple top. Did you hear that, Goose? Livid Goose busted me in another room. So Jimmy's looking at puts. And they're so damn expensive. The 6670s at $5.10. $5. $4.90. Get ready. I'm going to take a risk. I'm going against the grain. $4.50. This is a risky trade. Let's get that out there. But Jim, you're bullish. I know it. I know it. I know it. Oh God, right there, man. That sucked. Right when I bought it, it dipped $4.50. I mean, $4. Now we broke resistance. Risky Ghost riders in the sky. RISK, we're at 470. Ghost riders in the sky. We're at $4.90. We're at $5.10, 20. Come on, baby. Give me $100. Could have grabbed another one. $4.10. If I did that, I'd be out of the trade right now. These are at $5.10. I'm up $60 a contract. Have you ever thought about selling? No, I can't. I won't. They're at $5.70. $5.80. Make a business decision. We could come back down and hit the 63, and this will be up a couple $100. Or I sell it now for $100. No. Yippee-yi. Yippee-yi-oh. We're at $5.40 a contract. $5.50. George. $5.60. Oh. 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 We did break a new high, so it kind of has me a little bit nervous. And I'm debating on selling these for $100. That'll be 20%. 22%. We'll know something here shortly. George. $580. Oh, this is looking good. $590. Now I should sell them. And watch it drop big, and I could have made $400 or $500 on this trade. $6. Oh God. Jim. Come on. Right about now. $620. $630. Come on. Now's the time to do it. Yippee-yi-yi. Yippee-yi-yo. Ghost riders in the sky. It's that time of day where I don't do too well. I still got an hour for this thing to dip. If it doesn't want to hold this support, that or I sell it. Watch out, Nicole. Marley's after your job.
And rub your eyes because the market is now in the green after that sell-off this morning. We have a big show for you today. We'll discuss the recent volatility caused by increasing trade tensions and whether or not it provides a buying opportunity for you. We'll also cover the recent defensive rotation in markets and one of capitalizing on this shift. And our panel's ready to talk all about those bank earnings. Citi and JP Morgan, Goldman Sachs, BlackRock, Wells Fargo. A lot of good news there today. Also, we've had deals from AMD today, Walmart. So a lot of deal making too. In the meantime, here's a look at the markets. We did see the S&P 500 really testing Friday's lows. Got pretty close to the Friday low, and folks stepped in and started buying. And that's very telling here. The S&P 500 is now up 0.25% at 66.73. Tech-heavy NASDAQ, not too far off the unchanged line, down 0.1%. Dow Jones Industrial Average up 416 points. It was down 600 points. So what a day it's been. The Russell.
Yeah, sold one at 6. I'm trying to get
oil and gold are mixed.
the other one's back down to 5.
$82 the barrel, while gold is up $31 at $41.64 per troy ounce. You know gold's been at record highs. 10-year bond yield at these lows of 4.03. Wow, 98.78 for the dollar. Bitcoin 113,290. That's up off the lows. Up down 2.5%. Kevin Hicks, host of Fast Market here on Schwab Network, is live at the CBOE. It's great to see you. Wanted to get some of your takeaways. We've had some big movers. Johnson & Johnson has been one that gave us a glimpse into some of their news and a spinoff.
Yeah, Johnson & Johnson came out with their earnings this morning with the banks and Domino's Pizza. They were one of the groups that came out with earnings $2.80 a share versus $2.75 expected. Revenues $23.99 billion versus $23.74 expected. So a nice beat on earnings, nice beat on revenue, and the announcement that they were separating its orthopedics business from the rest of the company, establishing a standalone company operating under the name.
I think this is my last chance.
EPUY is the name, and so that was as much as 10% of their business So a lot of news. The stock was trading up on the day. It was down pretty significantly on the day. Now just fairly close, within $1 of unchanged, Nicole. But a lot of movement out of Johnson & Johnson. A lot of news today on earnings, but a beat on earnings per share, beat on revenue, and a spin-off.
Johnson & Johnson?
And a new all-time high, as you've noted. I mean, a great run here for what we've seen for Johnson & Johnson. What about DoorDash getting...
Ooh, $6.50.
JP Morgan today.
DoorDash, JP Morgan, away from neutral.
Yeah.
Of $325.
Now we're at the 63.
$175, almost double the price. After reinstating coverage of the name following a
Oh yeah, come on, baby.
restriction, DoorDash continues to deliver.
I'm Washboardjim. I'm the founder of the Sneaky Snake Trading Strategy.
Unit economics. The analyst tells investors
We're now at $7. So I'm going to sell these things, and they'll probably drop real big. $6.90. What'd you think about that, livid goose? Yeah, we should have. We'd be filthy rich. I had 10 of them. I had 20. What am I talking about?
I'm not sure anybody really thought we would have a bounce back from today's lows that we saw.
It's extraordinary. I mean, Friday obviously was a big down move, and we've made up for that and then some. And I think that people are, we thought that tariffs were normalized, and then Friday was a little bit of a kick in the teeth. But I think people are realizing that these test balloons are put out there, and the market voted no, and now we're off to the races again. So it's been
What
quite a
does it
year.
say about valuations where we are now?
$7.40.
Market, we've had, 2 20% years. This year is still out for the count, but incredible run up since the April Liberation Day. Your thoughts on where valuations are?
Yeah, I think for the stock market, the valuations are pretty rich. I mean, a lot has to go right, and it probably will or may, go right. Expanding margins and growth in the large cap tech area probably justify these multiples, but we have to see that actually happen. I think what's more interesting to me is on an equal weight basis.
Oh, man.
Trading at about 19 times earnings, which does not at all feel terribly elevated. That seems right in this interest rate environment. And more drilling down a little bit more.
So I was just looking at Wells Fargo. We're going to be talking about some of the banks later in a panel. I mean, Wells Fargo is really setting up. It's on track for a record high close. I mean, these banks have been doing incredibly well, and a lot of that has been on M&A activity.
Right.
Do you see M&A activity continuing? IPOs? Your thoughts?
Yeah, I think M&A activity is certainly interesting. A lot of the boutique M&A advisors have been ramping up in anticipation of a very dovish administration when it comes to approving mergers, and we're starting to see that with Goldman Sachs and Wells Fargo, reporting, and Citi reporting great numbers on the back of deal-making activity. And I think, more to come. But I think now that tariffs perhaps have been a little bit more normalized and people are learning to live with that news, I think corporate executives are able to look forward and figure out how to grow their companies, and I think increasingly that will come with mergers.
I'm watching the bond yield today, 4.03%. As the price of bonds moves higher. Your thoughts on, because last time the Fed cut, bond yields ended up going high. The 10-year bond yields ended up being higher the next few days than it was right before the announcement, and that happened last year too. This was the first Fed rate cut of this year in our last meeting. What do you anticipate going forward? Do you expect 2 cuts from the Fed? And what happens to the 10-year bond yield?
Yeah, it's interesting because now, the Fed is starting to cut, and we expect 2 cuts this year. The market's anticipating that, and that seems right. I think the difference this time around is that the economy is showing a few more signs of slowing. I think a lot of the Fed governors are coming around to this idea that 2 probably feels right, and 2 more next year probably feels right. And it makes sense at this point in the cycle. We're not going to see 3% GDP growth like we saw in 23 and 24. I mean, we're looking for sub 2% most likely. So I think that the economy's slowing. It's kind of bad news is good news for the stock market.
So let's talk about your fund, the growth fund. I know you have some stock picks for us too, folks, so stand by for that. But the Hennessy Cornerstone Growth Fund, HFCGX, Tell me a little bit about this fund and why it's good in a portfolio.
Sure, yeah. So the Hennessy Cornerstone Growth Fund is looking at valuation, earnings growth, and stock price momentum. And I think first and foremost, it's a disciplined process. We're not veering from that framework at all, and it tends to give us some kind of idiosyncratic exposures to industrials and consumer staples and financials, mainly non-bank financials. I think what's absent and what makes it a good complement to our portfolio is just the absence of large cap tech. There is some technology, mainly on the distribution side, but certainly the AI-focused companies that have done so well are not in the fund. And the fund's done well despite that over time, but I think it's, kind of valuation coupled with stock price momentum is an interesting idea at this point in the marketplace.
And so is that done on purpose so that you can have the S&P or the triple Qs or something else and this fund, so it's sort of X-Tech?
Yeah, I think so. I mean, the kind of active share, the way it differs from its benchmark, it's basically overlaps with its benchmark almost negligibly. So it is certainly a good, complement to an index fund or a passive fund. It's bringing in different things that most people probably aren't exposed to.
Okay, and then what about some of your picks here? BJ's Wholesale. Why BJ's?
Yeah, so, in the consumer staples area, we own BJ's, and I think it's an interesting idea. It doesn't get nearly the attention that Costco does, and they're very similar in construct. And, it's a great valuation, a lot of momentum of late on the stock price, and, strong balance sheet, free cash flow generation, and something that, over time, does well when gas prices go up because they offer gas at a good discount, and when gas prices aren't so high, people just stick with that model of shopping at a membership warehouse.
Okay, and then what about StoneX? What's this about?
Yeah, so StoneX is also a holding in the growth fund. They provide clearing and execution for investors trading fixed income and derivatives. About 16 times earnings, a lot of growth, a lot of M&A activity, which we talked about. They've grown the firm shrewdly through acquisition. And it's definitely a way to play the growth in the derivatives market and fixed income and securitized products.
You've mentioned staples more than once, by the way. Yeah. And so I think about the consumer, and I know there are some concerns about slowing labor market. Where do you think the consumer is end of the year, next year? Are you worried about a slowdown? I mean, we've certainly seen resiliency in spending. I mean, even in the JP Morgan, just this one, the CFO saying, consumer spending is strong, just talking about the resiliency of the economy. So, but what do you think happens with the consumer?
Yeah, it's interesting because it's been a surprise, and there was also a number out from LVMH, and that's more high end, but very strong numbers there. So it seems like as investors, we've yet to fully understand the strength of the consumer, and I think it keeps defying expectations. I think, I think some of that is the wealth effect, to be sure. A lot of people are invested in the market, through 401ks or IRAs or just personally, and I think that has been propping up some spending to a large degree. The employment trends aren't as robust as they were a year ago, and I would leave it to just the wealth effect.
You were talking about margin expansion. We are in earnings season. We've just begun. We're already seeing some good earnings. Yeah. Stocks sometimes trade lower even if they beat the street. What are you expecting, and what would you like to see?
Yeah, it's interesting because for the earnings season that's just got underway today, the market is expecting about 6% revenue growth and about 8% earnings growth, and that continues a trend of margin expansion. So it's interesting. With inflation came higher prices. I think a lot of those prices have stuck. On the expense side, I think there have been a lot of efficiencies gained already through AI and just other efficiencies driven by technology and software more specifically. So I think that margin expansion coupled with some better than expected growth that we're seeing, I think is what supports a market like this that trades at a relatively rich multiple. So I think it's exciting. I think for next year, there's a similar expectation for margin expansion, among S&P 500 companies. And I think it bodes well for the market going higher.
And this fund gives you an alternative to all the tech, because everybody keeps talking about the AI bubble. Nobody really knows if it is a bubble or where we are. And so HFCGX gives you an opportunity to have a little bit X-Tech, I guess, the big news. Thank you. It's great to see you. Josh Wine, thank you so much for being with us. Portfolio manager of the Hennessy Cornerstone Growth Fund. Coming up, Options Corner, Tom White is standing by, and he'll highlight Unusual options activity from the day. How investors are looking to trade on recent news of AMD, Intel, and Micron. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the watch list. Time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. We welcome in Tom White, host of Fast Market here on Schwab Network, and he's going to go through some real trades that he's found. But first, want to get a market thought. Pretty amazing to see the market drop this morning, hover around Friday's lows, just above it, and then they step What do you make of a day like
Time to
today?
make a
What are your
coffee.
market thoughts?
Well, Nicole, with markets just below all-time highs, it's not surprising that we're starting to see a little bit of chop here, where it's all headline-based at this point. The sell-off that happened this morning was on the back of, more rhetoric out of China on the trade front, putting restrictions and sanctions on that U.S.-owned South Korea shipping business, and that's a concern, right? But then on the flip side, there was some commentary out of the Treasury, the Secretary Greer today on trade, saying that, hey, the meeting's not off between Trump and Xi at this point. So we'll have to continue to watch the headlines, because that seems to be causing all the movement that we've seen in equities as we rally back into positive territory. We're now over 1.5% off of the session lows here. So you've got to continue to watch that, along with earnings. The bank earnings were great across the board. Is that going to set the tone
Bank earnings were
for the overall
great.
market, because the banks are benefiting from what's going on in the market, seeping into the yield curve, M&A activity, IPO activity, trading activity. So everything seems to be going in their favor. Now, will that equate or pull into maybe the rest of the sectors and the individual names going into earnings? We're going to have to wait and see, because it's still just a choppy market at this point, and we're still elevated.
Oh, come on, Baldy. What is it with all the bald men on this show?
So well today, and I didn't expect the market to take off. I mean, just if they beat the street or have some records, because that's how the market is. There's some high expectations, but to your point, a name like JP Morgan and the activity, Circle, they were the underwriter for Circle. JP Morgan was the underwriter for Figma. Also the take private of Walgreens Boots and Alliance by Sycamore. So there's been a lot of action. The question is whether or not it continues. I know some of the investment banking outlook were named upbeat for JP Morgan in particular, but all of these names really did well. Let's get to a name like AMD, which has had its own piece of news, and it's up 3.5% today. Go through it a bit and tell us about the bullish trade you found, Tom.
Yeah, stocks up over 3% today on the back of that Oracle, basically using 50,000 AMD graphics processor units. They're deploying those at the end of 2026. It's not right now, it's at the end of 2026. But that's giving the stock a lift today. Wolf Research upgraded the stock to outperform from peer perform, put a $300 price target. And then remember, on October 6th is when that deal was announced with OpenAI for 6 gigawatts of power for the AI generation and using AMD's infrastructure. So they're playing catch up with NVIDIA here. Remember, we thought this was a one-horse race as early or as late as basically 6 months ago. Lisa Su's kind of turned it around. The MI450 chip competes well with the Blackwell. Now we'll have to wait for NVIDIA's new Rubin chip to see if they out-innovate once again and keep that lead in advanced AI infrastructure and chip build-out. But really nice day here today. Stock's up over 85% so far this year. We did see some call buyers in here, really short-term positioning, and probably when the stock was a little bit weaker here. Trader bought over 20,000 early this morning. The October 17th monthly options that expire in just 3 days. The 230 strike calls. Paid an average debit of about $2.10 for these. So the break even where these traders start to profits above 232.10 over the next 3 days. That's only about 3.5% above the current share price there in AMD. So somebody thinks that we're going to continue to see more gains for this stock. It's just below those all-time highs that we recently set. But the momentum is definitely to the upside, and this trader thinks by the end of the week it's going to be higher.
It's amazing how much collaboration we've seen when it comes to the crisscrossing of these tech names, whether it's investments or collaborations. I mean, in this case with Oracle deploying the 50,000 AMD chips, a lot going on. Intel has had its own deal making that it's been doing. What about the bullish trade you found here?
Yeah, the stock's up over 80% also so far this year. Down a little bit today, down about 2%. Maybe they don't have the headlines that maybe AMD and some of the others have had recently, but you got to remember they just released their Panther Lake 18A chip. They're going to start deploying that. That's supposed to expand their footprint in that space. Yesterday, Bank of America downgraded Intel to underperform from neutral, unchanged price target of about $34. The $80 billion jump in Intel's market cap more than reflects its improved balance sheet and external foundry potential. So maybe some people pushing back on the rally that we've seen so far, especially over the last month and a half or so. And remember, when NVIDIA bought into or invested $5 billion into them earlier this month,
exactly.
The stock jumped nearly just over 30% on that day. So parabolic move to the upside. Maybe somebody's pushing back, but you know what? It's a cheaper opportunity in the AI chip building space, right? Compared to AMD or NVIDIA or high-priced stocks. This is under a $40 stock. So we saw some call buyers in here, but this was all the way out in the January monthly options. So they've got about 94 days till expiration. Trader bought earlier today 25,000 of those Jan 37 calls. Paid an average debit of about $3.80. So that break even of $40.80 over the next 3 months. That's about 12% above
Oh
the
my,
current
look
share
at
price.
that.
So you're going to need to see some more gains. But I think the key with this trader is they gave themselves plenty of duration.
Look at that.
To keep piling in. There's a big open interest.
Puts her at
on this
660.
strike, big round number up there.
Oh, we're in the money
on
now.
Strike. So yeah, somebody thinks that by the start of next year, we're going to see more gains here in Intel.
Yeah, and look, it was a worse performer today in the NASDAQ 100, so maybe those pullbacks really provide some
If we go much
opportunity
lower,
for those who think it does have an up arrow.
Jimmy might get back in it.
Let's look
If we
at
don't hold this
Micron.
support line.
A neutral to bearish trade.
Yeah, talk about parabolic moves.
Nicole,
I mean,
I love you a lot, but you definitely put on the wrong wardrobe today. I wanted cleavage. If you're listening, Nicole, don't ever do that to me again. So if we don't hold this here support line, I'm getting back in the put. That's a fact, Jack. You know what I'm saying? Yeah, Walmart got an AI deal. Go to Walmart, pick up my shopping cart, pinball, bird seeds, all the things you need. Let's go to Walmart now. Oh. Oops. Oops. Oopsie daisy. Fill up your shopping carts, pinball, bird seeds, and all the things you need. Let's go to Walmart now. Walmart and Kroger are part of a major pasta recall. The puts are now at $6.40. Jim's watching this real closely here. Yum, yum. Yum, 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 yum. Okay, we're going to go over the watch list. I've been memorized by this here. Let's see what we got here. RGTI up $1.55. New high. This is one I should have probably called out this morning because I saw it, but I didn't mention it, I don't think. NVIDIA down $6. I did mention this one this morning. It bounced up $3 to $4. Now it's pulled back to a support level. And we got Intel being brought up on Schwab. I'd like to see the 5-day, 5-minute chart on this, please. Nancy, put your pants back on. I kind of like it to go back up to 37.41 Intel and hold 35.50 where that wick is. And AMD just can't stop winning on this trade. We had a double bottom, come back pre-market, close snake breakout, pull back, higher low, boom to 228.80, resistance to break, and we really got a resistance right here to break, and we kind of broke it. Tesla, you just can't keep this one down no matter how bad they badmouth it. Definitely hit my red line support level at 419.22. That's been my solid support this week. And we came back and hit it twice today and left it high and dry to almost a triple top. Applied, now this one here is one we really got to watch, APLD. It's had a pretty good bounce off earnings and pulled back, then bounced back up to a double top and pulled back and bounced up again to a lower high. So that's flagging a symmetrical flag. I should have said that's flying a symmetrical flag. Amazon tech is valued as if AI is the next smartphone. It isn't. See, fat cats, they really think we're in a bubble. Taco Trader met, who in the heck's a Taco Trader? Taco Traders. What the heck is he? What? What the hell's a Taco Trader? Are they calling us names because we like Trump? Let's see what a Taco Trader is. Taco Traders. A phrase TACO. While a restaurant called Taco Traders does not appear to exist in Springfield. I didn't ask if it did. It's possible, Corey. Wow. He's pull up President Trump. Taco Traders Met, you know, what the hell is a taco trader? Anybody ever heard that term before? In our analysis, taco traders are akin to the Momo crowd. That's what the heck? Where's a Momo crowd? And that they do not do any dip analysis. This morning's taco traders are meeting. I think this is full of shit. Now I got to look up Momo crowd. What is a Momo crowd? Momo trading is the most popular trend trading system in the world. It's based on volume and trend, not fundamentals. Well, I guess I'm a Momo. Okay, the puts have dropped.
This trend continues, you will see the dollar suffer in real terms, not necessarily against other currencies, but it could create effectively dollar inflation. The dollar will not have the standing that it used to. It will buy less over time. The market will, and reserve managers will gravitate towards other assets, including things like gold or commodity standards, etc. So this is a drip by drip situation. It should not really be something that market participants that have 1 or 2 year horizons should really concern themselves with. But if your horizon is 5 to 10 years, this is certainly something that bears watching.
Let's talk about what's been going on with the Fed.
Okay.
The Fed is likely to have 2 cuts this year, probably 2 cuts next year, folks are looking at. Meanwhile, the 10-year bond yield is at 4.03%. You actually are a bit concerned about tariffs, which maybe the Fed will look at tariffs or the possibility of inflation. Maybe they may not. Investor who wants to make money.
Well, as far as October,
I'm a taco trader.
The next FOMC meeting day, we do think the Federal Reserve will cut. We think the FOMC will conduct a 25 basis point cut to the Fed funds rate target. However, it's important to keep in mind that the Fed is doing so reluctantly. Right? We have sticky inflation in the U.S. We have PCE price index inflation well above the Fed's target. We have the core component or the core analog as well above the 2% inflation target. And that should make the Federal Reserve uneasy to some extent about cutting rates too aggressively. So I think when they do cut on October 29th, they will cut, but also at the same time signal that they are hesitant to do much more. And I think the market could take that as a hawkish signal. Keep in mind, although what's motivating the Fed to cut is the premise that employment growth is slowing in the U.S. and we may get an uptick in the unemployment rate, there's another vocal component of, call them hawks if you will, among the Fed policymakers who believe that the reason that employment has started to slow is not because demand for labor has deteriorated, but rather because the supply of labor is shrinking, especially in view of immigration policies in the U.S. And that is not a reason to conduct aggressive rate cuts. If anything, it's a reason to be wary of the prospect that wage increases could take place, that could pressure inflation upward. And of course, on top of that, you have the uncertainty about tariffs. If we were to get these hyper tariffs on China, the 100% that President Trump has threatened, or the 145%, whose waiver ends on November 10th, then of course the market will be worried about inflation because of the transmission through the tariff mechanism and into ultimate prices. Of course, the Fed should also worry about inflation expectations rising if that were to happen. So these are all reasons for the Fed to signal that even though it may cut in October 29th or will cut on October 29th, it will be hesitant to promise much more.
Terry Wisman, thank you. Global FX rates strategist at Macquarie Group. Thank you for joining us. Really appreciate it. Thank you. Still ahead, we'll take a look at the banks. We have our team ready to discuss that. We'll be right back.
Oh, yeah. Look at that, man. I had an opportunity to buy a good price option right there. And I didn't, well, they're now at $6.30. And I didn't do it. $6.50. I could have got these at 4 something. $6.90. They're way too expensive.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Nicole Petalides, and we're live on the floor of the New York Stock Exchange. So glad you're with us. So we've been seeing some rotation into defense and how to capitalize on this shift. Joe Castigli's with us, co-portfolio manager at FMKT. So tell me a little bit about the defensive shift we've been seeing. What does this mean and why is it happening?
Certainly. Well, first off, I'd just like to say thanks for having me on today. To your point about the defensive shift, we've seen a huge uptick in utilities. We've seen outperformance since mid-September over the past 3 weeks of almost 8% for the utility sector versus the greater S&P 500. And then throughout October to this point, there's been a 20% uptick in volume within the utility sector, which is confirming that rotation. And so, you know, this is classic risk-off behavior that we're seeing from the market here.
So at this point now, how do you play it? When you think about defensive sectors, what defensive sectors do you like to focus on?
So I mean, I was just speaking about utilities, right? So when we think about the utility play, right, for us, we're looking at a company like Southern Company, where it's producing energy production for the southern half of the United States, the southeastern portion of the United States. It's cheap, stable energy that we need for this data center demand with all the AI growth that we're seeing from the technology companies.
Yeah, ticker symbol SO, right? And that they can benefit from the demand for the structural needs that increases when it comes to AI. right? I mean, when we
Exactly.
think about utilities overall, and we've been hearing a lot of the big banks too, seeing more interest in utilities and maybe even backing off on some of the tech startups. Are you seeing any of that? Do you think that's true?
I think overall you're seeing a lot of interest in this sort of energy infrastructure theme within the market. So like I said, Southern Company, right, that is a play to supply this energy to these companies, these AI companies. When it comes to banks backing out of that space, I think we've seen a little bit of that. I think there's certainly just we've seen the shift in institutional buying, right, over the past several weeks, where you've seen people shifting that money into the utility sector, more defensive sectors, probably to deal with some of the volatility. And, you've seen tech sort of underperform over the last several weeks relative to the broader market, but also relative to utilities in general.
And where do NACO Industries and Uranium Energy Corp fit into a portfolio here?
Yep. So Uranium Energy Corp is the largest U.S. listed uranium company in the U.S. Basically, they have several catalysts working for them. Number one, the Trump administration is essentially stockpiling. They signed an executive order to stockpile uranium and create a uranium reserve and replenish that. So you have some demand coming from the government, but then you also have demand for nuclear energy with all these data centers for that cheap, stable, reliable power to power all this AI and data center investment that's going on in the United States. And then NACO Industries, they are a little counterintuitive to some of that with the nuclear and renewables and things like that. They are actually a coal company, but they also do some mining for some critical minerals such as lithium. And the thought process here is, right, when you look at the coal companies, they can serve to be a bridge. While some of this nuclear capacity comes online, they can be that bridge energy provider to make up the gap in supply to supply all this demand that is being created from these AI.
I'm still watching this, baby.
Infrastructure plays.
Are you moving away from tech overall?
Yes.
So
No,
in our portfolio,
don't.
Tech is a very limited segment of our portfolio.
Oh, God.
We're definitely heavily tilted towards sort of energy infrastructure, utilities, and we do have some financial exposure, mostly through regional banks.
You gotta be kidding me.
But technology is definitely not a big segment of our portfolio at this time.
And I ain't trading with you.
And then the free markets ETF, tell me more about that. Is that something people should have in their portfolio? Why?
Sure. So to this point,
Man, it's just weird.
ETF is an ETF that's built to capitalize on deregulation.
They all think we're in a bubble in tech. They really do. That's my favorite. It's always been, for the last 20 years, it's been my number one sector. And every time what was it? 3 or 4 months ago, they were telling you to get out of tech and go into small caps. Four or 5 months ago. I think they're idiots. I find it hard to listen to them. It was back in here. They were saying that we were overbought. In tech. NVIDIA. It was back in what? About I think it was even sooner than that, but it was definitely back in here. And then we had the pullback. There's a triple bottom right there. So if it's $15, $17 dip, it ain't much. I don't know, man. I just get, that's all I hear anymore. Bubble, 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 bubble in tech. Apple I can see. I don't know. I would love to see a pullback. Now I can load up again. Oh, Randy. We turned around off that support. Now we're at 390 on the puts. We got 10 minutes to power hour. So get ready. So tech, huh? AMD's a different kind of card compared to all the other ones. We've been consolidating. Okay, prepare ye. We held yesterday's support level, resistance level, so far. We could bounce another $7 up, $6 up to the upside.
A record-breaking quarter. Let's see what you think, Matt.
Well, yeah, I agree with John. It was good. I mean, the reaction, of course, has been very strong for especially a couple of names. I mean, Wells Fargo. I mean, obviously their issue with the asset cap being removed. That's been very helpful. They had been basically mismanaged on many levels for a decade. Coming with the new management has turned things around. And of course, Citigroup has been underperforming for quite some time, and they're finally seem to be turning the corner. So you have a couple of stocks that have not been doing that well, which are finally doing well. They're the ones leading the way. Overall, don't get me wrong, it's still good, but the issues that Jamie Dimon brought up about credit quality and things like that still, give us a little bit of reason to take a pause and still be looking forward to see how things play out going forward.
Matt, which names would you buy today or in the near future? Which names do you like the best in financials?
Well, of course, it's always hard to go against the big names like J.P. Morgan. But the thing is we also want to be looking at some of these regional banks. The economy, we're worried a little bit worried about.
Banks had a great run.
What will happen there?
If I was saying anything's a bubble, I'd say the banks.
Kind of, trying to play catch up as well. And the reason why I highlight that is that people are looking for a lot of different areas of where can they put their money. In this this bull market that's been kind of long in tooth. Well, a lot of people are looking to small cap. What is the area that has the most weighting in the small cap area? Well, one of those is the regional banks. So if you see these things can see some upside follow through, that's an area where I think people could see some surprising growth in this group in the rest of the year.
And John, for example, J.P. Morgan said investment banking, the outlook there remained upbeat. They talked about resiliency of the economy, consumers are spending. What names do you like the best here as you look? As chief equity strategist and economist, you're looking at the economy and how these, they did say delinquencies were trending below the average. That was good, though. There were some auto loans that actually showed some excess. The automobiles, that wasn't necessarily a bright spot. But your thoughts?
Yeah, look, this is the conundrum Matt, really pointed out well when he looked at the regional banks. I'll just throw out the Zacks ranking on J.P. Morgan, which is the number 2 ranked short term. So, the earnings are good. They're going to revise them up. Here's, Nicole, the puzzle that Matt pointed out. Long-term scores in value for J.P. Morgan, F. Long-term score growth, F. So the long-term score for J.P. Morgan at this level is F, and that's really the trade in this banking sector right now. Obviously, everybody knows that you buy the big names and it works out for you until it doesn't, and that's why the regional banks, the Wells Fargos, even the Citibanks get a look at this point because people say, hey, I got to find value here, and you can get a price earnings growth ratio out of Wells Fargo, which is 1.4. versus J.P. Morgan at 2, and that's significant. That's a significant difference. So even today you saw with the Dow rallying and the Nasdaq falling that there is a rotation that's based on value now, and I think that's what Matt's talking about.
So what's the big concern here, Matt? is there a hurdle that we have to worry about?
Well, again, we've had some of these issues with bankruptcies. We saw what happened with Tricolor and First Brands. And so, again, some of this credit quality, non-performing loans, these are some of the things that people are worried about going forward. And, what Chairman Powell said today about how, they're going to be lowering interest rates maybe a little bit more aggressively, that's bullish to a certain degree, unless, of course, they're doing it for the wrong reasons. If they're doing it because of lower inflation, great. If they're doing it because the economy's slowing down, not so good, and that's not so good for the banks either. So, it looks real good here. We do have to remember that the banks had sold off going into this earnings report, so they're bouncing a little bit from an oversold condition. We need a little bit more upside follow-through to really make sure that this thing's going to have some legs.
All right, well, financials are the best performing group today. I see industrials, consumer staples, materials also leading the way. John Blank, Matt Maley, thank you both so much for being with us. And thank you, friends, always for being with me. I'm Nicole Petalidis. That's going to do it here for the Watch.
3 minutes to Power Hour.
9 a.m. and 2 p.m. here on Schwab Network. And keep it right here. Market on Close is next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
We are now into Power Hour. And the puts are at 340.
Afternoon. It's 3 p.m. on Wall Street, and this is Market on Close. I'm Marley Caden, coming to you live from our Chicago headquarters.
And I'm Sam Bartis, coming to you live from the floor of the New York Stock Exchange. Let's take a look at what is coming up on today's show. We'll discuss nuclear energy with the team at Terra Innovator after debuting on the NASDAQ last week. In Options Corner, we'll take a look at Walmart as it becomes the latest company to announce a partnership with OpenAI. And today's overlooked stock is Navitas, a semiconductor, as it soars to an almost 4-year high after announcing progress on power chips for NVIDIA's AI platforms. But for now, Marley, take us through what you're watching today.
Yes, Sam, the big banks demonstrating resiliency amid economic uncertainty. We heard from JP Morgan, Goldman Sachs, and Citigroup, all capitalizing on strong trading and investment banking activities, while Wells Fargo continues to benefit from increased consumer spending. We also got a report from BlackRock this morning where they posted record assets under management crossing the $13 trillion mark for the very first time. We'll look more closely at those numbers coming up, but like you mentioned, Walmart teaming up with OpenAI to allow shoppers to buy things directly through ChatGPT. Now, we're not sure when this new feature is going to roll out, this instant checkout feature, but it does show the retail giant is trying to keep pace with changing consumer trends. And shares of Albertson are soaring today after reporting better than expected top and bottom line results this morning. Steady demand in its pharmacy products, particularly driven by GLP-1s, helped boost the results despite battling cost pressures in a very competitive category. The grocer also raised its full year profit and sales forecast. Before we get to all of that, though, let's see where the markets are as we near the close today. A better picture than we had earlier in the day, but still a mixed picture. The S&P 500 up close to 1/3% right now at 6673.93. As for the NASDAQ, trading down under the unchanged line, not even 1/10% at 24,730. For the Dow, we're trading up 0.9% higher on the day, 46,479.36. And the Russell 2000, our big winner on the day right now, up 1.8% at 2506.67. The dollar down 0.25% right now at 98.79, but that means gold is up in converse, up 0.8% right now, 4165.80, still well above that $4,100 threshold that we crossed for the first time earlier this week. Crude oil at 58.83, under some pressure today, down more than 1% right now. And Bitcoin recovering from earlier lows. They were down to about 111,000 earlier this morning, but now down 2.5%, trading at 113,410. Now, before we get to some of our top stories and bring in our first guest, I do want to ask Sam what's been catching her eye on the floor of the NYSE today. Sam?
Well, even with this rebound that you've been talking about, Marley, I mean, trade war fears are still back on the radar and sort of lingering in the background as the US and China step up the pressure now with more tit-for-tat maneuvers. China now sanctioning 5 American subsidiaries of South Korean shipping giant Hanwha over supporting US moves against China. It comes after both sides slapped port fees on each other's ships, which could raise the price of moving goods around the world, many of which are already subject to tariffs. The latest steps by both sides is being seen as leverage ahead of expected talks between Presidents Trump and Xi. Now, US Trade Representative Jamison Greer suggesting to CNBC this morning that the meeting between the two leaders is still on and thinks they can work through it, and that the threat of 100% tariffs depends a lot on what the Chinese do and whether they come into effect. Treasury Secretary Scott Bessent, meantime, reportedly accusing China of trying to weaken the global economy, telling the Financial Times that Beijing's recent moves on rare earths and critical minerals are an attempt to pull everyone else down with them. So we're watching those remarks. Let's send things back to Marley, who's with Jenny Horn in Chicago with some of today's top movers.
Thanks so much, Sam, for what you've been keeping an eye on. Like you mentioned, Jenny Horn joining us here in studio in Chicago, the co-host of Next Gen Investing, to break down some of the top stories that we've seen today. Of course, we got the first preview with the big banks today. JP Morgan reporting earnings that topped analyst expectations. Can you give us a better picture of what we got from them?
Yeah, I will say also clearing a pretty critical hurdle. JP Morgan is who I tend to look at when I look at the health of the overall banking.
Having technical difficulties.
Yeah, and Jenny, as we take a look at their chart, if we can pull up their chart today, I do want to show that JP Morgan more broadly is having some issues here performing.
We're having technical difficulties.
Bank earnings more broadly across the group. Citi, which also posted beats on there and impressive numbers in iBanking.
SPY 660s are now at 525.
But JP Morgan Chase trading down on the day, 1.31%. Goldman Sachs also trading.
I had them at 65 cents. 20 of them.
In the banks today, trading up close to 8%. Now, Wells Fargo got a massive boost from consumer spending, continued consumer spending. A real turnaround story for Wells Fargo here, but JP Morgan, a very interesting one here. Wondering about that downward move, and maybe it's some of the commentary here from Jamie Dimon. Jamie Dimon came out and said
$10,000.
Each of the major business lines performed well against what he called a good economic backdrop. He was preparing the firm for possible turbulence ahead, and one of the only CEOs who
shut up,
preparing for something
Marley.
like this. He also mentioned that there's been a softening that we're seeing more broadly in the economy, particularly job growth. But because of this, they've raised their provision for credit losses up to 9% to $3.4 billion. Now, that's important because that indicates that the firm is preparing for higher loan defaults down the road. Jamie Dimon specifically saying, quote, there continues to be a heightened degree of uncertainty stemming from complex geopolitical conditions, tariffs and trade uncertainty, elevated asset prices, and the risk of sticky inflation. He continued to say, as always, we hope for the best, but these complex forces reinforce why we have to prepare the firm for a wide range of scenarios. We did not get any commentary like that from any of the other banks saying that they were preparing for a more uncertain macroeconomic picture. But Jenny, I was particularly struck by that commentary from him because just as as a CEO, when Jamie Dimon speaks, more broadly, the market listens. And when he's the only voice in this conversation saying, yes, we're all performing well, and yes, we're showing resiliency during uncertain times, we are also preparing for those uncertain times. And I just thought it was a very interesting takeaway.
It is, because I never have heard him to be, frankly, overly optimistic. I mean, even in times like he was one that famously was calling for one of the biggest financial crises in decades at the beginning of the pandemic, really, and then we obviously saw that turn into one of the strongest bull markets we've known. So I would always say, when it comes to CEO commentary, he is one that the street reacts, and that's always why I think you see somewhat of a ceiling on the gains we can expect from JP Morgan out of its earnings, because of the fact that he is famously pretty cautious. Again, you have also exposure to the credit of most Americans, as JP Morgan does.
Coin had a good run from this morning's bottom.
And also Chase, a major hub here in Chicagoland, so it feels like everyone I know has Chase banking or JP Morgan of some sort. He is also within a great, I think, perspective. But perspective is just one thing. I think take it with a grain of salt, because he's been famously pretty down on the U.S. economy. This might be, though, the earnings call that it does feel like we're paying a bit more attention.
Yeah, certainly voices listening, it was a positive call, but seeing some downward movement where we are not seeing it as Wells Fargo, up more than 8% on their report, which was not as widely watched as some of the bigger ones, your bigger U.S. lenders up here. But, walk us through why we're seeing such a positive response in, as I read through it, a positive but also a little bit mixed report.
I mean, absolutely, especially when you consider the fact that, conditions right now are as ideal for these major banks as you would really hope for. Now, on the other hand, when you see these conditions be as hopeful, like JP Morgan, Citigroup, investment banking fees jumping 16, 17% respectively, fees also higher at Wells Fargo, yes, but that has really begun ramping up into the small business aspect of financials in recent quarters. So for conditions to being as good as you
Man, it's Irene. I don't know why I haven't caught on to that yet.
Really just, transactions we've seen from its fellow peers, that's not really the story. But the story is...
Oh, shut up. Fitzgerald has it to 100. BTIG maintains 75. Irene secures an $875 million convertible senior note offering. So they need money. So I don't know. It looks to me like a Momo trade, if anything. I mean, geez. Zim's up 6%, but that ain't much.
AMD's next generation Instinct MI450 graphics processing units. So that's, I think, exactly where we see the competition from NVIDIA. GPUs have been NVIDIA's, bread and butter. I believe they command roughly 90% of the GPU market share, but Oracle's a powerful customer. I would not want to be going against Larry Ellison and the behemoth that is Oracle right now.
No, I mean, you can certainly see it too reflected in the movements today. You know, we did have a mixed picture in the market, but mostly recovered. The NASDAQ barely below the unchanged line right now, everything else in the green. But AMD up 2 3/4% right now. But we are seeing Intel under pressure, Nvidia under pressure, Oracle not so surprisingly, you know, just because they're not the major beneficiary of this. But the Nvidia conversation is such an interesting one, just as, you know, we've talked over the day about how much this actually contributes to the downward move on the market, because Nvidia just has such a power hold, as well as Oracle in terms of being a weight. So very interesting to look at it from the AI bubble perspective and the competition perspective. And you know, we get another one of these deals every day, it feels like.
We do, and I want to track the amount, the true dollar amount added from just OpenAI and Oracle for AMD specifically. I know that OpenAI has been busy in its own right with several other partnerships, like announcing one with Walmart recently, but the dollars that change hands from some of these deals are huge, and I think that will be something to watch this entire earnings period, as we do see CapEx when it comes to AI is going to be, I think, one of the most closely watched metrics.
You are going to run into a major hurdle with that one, because OpenAI has notoriously not given financials on a lot of these deals, and they're still private. But let's talk last about Domino's. I know you're a big fan of Domino's, so we have to get them in the conversation. Trading higher on some impressive results that really bucked the trends here in the U.S.
Absolutely, and I will say that it's a lot easier to be an enthusiast of Domino's living in Chicagoland on days when the stock is actually moving to the upside, because it has gotten killed on earnings. So I mean, like a name that's
Is Domino's really a good pizza?
Higher on a year-to-date basis, but 15.5% from highs.
I got a Pop and Murphy's down the street. I'm very tempted to go down there today.
But was one of the top performers in the S&P 500, or is one of the top performers in the S&P 500 today, after overall beating on top and bottom line and strong U.S. sales, like you said. So the U.S. accounted for the bulk of their growth, words we have not been able to say for a lot of these restaurant chains. International same-store sales were still higher by about 1.7%, but that did mark a slowdown from the last 3 quarters, while domestic same-store sales growth accelerated to 5.2%, which is the fastest rate of growth we've seen here domestically since the first quarter of 24. So they did highlight their new stuffed crust pizza and their best deal ever, which is a large pizza for $9.99, which is actually, I will say, it's sad how expensive things have gotten, and it is very affordable in this current environment. But they also did say this drove in consistent repeat customers, more so in the U.S., which resulted in then another really strong delivery and carryout quarter for them here domestically. So same-store sales growth, I think, will be a metric to watch across the board for restaurants this quarter, but trying to find this value, as we've talked about throughout the day, it's really about feeling like you're getting a good deal. And thank goodness the U.S. average American is still eating their pizza, so I'm glad to hear it.
Still ordering pizza. The question is, Papa John's feeling like Americans might be ordering pizza for them too. We won't know till November 6th.
And Papa John's just like moving in sympathy on
Moving in sympathy
so,
on a higher note. Well, Domino's up 2.8%. Papa John's up 7.5%. Jenny Horn, thank you for breaking down the top stories for us today. Lots to cover there. But I do want to check back in with Sam and see what we have coming up next in the show.
Thank you so much for that, Marley and Jenny. Well, coming up, we will recap some of the themes that we saw from the third quarter and look ahead to what we can expect for the next quarter coming up on March.
Quarter.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Pedalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets, with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Hello everybody, welcome back to Market on Close. I'm Sam Barnes on the floor of the New York Stock Exchange alongside Marley Caden over in our Chicago headquarters. We've got just less than 45 minutes to go now until we hear the bells for this Tuesday. So let's just check in on where things stand right now as we look towards the close of trade, because we have seen a nice rebound for stocks very much coming off the session's lows earlier today. We looked
Target had a good bounce today.
Risk off, and now we have seen very much.
They're pumping Target to $100.
Positive now, so we have got the S&P 500 sitting up a quarter of 1% at 66.70. The Nasdaq still underwater there by a tenth of 1%. The Dow Jones really leading the charge there. 0.8 or so% higher. We are up almost 400 points on the session, and then the Russell 2000 very much outperforming there.
I don't know, man. It gets old.
Points, of course, we have been listening to Powell's commentary.
Target used to be a good one, but not no more. Evercore's really pumping this one.
Earlier today,
Who's
we
Evercore?
did see a bit of a flight to safety, dipping below that key level of 4%. We're above that now at 4.02, so we very much have seen that coming off as well. But looking at the US dollar ticking down now at 98. Crude oil is lower, looking at $58 a barrel. We've had the IEA actually coming out.
It's an investment
with
bank.
Demand outlook, so maybe some things are weighing there. And then Bitcoin continuing to slump, down 2% at levels of 113.
2,500 employees.
Let's take a look at the sectors that are on the
Founded
move,
in
because it is
1995.
sort of a mixed
$5 trillion.
but we have seen things, if you look under the surface, turning more into the green throughout the course of the session. Financials having a very good day there, thanks to some of the big bank earnings looking pretty robust from some of the major names in that sector. 1.6% higher. Consumer staples also doing well today, up 1.4%. It is a nice day for industrials, materials, real estate, utilities. In fact, everybody is up here, including energy, despite the fact that we are seeing those crude prices on the way down. Let's take a look at some of the big names, particularly across the technology sector. Mega cap tech. Apple is higher just fractionally there. It is Amazon and Meta that are underperforming today in the red. Alphabet, however, is higher. And if we flip the boards and take a look at some of the other big movers and shakers, because we did see a lot of sort of key names in the red earlier today, like Nvidia, for instance, but we have been seeing a bit of a rebound, particularly when you look at some of the technology stocks, although these still are all underwater. Broadcom, in particular, off the back of that nice rally we saw yesterday on this deal with OpenAI, and as I mentioned, it really is Nvidia that is dragging today, down almost 3.5%. So on that note, I'll send things back over to Marley in Chicago for now.
Thanks so much, Sam. Joining us now here in our Chicago studio is Zed Francis, the co-founder and CIO of Convexitas. Zed, thanks again for joining us in studio. You know we love having you here in person. I want to dive right into your Q3 note, the Convexitas note, titled Surrender to the Pro-Growth Agenda. Now, what do you mean by that? Who is surrendering? Is it the Fed? Is it the market? Or is it both?
I think it's kind of everybody. I mean, it was a pretty amazing quarter, especially in comparison to Q2, right? We have a little bit of a different dance over the last 3-4 months than we did early in the spring. But a lot of the themes are the old forces kind of surrendering to the current agenda.
And so is this the start of a new cycle then, or are we in like a late stage melt up before something's going to break?
Well, I mean, when you're kind of surrendering that pro-growth agenda, it means all the old items that everybody was worried about, they're at the moment not very worried about it. So you're like, we need something new to raise its head to kind of be a problem. But like you said, the easy one is specifically Powell, but the Fed as a whole kind of surrendered at the Jackson Hole meeting, and the follow through today is that they're continuing on that path. I mean, the only little blurb out of Jay today was essentially that the whole tapering thing, we're getting close to the end of that. So they're almost leaning into the concept that they are going to be supported. Inflation be damned. We don't even get the numbers anymore at the moment, but they don't really care. On the ability to really lean into growth and any sort of inflation issues is the concept that the long end bonds would get unhinged, that we have a decent sell-off, that we're back to the 5+% in 10 years. And the opposite has happened. We've had a pretty darn good rally in the long end of the curve, which is allowing everybody to kind of lean in to this concept of growth's going to win out. We're going to be able to grow out of all these potential deficit problems, so on and so forth. So
It's just been sideways all day.
And thus far, they're surrendering to the concept that it's going to work.
And why do you think that the bond market responded that way? I mean, classically, it's supposed to push yields up, but we saw the converse move.
Amazon Prime big deal days were a success.
My gut at the end of the day is that positioning is one of the biggest factors. I think a curve steepener was a favorite trade by many, and the main catalyst for making money in a short-term period on the curve steepener was ultimately central banks becoming more accommodative. So you got the catalyst you were looking for, and the results didn't pan out how you would hope. That tends to kind of say, this is overcrowded positioning, and in the short term, it tends to not work when it's overcrowded. The other piece of it is the Treasury has been able to, we'll call it meter their wall of issuance very effectively. They've delayed a lot of issuance items. And right now, the government shutdown allowing you to go ahead and delay a decent amount of new issuance. And they've kept to the old game plan of the previous Secretary of Treasury, where they've been issuing a significant amount of bills rather than anything longer dated. So I think the ham and egg of active market participants positioning, along with the Treasury is kind of trying to avoid that known tell that things are a problem.
And so if the Fed is really now pro-growth, what happens to inflation expectations next year? And we're all focused on this next meeting, the December meeting, but if that's really the case, what happens next year?
Yeah, again, like the theme was surrender. That ultimately, I think the market for now is just accepting the concept that 2.5, 3.5 is the new normal. Trying to pin ourselves on 2 is not where we're going to be in the next 1, 3, 5 years. And it hasn't caused any disruption, which always allows people to kind of lean into that further. And ultimately, if markets are going up significantly and wages are going up reasonably well, then a higher inflation isn't going to necessarily disrupt the path that the U.S. economy is on. If we all of a sudden had a 2022 where we have really high inflation and asset prices going down, well, that is a problem for spending, right? But that's not what we have right now. Everything's just kind of happily going up together.
Everybody's happily going up and everybody's doing a lot of shrugging.
That's right.
A lot of shoulder shrugging. So you've also suggested that Jerome Powell may have signaled some support for Waller as a potential new Fed chair here. What would be the implications if that's actually the case?
I think what the committee is potentially trying to say is, all right, we know you're going to pick somebody new that's likely going to be somebody that tilts towards your camp and thinking of where long-term rates should be for the direction of the FOMC. But they also want somebody that they know well, that's kind of coming from inside the house. It's ultimately not very market disruptive if you pick somebody that's already been a long-term participant in the institution rather than an outsider. So I think there was a little bit of the communication of this person is going to give you what you want and is going to be, we'll call it, appreciated by the markets, as you can see the results of asset prices after that kind of indication.
All right, so with all that said, what are some of the principal threats that could derail this pro-growth narrative?
Yeah, so I think the other thing that ultimately surrendered is the concept that there's any risk in the marketplace. So credit spreads are essentially at post-GFC all-time tights. even when we've been focused on interest rates over the last 5 years pretty intensively, the MOVE index, which is essentially the implied volatility of interest rates, how volatile we think interest rates are going to be going forward, is all the way back to 2021 levels. So there's no risk in rates, is what the market's pricing in. There's no risk in credit. And the equity markets, in terms of Q3, essentially rallied 8% on an 8 volatility. That was in comparison to the craziness that we were experiencing in Q2. And not everybody thinks in sharp terms, but if you just held the S&P 500 in Q3, that's almost a Sharp of 4. So that is incredible returns with almost zero risk. So the whole market has been saying for the last quarter, there is no risk, which ultimately sets yourself up to, okay, it might not take too much to disrupt that apple cart to go from zero to some risk. And the thing that's embedded specifically in equities, which was a story of 2024 as well, is essentially incredibly low correlation, i.e. equities have been able to diversify themselves. So over the last month, the S&P 500 has a realized correlation of 0. Like that is unheard of, that all the constituents of the S&P are moving essentially half up and half down every single day. So the market's grinding higher, but the correlation across everything is so low that it's basically burying a lot of risk in the system, because across all the constituents of the S&P 500, they're moving as if it's a normal market. It's not a highly volatile market, it's not a low volatility market, it's a normal market. But when you staple them all together, because they're moving in different directions, we experienced one of the lowest quarters of volatility since 2017, which was the lowest volatility year of all time.
Well, Zed, thank you for walking us through this growth strategy, the surrender to growth that we're seeing in the market. Certainly an argument to be made that there's been a lot of shrugging off of a lot of data and a lot of numbers. We appreciate you being here with us in studio. That's Zed Francis, the co-founder and CIO of Convexitas. And with that, I'll send it back to Sam in New York.
Thanks for that, Marley. Coming up next, I'll be joined by the team from Terra Innovator to discuss the company's decision to go public via a SPAC last week and the future of nuclear power coming up.
So we got the end of the day trade.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you could have done better. Same goes for where you invest.
$66.75s. SPXs, we're at 145, 150 here. at the 200 EMA. Now we're at the 200. $66.75s. I just feel like we're just up too much and we're doing nothing but going sideways. $60 lotto. $66.75s. 5 contracts. Now I'm going to wait. It's not feeling it. Be at the 85 cents maybe. There's the dip right there. See? Yeah, I wasn't feeling it. Them things got cheaper real fast. 66.70s. Go look at the spread widen on them. Now it's tightening up. God, man, this thing's really jumping up and around. $1, then $1.50. And they're way too far out of the money now. Jeez. Yeah, I'm not taking no chance with this. I'm not. I mean, I'm almost hit my support. I came within, I mean, real close. Within 50 cents. And then puts would have paid off good. Damn, them puts. The 6660s. Jesus. They went up $1,300. Oh my God. I had two of them at one time. That one candle, they went up $1,300. $1,400. They were at $370 last time I looked. Unbelievable. That's what you are. Man. I would have been more apt to get the puts than I would have the calls, because I didn't feel like getting the calls at all. Them suckers knifed. Well, that sucked. Them puts are really adding up. They're at $19.40 now. $2,000. That's $700 just right there. No, what did I have, the 70s? I think I had the 70s, not the 60s. So that changes things. So I still had the 70s? That would have made it a lot more. At 450. Them things are at $3,000. I didn't have the 6, I had the 70s. Oh my God. Shit. That's horrible. Oh. I don't know what to say. That'd have been almost $7,000, $8,000 on 2 calls, 2 puts. I was right not to buy the calls there in the close, that's for sure. That would have really screwed me. I almost had them ready. Damn. China. Well, if they're not going to buy my soybeans, we're not going to sell them no oil. China. Why can't we just get along with the Chinese? I love the Chinese people. China. Screw the commies. You ever been screwed by one? Okay, we got 7 minutes left. Well, what an end of the day. Trump tweet. The U.S. indices drop as China trade war tensions intensify. You can't do that to Trump, China. What's wrong with you people? It's not Joe Biden. China could walk all over Joe Biden, but not Trump. China. So I believe that China purposely not buying our soybeans and causing difficulty for our soybean farmers is an economical hostile act. We are considering terminating business with China having to do with the cooking oil and other elements of trade as retribution. As an example, we can easily produce cooking oil ourselves. We don't need to purchase it from China. I'm going to look at my cooking oil and see if any of it's made from China. I've never thought about that. So they buy our soybean to make oil to sell to us. Is that what he's referring to? The Chinese use a lot of oil. I'm not sure if that's a wise thing to do unless they think they can get it from Russia. Because I know it ain't in the Middle East. Let me see where cooking oil is produced. Cooking oil is produced in extracting oil, while Russia and Ukraine are key for sunflower oil. So yeah, Russia and Ukraine. The production process typically involves crushing the so they can just buy it from Russia. This here stuff is what guy turned me on to the other day. AG Cooking Club Chef Grade Algae Cooking Oil. Chef Grade Algae Cooking Oil. Where's it made at? China. $535 smoke. You got 10% off. The most important thing, your cooking oil. I gotta try to find that. I'm gonna get ready to cook my stuff. Oh well, that's a bummer. That's 2 trades today where I could have made over 20 grand. More than that. Probably about 25, 30 grand just keeping the calls this morning, both SPX and SPY. I had 20 of them at $5 a piece, $500 each. And I had 2 calls that went to 1,700, and then these puts that went to what'd they go to? $115? Are you kidding me? That's 20 grand. No, that's impossible. No, higher than that. 115, that'd have been 30 grand. Wow. I'd have had at least a $55,000 day. But I'd never hold them that long. I mean, give me a break. It's hard for me to play puts. And usually when I do, I'm wrong. It's not that I don't have near the percentage rate I do on calls. So that's an interesting day. Someone on StockTwits told me it's going to be an interesting day today, and he was right. I mean, you go sideways most of the day. I got to where I didn't want to trade anymore because it was my bad hour. So I was going to buy calls. And then it tanked, so I'm glad I didn't get them. I got oil all over my face for some reason. Well, I'm going to relax, watch some videos. I think it was an interesting day. I still green for the day, but I mean, it could have been an outstanding day. Now, all I've heard is bubble this, bubble that, bubble this, bubble that, bubble this, bubble that. The way I play that kind of market is I wake up, the market's down, I'm bullish. And today was a great, I mean, it continued going down. Let's pull it up here. This is an interesting day today, it really was. So we opened up down and Randy nailed it. And then it pulled on down more in a short period of time. And I called these 3 black crows out down here, especially on even on the 5-minute. 3 black crows on the 5-minute. So it took 15 minutes into the day, and bam, I got out up here in this area here. You know, them things ran up to $2,000. A little more than that, from 65 cents on the calls on the SPY. These were, I forgot what I got them at. So, chart patterns, moving averages, and being a now. 3 black crows on the SPY also. I jumped into both the calls and the SPX at that point. Then we had a triple top and it started getting weak. And then we had it to the 200. See, on the 5-minute. So that's easy to read. Bounced off the 200 here. So that's real easy to read right there. In the 1-minute. People get a little confused on the 1-minute. You can see that the trading with the 5-minute won't get you that many trades like I trade, like the 63 here. It held the 63 all day for scalping. Then you had a double top. Almost a triple top. Then it consolidated for a good 2 hours. And then Trump tweet comes out and spoils everything. So you got to be very careful when we're at all-time highs. And we got this trade war going on with China right now. Just one of his tweets hits an algorithm. And all I heard today from CNBC and even some on Schwab, bubble, 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 bubble. We're, you know, that's that one guy says, no, tech's not, you know, we're more in utilities and banks. And the banks are overbought. The banks are way overbought. So I could see them pulling back after earnings, no matter how good the earnings were. My opinion. We're going into regionally banks, he says. So, real good comeback today. I think the retail traders made a lot of difference in this market. Because the fat cats have been saying bubble for the last year in tech, and they've done nothing but gone up. So that's kind of why I get kind of itsy with Marley on here. She reads all this stuff about what the fat cats are doing, and I don't particularly agree with a lot of what they're doing, because they try to change direction of the market. And once it gets lofty, they want to try to move it into and make it a more balanced trade, but so I'm not swinging nothing until we have a good correction. At least 10%, 9 to 10%, if it happens. But it's buy the dip mentality right now, so you don't want to go against that grain. Buy the dip. We heard that today too. I like listening to Schwab and CNBC just to get a perspective, and it directs the way I want to trade. Not that I'm going to believe all the crap they say, because I'm still lenient of any woke traded stock, but there gets to a certain point where they're so cheap that you got to start have to change your mind a little bit. You know, Disney, they were pumping Disney again today. They have, like, Bob Iger is the number one out there, and it run right to it. Yesterday it hit my support, 109.41. We hit it again today, and I've been talking about this support for weeks, if not days, if not weeks. If we get down to it, it's going to be a good support. I've been saying it. And then we hit that on that big flash crash. Next day we hit it again. We're running in, so as long as we're under that 200, we're still bearish. If we get above the 200, then we can run it back up to this last resistance at 115. As far as I know, this thing can drop to 107 because I don't like this guy. Disney has considered a co-CEO structure to replace Bob Iger. He needs to go. Some of these companies, they just hire a well-established CEO because they think it's going to turn around the company. A lot of these fat cats, you hear them talk about, well, I like this CEO, and that's a way to trade. It's like the idiot they got for Starbucks. I mean, he looks like a jerk. But he's highly, pumped up. We're down here on a head and shoulders. Inverse head and shoulders. So, it was cheap on that day, and they probably jumped in this trade, the fat cats, to add on to their position, because they're heavy in this trade right now, Starbucks. I haven't bought but one coffee and 2, maybe 3 coffees in the last 10 years from them. Maybe longer than that. I bought one this year because I wanted to try that matcha drink out. It was good, but I had to shake it up, stir it around. I mean, I didn't like how they mixed it. Once I stirred it around, it tasted real good. Target's another one. It's a woke company. Starbucks is woke. Disney's woke. Nike is woke. And look at Target on the 3-year. This is what happens when you go woke. You go broke. And this is a triple bottom. So, and I called this out yesterday. And we had a bounce today on that one. There's only goes so low. This is a new 3-year low. You can only go so low. That's Nike's another one. See, 3-year Nike. Nike used to be Buffett stock. Now see, you go woke, you go broke. And they've not been able to change either. I mean, they're selling men's bras. Okay? They're selling men's bras. Budweiser was another one. Budweiser really got hit hard, but it's another fat cat stock. They love all these stocks that I'm mentioning. It had a new high this year. They piled on that baby. Now we're at the 200, so we're at a pivot point. I'm building a symmetrical flag. I wouldn't doubt if this thing jumped back up this winter to that head and shoulders. Back up to 64. But, and then we got Walmart. Walmart didn't really go woke, but they're involved in a lot of woke shit. Walmart had a breakout today on the 3-year. This used to be a stock that hardly ever moved at all. I traded it back in the 80s. I had it in my 401. And I did inventory for Walmart, so I had, a couple hundred shares. If I'd held them, I'd probably been not very rich. Who knows? I'd have tripled them. So it's a couple hundred times $100 a piece. Trying to think of any other one. Those are my top. Those are all, top, used to be top rated companies. So that's an ascending triangle breakout. 1, 2, 3, 4, make a little bit more. Definitely an ascending triangle. Well, I'm going to get out of here. I hope everybody had a good day. I mean, some of us are sad because we didn't hold the calls that I called at the very bottom. Jimmy can call the bottoms. I know how I can figure that out. Get rid of me. Okay. Vote me out. I'm going to go ahead and take a boogie. I got to shop for a camper, and I got to put a. I'm going to put a shed out on my property. I'm going to do a dry I'm going to put up a self-drying concrete slab for my shed. That's going to be a lot of work. Might just get a concrete company to go out there and do it. I've never done that before, so I'm going to build me a little off-grid living quarters up at my property. And then keep me busy. Got to put in a mailbox, get my mail transferred up there. Make me a little place where I can jam out. I miss playing music. I'm getting a little bit better. I'm getting some of that rust out of me, but okay, well, I think it's time to go. Thank you, Robert. Thank you, Parge. We'll see you tomorrow, YouTubers. Now thinking about if anybody wants to donate to my vacation fund on YouTube, you can. So I might get that thing where you do that.